Hi friends, today I'm uploading the investment decision chapter. Many of the students wanted me to upload this chapter, full chapter in around 12 hours. You will learn all concepts and good number of questions have been practiced in this video. So that will give you the full confidence to face your exam as far as this chapter is concerned. Practice along with me, do questions, and then only you will learn. Just going through the video alone will not help. Do sums along with me, practice along with me. All concepts and questions will make you fully ready for your exams. What are we going to cover? All my concepts from the concept book, and I think around 35-40 questions are also covered in this video. 12 hours of extensive learning. We have also uploaded full video for ratio analysis chapter. In cost accounting, I've done it for standard costing and labor chapter. So two full chapters in costing, and now the second chapter in FM is also uploaded, and one more chapter in costing I'll be uploading. Three costing and two FM full chapters are uploaded so that you get the much needed confidence and boost in your marks. With this, the regular class video starts. Thank you, friends. Okay, now we start with investment decision. This is the second major layer of your financial management. The financial management has technically four major layers. One was financing, one was investment, and there's another layer called dividend decision. So dividend decision we'll see later. Financing we are already covered. Now I come to investment decision. What is investment decision is whenever an organization is making a big investment, they want to be sure before making the investment. Let's take a personal example. I plan to buy a mobile phone. The cost of the mobile phone can be 15,000, 20,000, 25,000, 30,000, 35, 40. For me or for you, that is a material amount. 15, 20,000 is not a small amount for you. Will you just randomly go and buy a mobile phone, or you do some research before buying a mobile phone? You'll do some research. You want to buy a chocolate of 1 rupee. You want to buy a chocolate of 1 rupee. Will you do any research before buying a chocolate of 1 rupee, or you'll just randomly go and buy it? Mostly we will go randomly to a shop. I'll say I want some chocolate. He gives me something. I'm kind of okay with it. I'm kind of okay. I just wanted to have some chocolate. 1 rupee, 5 rupee, 10 rupee. Dairy milk is okay. 5-star is okay. Anything is okay for me. I'll just buy the chocolate and come back. No research. Not thinking that what is the price in Amazon, what is the price in Flipkart. I just go and buy it and come back. That's all. I just wanted a chocolate, or I just ordered in Zepto and I just get it. But before buying mobile phone, I want to check the review of the mobile phone. What do? I check some YouTube video. I check some Google reviews to understand how is the mobile phone performing. Then I go to Amazon, check its rating. Then I go to Flipkart, check its rating. After that, I check the price in Amazon. I check the price in Flipkart. I check the price in the website of the seller. I check the price at other places. I do a lot of research. How much research you want to, that depends on you. But you will do some research. Nobody is going to randomly buy a mobile phone, buy a laptop. Even me, I'm not going to buy randomly a mobile phone or a laptop. I will do some research. Maybe Reliance Industries Limited want to buy a mobile phone. They'll not do all this research. They'll say, let's place an order and get it, because for them that is not a material amount. That is not a material amount. Mukesh Ambani wants to buy a mobile phone. He will not do any research and all. He will just see which is the high-end mobile phone and buy it. That's all. No research, nothing. The upgraded version of iPhone, the upgraded version of Samsung, anything he wants to buy, he will just buy it. He is not going to do any research, because for him it is an immaterial amount. For him it is an immaterial amount. Reliance Industries wants to do 1 crore investment. No research, directly 1 crore investment. Bharadwaj Institute wants to do 1 crore investment. We will do lot of research. So investment decision basically says that whenever you are doing a material expenditure can be different for different people. Investment decision means budgeting for capital expenditure. Other name for investment decision is capital budgeting. Capital budgeting means budgeting for capital expenditure. Budgeting for capital expenditure. It involves huge outflow of money. Revenue expenditure, less investment. I want to take classes from this building. I am taking it on rent. I may not do that much research. Some analysis I'll do. I find location is good. go ahead and start the batch. I want to buy this building. Just location alone I will not do. I'll have to do legal research. I have to check whether resale can happen. Lot of analysis I have to do. Capital expenditure randomly cannot be done. Revenue expenditure, no problem. You want to go today from place 1 to place 2. In Ola, any car is okay for you. Any car is okay for you. But if you want to buy a car, any car is not okay. Any car is not okay. Before buying the car, you want to be doubly, triply sure that that car is the best according to your requirement. Whereas in Ola, if you are going, Uber, you are going, revenue expenditure, not that much bothered. I may try to get a car which I want, but anything is okay. I cannot decide the car anyway. I can just say I want an SUV or I want a normal car. Anything can come. So whenever you do revenue expenditure, you are not that much worried about the expense. But whenever you are doing a capital expenditure, you are worried about the expense. Even in revenue expense, if something is very huge, you still do some analysis and go, but we are only bothered about capital expenditure. So involves huge outflow of money, and hence proper appraisal is needed before doing investment. Proper appraisal is needed before doing investment. I cannot randomly do an investment. Randomly doing an investment is not possible. Clear? This is the context. Now, in order to do this, there are 6 techniques of capital budgeting. I'll be explaining them one by one. There's a payback technique, there's a discounted payback technique, there's an NPV technique, there's a profitability index technique, ARR technique, and IRR technique. 2 words of this we have used it earlier when we did the chapter on cost of capital, but that time I said I will not explain much. I'll explain it later. We had used term called NPV there. We also used a term called IRR there, but I did not explain much. I said I'll explain at this point of time. Clear? Any doubts till this? Format we will discuss it later. Let's first start with one by one. Okay. Payback technique. Payback technique is the term payback. Payback means give it back. Give it back. As the name indicates, payback, give it back. Let's take an example. I buy a mobile phone. Year zero. Year zero means today. I pay 20,000 rupees for the mobile phone. 20, or you can take not mobile phone. Let me take another example. Year zero, 5 lakh rupees. I wanted to build a restaurant. 5 lakh rupees is my investment on the restaurant. On the restaurant, 5 lakh rupees is my investment. First year, restaurant will give me 3 lakh profit. First year, it will give me 3 lakh rupees. Year 2, it will give me 2 lakh rupees. Very happy. I got my money back in 2 years. I got my money back in 2 years. Payback is 2 years. Payback is 2 years. Many places when an investment is done, if you have looked at some interviews and all, they'll ask, what is the payback period? In how much time will this money come back to us? I invested 5 lakh, got back how much? 3 lakh in the first year, 2 lakh in the second year. Beyond this, I'm very happy. Everything is profit. Beyond this, I'm very happy. Everything is profit. Payback basically means in how many years will I get back the investment done? Will I get back the investment done? There is one issue in this analysis. The issue is this 3 lakh and 2 lakh is not worth 5 lakh today. This 3 lakh and 2 lakh is not worth 5 lakh today. Concept time value of money, which is later called discounted payback. I'll explain that. Payback without time value of money, without time value of analysis. What happened? I gave you 5 lakh rupees as a loan. You paid me 3 lakh in the first year, 2 lakh in the second year. My principal has come back. Anything extra comes back, I'll be happy. That is extra income for me. But I got my money back in 2 years without considering time value of money. Without considering time value of money. So year 0 paid 5 lakh. Year 1 I got back 3 lakh. Year 2 I got back 3 lakh. We do something called as cumulative cash flow. What is cumulative cash flow? It's cumulative values for this. Year 0 cumulative values negative. Year 0 means a single day, okay? Negative 5 lakh plus 3 lakh. Negative 5 lakh plus 3 lakh is negative 2 lakh. You could have learned a term called cumulative frequency in median calculation. Same thing, cumulative value. Negative 2 lakh plus 2 lakh is my money is back. Anything after this is my profit. Anything after this is my profit. So I get my money back in 2 years. I get my money back in 2 years. That is called payback. That is called payback. Any doubts till this first? In how many years are we getting back the money which we are investing? I buy a mobile phone. I don't bother about payback because I don't earn anything out of the mobile phone. That's why I change the example. Okay. But I buy a laptop. I want to calculate payback of laptop. I can calculate because laptop gives me income. Laptop gives me income. You buy a car. Car, personal use, no payback. Commercial use, you can calculate payback. An Ola driver will calculate payback of a car. Payback of a car. In how many years is he able to recover that 15 lakh rupees of the car? In how many years is he able to recover that? Clear? Any doubts till this? Another example, year 0, 5 lakh. First year, 4 lakh. Second year, 3 lakh. Second year, 3 lakh. First year, I got back 4 lakh. Second year, I wanted only 1 lakh. Second year, another 1 lakh only I wanted. I got back how much? 3 lakh. Payback is somewhere between first and second year. It's not second year. It is between first and second year. How to calculate that you will understand. It is between first and exact zero you get very happy. That is the payback. But practical world, exact zero and all not possible. Exact zero is not possible. Any doubts on the concept here? So first technique is payback. 10 lakh invested, 4 lakh 50 got back, 5 lakh got back, 250 got back, 2 lakh got back. We calculate cumulative cash flow. We calculate cumulative cash flow. Do you see exact zero somewhere in cumulative cash flow? If you get exact zero, that is the payback. Exact zero, that is the payback. If you are not getting exact zero, you will have negative and become positive. In between that payback happens. Negative and positive in between. In between that payback happens. When is it negative? Which year it is negative? Participate guys, I want participation. Year 2. Which year it became positive? 3. Somewhere between second and third year I got back my money. So how do I calculate? Base year, unrecovered cash flow of base year divided by cash flow of next year. Don't write the formula, don't remember the formula, understand logic. What is base year is the last time when cumulative cash flow is negative. Is year 0 cumulative cash flow negative? I want participation guys. Year 0 is it negative? Year 1 is it negative? Year 2 is it negative? Year 3 is it negative? Year 2 is the last time it is negative. Base year is year 2. Base year is year 2. Whenever it is negative for the last time. Whenever it is negative for the last year. What is the unrecovered cash flows? How much negative it is in the second year? How much negative? 50,000. So I am in the second year and I tell, can you recover another 50,000? Can you recover another 50,000? He says, no, no 50,000. I'll recover 2 lakh 50,000. I'll recover 2 lakh 50,000. Third year, how much we are recovering? 2 lakh 50,000. Divide by 2 lakh 50. 50,000. Sorry, year 2 plus another 1 by 5 year. Another 1 by 5. I wanted 50,000. You are giving me how much? 2 lakh 50,000. You are giving me 2 lakh 50,000. So your payback is 2 plus 50,000 by 250, 2.2 years. Payback is 2.2 years. I'll repeat the explanation again. I got back negative 10 lakh. Let's write another example. Year 0, negative 10. Cumulative is negative 10. Year 1, 4 lakh. I got back 4 lakh. Negative 6. Year 2, 5 lakh. Negative 1 lakh. Year 3, 4 lakh. Positive 3 lakh. Beyond this, I'm not writing, okay? Positive 3 lakh. Is the CCF negative for year 0? Participate, guys. Is it negative? Year 1, is it negative? Year 2, is it negative? Year 3, is it negative? No, base year is second year. Base year is second year. Second year, how much negative in second year? 1 lakh. How much is the cash flow of the next year? 2 plus 1 lakh by 4 lakh. 2 plus 1 lakh by. In the third year, I wanted 1 lakh only. You are giving me 4 lakh extra. I wanted only 1 lakh rupee to attain payback. But you gave me how much? 4 lakh. Very happy. I'm able to attain payback and earn more also. So my payback happens in 2.25 2.25 years. My payback happens in 2.25 years. Any doubts on this? Any doubts on this? 2.25 years. Clear? Able to understand this? So payback, time taken to recover the initial investment, ignoring the time value of money. Base year plus unrecovered cash flow of base year divided by cash flow of next year. We are not bothered about profits. We are only bothered about cash flow. Profits is not my worry. Reason is profits an accountant can keep changing. WDV method, SLM method, all this you can do. Cash flows are what finance is bothered about. We are not bothered about profits anywhere. Till now, whatever you learnt in any of the chapter, nowhere I use the word profit. I'm only bothered about cash flow. Only bothered about cash flow, because cash flow is where the real inflow or outflow is measured. Books of accounts you can keep altering. 10 accountants can give me 10 profit figure, but 10 accountants cannot give me different cash flow figure. So cash flow is what matters here. Profits is not my worry. So I work with cash flow. How to calculate cash flow and all you will see later. Okay. So if you are following payback technique, you need these three format. This is the format. Okay. You need year, cash flow, cumulative cash flow. There are other columns which I don't need for payback. For payback, I need what? Year, cash flow, and cumulative cash flow. Any doubts on this? Any doubts on this? We are going to see a problem now. Then I'll come back to the next technique. Any doubts on this? Any doubts on this? Page 144, question 2. 144, question 2. A company has to make a choice between two projects, namely A and B. Initial outlay of the two projects are 135, 240 for A and B. No scrap value at the end of life. Opportunity cost of capital. Cash flows are as under. You are required to calculate payback, discounted payback, ARR, NPV, profitability index, tabulate the result and indicate which is better if the projects are mutually exclusive. Assume that target payback is 3 years, discounted payback is 4 years. Now, I give you a minute or two, you go through the question. A minute or two, go through the question. Okay. Company needs to make a choice between two projects, A and B. So they want our help in saying which is better. Is project A better or project B better? In order to do this, they have asked 5 techniques in the question: payback, discounted payback, ARR, NPV, profitability index. What we are going to do is we'll first do payback for project A. Then I'll give you 2-3 minutes. You will do project B. We will do A together. B, you will do it. Then I'll explain the next technique. I will do A, you will be doing B. This is how we will proceed with all the 5 techniques. Today we will try to cover all the 5 techniques. IRR is something a time consuming technique which we will do it in the next session. Let's start with payback calculation. Working note 1, computation of payback. Computation of payback. In fact, if I do all the techniques together, I need a single table of 8-10 columns. Everything can be done together. But being the first question, I'll do every technique individually. For payback, we need 3 columns: year, cash flow, cumulative cash flow. So open 3 columns: year, cash flow, cumulative cash flow. Year, cash flow, and cumulative cash flow. Whenever you write cash flow, it will always start with year 0. Whenever you write profit, profit is always for a year. Cash flow can be there for a single day also, which is year 0. Which is year 0. Year 0, how much we have to invest in this project? Project A, negative 135. Outflow, negative 135. Question has given cash flows are as under. Sometimes they may give profit. From profit, how to calculate cash flow, I'll explain later. Year 1, what do we get back? 0. That's okay. Year 1, 0. Year 2, 30,000. Year 3, year 4, year 5. Any doubts on any of these numbers? Cumulative cash flow, write the cumulative amount. Negative 135, negative 135 plus 0. Negative 135 plus 0, obviously negative 135. Cumulative values of this, then negative 135 plus 30,000, negative 105, then negative 105 plus how much? 132, positive, positive 27 plus 84, 111, positive 111 plus 84, 195. Any doubts on these numbers? I don't see any difficulty in this. Base, once it is set, will be in a position to handle different question. We're just setting the base for the calculation. Any doubts on this? Done? Can we proceed? Any doubts on the base here? Now write. Payback is equal to, payback is equal to, look at the CCF column. Do you see exact 0 there? If you see exact 0, directly write the answer. No need to do any calculation. I don't see an exact 0 there. If you see exact 0, that's the payback. Base year plus unrecovered cash flow of base year divided by cash flow of next year. Base year plus unrecovered cash flow of base year divided by cash flow of next year. It's a very simple topic as long as you understand the concepts properly. Cash flow calculation will become little tricky. You will understand as we proceed. Base year plus unrecovered cash flow of base year divided by cash flow of next year. Is the CCF negative for year 0? Participate. I want participation. Is it negative? Year 1, year 2, year 3. No. So year 2 is the base year. Moment it is negative for the last time. Year 2 plus unrecovered means how much negative in the second year. How much negative in the second year? Unrecovered means you are yet to recover that much. How much negative in the second year? 1,05,000. What is the cash flow of the next year? 132. 2 plus, give me a 4 decimal answer. 105 divided by 132. 0.7955. 7955. Any doubts on this? Any doubts on this? Clear? So payback equal to 2.7955 years, or 2.7955 years, or you can leave it this way also. Depends on if it's an MCQ, you may not see this in the answer, or 2 years, and the decimal portion multiply with 12. What is 12 to convert into months? 0.7955 multiply with 12, only the decimal portion. Decimal portion multiply with 12 to convert into months. To convert into months. The decimal portion alone multiply with 12. 0.7955 into 12. How much? 9.5 months you can say. 54 or 9.5 months. Let it be okay, 9.55 months. 2 years and 9.55 months. I'll basically say that in 2 years and 9.5 months, your break even will happen or payback will happen. Payback will happen in 2 years and 9.55 months. 2 years and 9.55 months. Any doubts in this? Any doubts in this? Exactly 2 minutes, complete the other project. Exact same thing. Other project, 2 minutes for you. 2 minutes for you, other project. Okay, coming to project B. Very simple. Year cash flow, cumulative cash flow. What is the initial amount? Negative 240 240 plus 60 is negative 180. Negative 180 and 84 is negative 96. Exact 0, 102, 192. Answer is directly year 3. Directly year 3. Exact 0 you are getting. No formula, nothing is needed. Year 3. Any doubts on this? Any doubts on this part? With this, the payback discussion is over. Any doubts on this? In payback, lower payback is preferable because I want to recover the money as early as possible. So A and B, A is better. A and B, A is better. Any doubts on this? In that also, there could be a target payback given in the question. Target means you want to recover money in that period. What is the target payback given here? 3 years. Within 3 years, I should get back my money, which is A is also giving in 3 years. B is also giving in 3 years. Both are good only, but A is relatively better than B. A is relatively better than B. We'll write a final tabulation later. So A is a better project as compared to B based on payback. Any doubts on this? Clear? Can we proceed? Okay. Second technique is discounted payback. The problem with the payback technique is time value of money is ignored in the calculation. In our calculation, we did not consider time value of money. What discounted payback says is do the same calculation. Only thing is you have to discount the cash flow first. How will you do discounting? Year, cash flow, PVF, DCF, and then cumulative discounted cash flow. Then do cumulative discounted cash flow. In the calculation, year tick, cash flow tick, cumulative cash flow is not needed for discounted payback. PVF tick, DCF tick, CDCF tick. These 5 columns I need. Year, cash flow, PVF, DCF, CDCF. Because I'm doing discounted payback, again I have to open 5 columns. If I had done together, year and cash flow would have been a common column. I need not keep repeating the column, but first question I'll do individually all the technique. So now we are going to move to discounted payback technique, where the only difference is you should discount the cash flow. At what rate will you discount? Cost of capital. You need to discount it at cost of capital. Why cost of capital? Just give me a minute. Why cost of capital is because that is the minimum return I want. Minimum return I want. So I want to discount it at the minimum return I want. In the cost of capital chapter, we learned WACC. That WACC will be the discount rate here. Or WMCC, it can be WACC. Best is WMCC. WMCC is the cost of additional capital. Here, coming back to this question, again projected cash flow. The opportunity cost of capital is 16%. So you need to discount it at 16%. They've already given the discount factor there. How did they give discount factor? In the calculator, 1 divided by 1.16 first year factor equal to second year factor equal to third year factor equal to fourth year factor equal to fifth year factor. How many decimals they have given? 3 decimal. Follow that. Problem silent, 3 decimal. Problem gives you 4 decimal factor, follow 4. Problem gives you 5 decimal factor, follow 5 decimal factor. Whatever question gives you. Question is silent, 3 decimal. Question is silent, 3 decimal. Working note 2, computation of discounted payback. Computation of discounted payback. Project A. Copy paste year and cash flow same as it is. Totally 5 columns will be needed. Year, cash flow same. Totally 5 columns. Year and cash flow copy paste. Year, cash flow copy paste. Year and cash flow copy paste. Now time value of money said you cannot add these cash flow. They are at different points of time. Please bring it to one point of time, which is called present value. I normally bring it to year 0. Can I take it to future years? Yes, can be done, but that will not help me in giving the answer. So we bring it to a common time period, which is year 0. PVF at discount rate will be there in the question. PVF at what is the discount rate? 16%. Year 0, write 1. Why 1? Because year 0, present value, future value is same. They've given the factors in the question, assuming they don't give in the calculator. 1 divided by 1.16 equal to first year factor, 3 decimal, 0.862. Another equal to 0.743. Where did we learn this? Time value of money. Time value of money discussion. Another equal to 0.641. Another equal to 0.552. Another equal to. Clear? Any doubts in this? This is presented in the question. Do proper rounding off when you do the calculation. Any doubts in this? Can we proceed? Cash flow into the present value factor is called discounted cash flow. I discount the cash flow. How do I discount? By multiplying with the present value factor. Multiply. DCF. Negative 135 as it is. This is CF into PVF. CF into PVF. 0, 22, 290, 84, 612, 46, 368, 39, 984. These are the DCF numbers. Any doubts on this? Payback is technically a wrong technique because it was not giving the benefit of, or it was not giving the effect of time value of money. It was just normally adding it. Now what you need to do is CDCF. Please do cumulative value for DCF column. Starting with negative 135, negative 135 plus 0, negative 135 plus 0, plus 22, 290, negative 112, 710, add 84, 612, negative 28, 098, 46, 368, positive 18, 270, 58, 254. Keep adding the values. This is the base. Unless base is clear, you will not understand the concept, because questions main focus will not be giving cash flow. They will ask you to calculate cash flow and then the technique we are learning without focusing on the cash flow. Then later on we'll focus on cash flow calculation. Any doubts on this? Any doubts on any of these numbers? Can we proceed? Any doubts? Done. Discounted payback, same formula with small changes. Discounted payback is equal to base year, base year, just a minute, base year discounted payback, base year plus, there it was called unrecovered cash flow, here it is called unrecovered discounted cash flow of base year. Instead of using the word cash flow, use discounted cash flow, divided by discounted cash flow of next year, divided by discounted cash flow of next year. There it was cash flow, here it is called discounted. The name of payback is replaced with discounted payback, name of cash flow is replaced with discounted cash flow, denominator cash flow is again replaced with discounted cash flow. Base year plus unrecovered discounted cash flow of base year divided by discounted cash flow of next year. Any doubts? And now tell me, is CDCF negative for year 0? I want participation. Is it zero for, is it negative for year 0? Negative for year 1, negative for year 2, negative for year 3, negative for year 4? No, base year is year 3. 3 plus, 3 plus. Third year is the base year. For discounted payback, year 2 was the base year. How much negative in third year? 28 divided. How much is the DCF of the next year? DCF, not the normal cash flow. DCF 46, 368. 3 plus 4 decimal answer. 0.6060 years. You can convert the decimal part into 12. Decimal part into 12. Any doubts first on this? 6060. Any doubts on this? Clear? Very simple logic. Only thing is time value of money is to be considered here. Discounted payback is equal to 3.6060 years or convert the decimal part into 12. 7.27 months. Approximately 3 years and 7 months. Approx answer is 3 years and 7 months. Any doubts on this? Any doubts on this? Clear? Understood this? Anybody has any doubts on this? Exact 2 to 3 minutes. Complete project B. Any doubts on project A? 2 to 3 minutes. Do project B. So the cash flows are given. What is the year 0 number? Negative, negative 240. Year 1, 60. Year 2, 84,000. Year 3, 96,000. Year 4, 1 lakh, 2,000. Year 5, 90,000. The discount rate was 16%. So 1 divided by 1.16, 1.862, 0.743, 0.641, 552, and 0.476. You have to discount this. These are your discounted cash flow and put a total. These are your individual numbers for every year, and discounted payback is 4 plus 8028 divided by 34812 divided by 34812, which is equal to 4.23 years. 4 point divided by 42840 divided by 42840 divided by 42840 sorry, 4.1874 years are the decimal part. Decimal part you can convert 4 years and how many months? 2.25 months. Any doubts on this? Any doubts on this? Divided by 42,840. Sorry. Any doubts on this? Clear? With this, discounted payback discussion is over. We'll take a break of 10 minutes and then I proceed with the next part. Okay. I move to the next two techniques, NPV and profitability index. There are other names for profitability index called as benefit cost ratio, present value index, or desirability factor. I'll explain this. NPV is very simple, net present value, inflow minus outflow, present value of inflow minus present value of outflow. Present value means after discounting. After discounting, present value of inflow minus present value of outflow. Is there a separate format or separate analysis needed? No. In this question, if you put a total of this, negative is automatically deducted, positive, that is outflow, is automatically deducted, and the positive item is automatically added. Just the total of this is called NPV. Negative 135 plus 0 plus 22 plus 84 plus 46 plus 39 is technically the net present value of the project. Just adding all the numbers, sign is automatically taken care of. Outflow is automatically minus, inflow is automatically plus. So separately, I need not give a formula, but if you still want a formula, it's inflow minus outflow. And PI is exactly same thing, just that it is expressed as a ratio. Present value of inflow divided by present value of outflow. It is expressed as a ratio. The other name for this is called benefit cost. Benefit is numerator, cost is denominator. Benefit is numerator, cost is denominator. Profitability index, benefit by cost, or present value index, or desirability factor. NPV, I need positive. Positive technically means inflow is more than outflow. Profitability index, I need more than one. More than one means inflow is greater than outflow. Inflow is greater than outflow. If your inflow is greater than outflow, you will get a profitability index of more than one time. Present value. Present value means you'll have to do discounting. What is the format to do this? Year, cash flow. You see no tick for cumulative cash flow, but a tick for PVF and DCF. Again a tick for PVF and DCF. Only four columns I need: year, cash flow, PVF, DCF. All these four columns are already prepared by us. We are already prepared, so we are not going to prepare it again in this question. We have already prepared a year column, cash flow column, PVF column, DCF column. All the four columns are already prepared by us. We are just going to directly calculate it now. What is NPV? Present value of inflow minus present value of outflow. What is profitability index? Present value of inflow divided by present value of outflow. Clear? Now write NPV is equal to working note 3, computation of NPV and PI. NPV and PI, NPV and profitability index. NPV is equal to PV of inflow minus PV of outflow. This is the only time I'm going to write the formula. Later on, no formula. Directly just put a total of it. Tell me the total of all plus items there for project A. NPV of A. Total of all plus items. 0, 22, 290, 84, 612, 46, 368, 39, 984. Total of all plus items. Total of all plus item. How much is the total? 193, 254. Only the plus items total, okay? 193, 254. Minus item total is 135. Total of all plus items, total of all minus item. As I said, no need to do a separate formula. Just put a total there, automatically answer. What is the answer? 58 to 54. This is project A. 58 to 54. It will match CDCF of last year, because CDCF of last year means everything is added. It will match CDCF of last year. Any doubts on this? Any doubts on this? NPV of B. Total of all cash flow. 51, 62, 61, 56, 42. All total. Total of all cash flow. How much you get? 274, 812 minus 240. 34, 812. 34, 812. 34, 812. Clear? Any doubts on this? Done. Profitability index, same formula, just that instead of subtracting, we're going to divide it. We're going to divide it. Profitability index, it's a ratio. NPV is an absolute number, PI is a ratio. Profitability index is equal to PV of inflow divided by PV of outflow. Inflow divided by outflow. PV of inflow divided by outflow. project A, project A, what is the inflow total? We already have 193.54 divided by, give me a 4 decimal answer. 1 point R, 1.4315 R. You can express in percentage also. Sometimes I say it as times, sometimes mostly times. Okay, 1.4315 times, you can write it as 1.4315 times R, 143.15%. 143.15%. 1.4315 times R, 143.15%. Any doubts on this? Clear? Then project B. Project B. Project B, 274,812 divided by 240. 1.1451 times R, 114.51%. 114.51%. Which is better? More positive NPV is better, and whichever has higher PI is better. Higher the better, higher the better. Payback, lower the better. Discounted payback, lower the better. These two, higher the better. Obviously, it has to be positive and greater than 1. Negative means it will get rejected. Negative means we are rejecting it. Positive and greater than 1. Any doubts on this? Any doubts on this? Can we proceed? Clear? We are done with 4 techniques. The 5th technique is on accounting rate of return. As the name indicates, accounting is always bothered on tax, on the profit after tax. It is only bothered about profit and not bothered about cash flow. Not bothered about cash flow. So as far as accounting rate of return is concerned, we use PAT. We don't use cash flow. We don't use cash flow. We use profit after tax. Now, profit after tax plus depreciation is technically cash flow after tax. Profit after tax, assuming depreciation is the only non-cash item. There can be other non-cash item, then calculation will change. Profit after tax plus depreciation is called cash flow after tax. So PAT is equal to cash flow minus depreciation. PAT is equal to cash flow minus depreciation. So first thing I have to do is calculate PAT and take an average of that. Take an average. What is accounting rate of return is what I earn divided by what I invest. Where did we learn this formula? Ratio analysis. ROI, ROA. What do I earn? Average profit after tax. What do I give? Investment. There are 2 types of investment. One is called initial investment. Second is called average investment. What is average? Redeemable value plus net proceeds by 2. Closing value plus opening value by 2. Closing value plus opening value by 2. What is closing value? Could be given in the question. Opening value is what you invest divided by 2. What is closing value? Closing value of asset. Closing value of asset plus opening value of asset. I invested 1 lakh in a mobile phone. Denominator can be 1 lakh or denominator can be closing value of mobile plus opening value of mobile divided by 2. What is closing value of mobile? Scrap value. Scrap value of the mobile. You invested 1 lakh. You got back 10,000. 1 lakh plus 10,000 by 2. 1 lakh plus 10,000 by 2. I do not have any scrap value. 1 lakh plus 0 by 2. 1 lakh plus 0 by 2. On initial investment, on average investment, on initial investment, on average investment, on initial investment, average PAT by initial investment, on average investment, average PAT by average investment. What is investment? Opening plus closing by 2 or as it is opening investment. What is closing investment? Salvage value. Not given, 0. I can't help it. I can't help it. So accounting rate of return is the only technique which is based on profits, because accounting Your financial accounting is bothered more about your profits and less bothered about cash flow. So we prepare cash flow statement, but more bothered about the profits. Any doubts on this? Any doubts on this? Only technique which is based on profits, which is based on profit. So first I have to calculate average profit. What is average profit? Every year profit divided by the number of years. How will I get profit? You may write this formula in the side. PAT is equal to cash flow minus depreciation. PAT is equal to cash flow minus depreciation. The logic is PAT plus depreciation is cash flow. Hence, PAT is equal to cash flow minus depreciation. You can write this in the side. PAT plus depreciation is CFAT. PAT is equal to CFAT minus depreciation. Minus depreciation. CFAT minus depreciation. CFAT minus depreciation. Clear? Can we proceed? I'll go back to the question we are doing. Question has asked us to calculate accounting rate of return. I'll do it for project A. You'll do it for project B. Next, computation of ARR, whatever working note number, I think should be 4. Computation of ARR. Note 1. Computation of average PAT. Computation of average PAT. Copy paste year cash flow column. Year and cash flow column. In that, no year 0. Profit is always calculated for one full year. Year and cash flow. Year and cash flow. No year 0. Year and cash flow. Extra 2 columns. Depreciation, PAT. Year and cash flow. We repeated this cash flow year so many times. That is why I will do a single table and close everything. Which is, if I had already explained you all the technique, we would have done one table, all techniques in that single table. All techniques in the single table. Depreciation, PAT. Depreciation and PAT. Can you tell me the depreciation per year for project A? What is the original cost? 1,35,000. Any salvage value? 135 minus 0 by 5 years. 135 minus 0 by 5 years. No scrap value. In fact, they have mentioned no scrap value. 135 minus 0 divided by 5 years. How much is the depreciation? All years 27,000. Cash flow minus depreciation is PAT. Cash flow minus depreciation. 0 minus 27,000 minus 27, 3,000, 105, 57, 57, and tell me the average. Year 0 will not come in the calculation.
Can you repeat how did you find depreciation?
Okay, there's a doubt on depreciation. 1,35,000 minus 0 divided by 5 years. Cost minus salvage value divided by life. Cost is 135, salvage value 0, life is 5 years. 135 minus 0 divided by 5 years. Tell me the average of the profits. How much? 39? Okay. Any doubts on this? Any doubts on this? Can we proceed? Any doubts? Clear? ARR. ARR on initial investment. Both will give different answer. Okay. On initial investment is equal to on initial investment is equal to average PAT divided by initial investment, divided by initial investment into 100. Average PAT divided by initial investment into 100. How much is the average PAT? 39,000. What is the initial investment? 1 lakh 35,000. Every year I earn 39,000 by investing 135. Every year I earn 39,000 by investing 135. What's the number you get? This is one answer. 28.89%. Any doubts on this? Can we proceed? This is on initial investment. 28.89%. Any doubts on this? Can we proceed? ARR on average investment. ARR on average investment, average PAT divided by average investment. Again and again, I only repeat one thing: no formula by hearting. Logic is what I get back divided by what I give. I get back PAT every year, and I investment, initial investment can also be on average investment. What is average PAT? We said average investment denominator. What is the initial investment? Opening plus closing by 2. Closing is salvage value. How much is the salvage value? 0 divided by 2. 39, 67, 500 into 100. 39 by 67, 500 into 100. 57.78%. 57.78%. Any doubts on this? Able to understand this fairly simple, straightforward calculation? Please do for project B. I give you around 3-4 minutes. Do it for project B. We'll discuss after you're done. 3-4 minutes for you. Coming to project B. Depreciation will be 48,000. 2 lakh 40 divided by 5 years. PAT number will be 60 minus 48,000, 12, 36, 48, 54, 42. Average of that is 38,400. Your ARR is 38,400 divided by 2 lakh 40. Another ARR is 38,400 divided by half of 2 lakh 40. Half of 2 lakh 40. The two answers are 16% and 32%. Any doubts on this? Any doubts on this part? Clear? With this, the fifth technique is also over. And this technique, again, I would want higher the better. Payback alone, lower the better. Accounting rate of return is also higher the better. 5 techniques we have done. IRR technique is something we have to discuss. Any doubts on this? Any doubts on this? Now, question wanted us to ultimately tabulate the result and then say which is better. We are going to now tabulate the result and then finally say which project is better. Any doubts till this? Next, selection of project. Selection of project. Selection of project. Particulars. 4 columns totally. A, B and choice. A, B and choice. A, B and choice. Payback. I give you first 2 3 minutes. What I want you to do is payback, write the value of A, B. Discounted payback, write the value of A and B. ARR, write the value. ARR on initial, average, everything you write the two values, and then I'll discuss. So some 2 3 minutes for you. Note down all the values there. 2 3 minutes for you. So these will be your numbers which you have only calculated. Payback. Question would have given some target payback. What is a target payback? 3 years. So first thing is I have to check whether the projects are below 3 years. If they are below 3 years, both are below 3 years, three are below, whichever has lower payback, whichever has lower. Assuming you get answers 4 and 5 years, choice both rejected. Both rejected. If it's 4 and 5 years is your answer and 3 is the target payback, both will get rejected. Just give me a minute. Okay. In case you get 4 and 5 years, both will get rejected. But here both are okay. But between A and B, A is better. So choice is A. Choice is A, lower payback. There will be a target discounted payback given in the question. How much? 4 years. B is rejected. B is rejected. So I don't have anything to choose here. B is rejected. B doesn't serve any purpose. A is the project I'll select. A is the project I'll select. B is rejected because 4 years is the cutoff. Assuming 3 years was the cutoff, discounted payback, both will get rejected. Both will get rejected. If 3 years is the cutoff, both will get rejected. First, you meet the target. After you meet the target, if both are good, we will choose. NPV, positive NPV is needed, no target and all. Is project A positive? Project B? Both are good. Whichever has higher positive NPV, go ahead with that. Which one has higher? A. PI has to be greater than 1. Has to be greater than 1. Is project A greater than 1? Project B greater than 1? Whichever is better. Whichever is better. Which one? A. ARR on initial investment, there can be a target given in the question. If given, I'll use that. If not, we'll see. Is there any target given? Any target ARR? Not given, leave it. If they give a target saying that 40% on initial investment, both will get rejected. 40% on initial investment, both will get rejected. Payback lower than target, discounted payback lower than target, ARR greater than the target. ARR is a return metric, PI is a return metric, NPV is a return metric, payback and discounted payback is time metric. Lower the better, others are higher the better. So in this case, again A and again A. Finally, I'll go ahead and select project A. Sometimes you will see some preferring A, some preferring B. What to be done, you will understand as we proceed in the chapter. So in this question, both all the techniques are preferring project A. We will go ahead with project A. We will go ahead with project A. Any doubts on this? Any doubts on this part? Clear? Understood till this? This was a simple question to start with where we have gone through all the techniques, all the technique. Overall, it has taken me 1+ hours. But if I had done it is with a single table, we will be able to complete the entire calculation. Maybe one project will take me 10 minutes, another project will take us 10 minutes. Any doubts on this? Any doubts on this? With this, this question is over. I don't want to do the another question, so we will end with this. We'll continue in the next session. Just go through all the techniques again. Go through all the techniques. We'll end with this. Question 4 is technically a homework question. I'll be doing a small part of it in the class. Balance part you will do it at home. Okay. Let's go through the question. Lockwood Limited wants to replace its old machine with a new automatic machine. Two models A and B are available at the same cost of 5 lakh each. Salvage value of the old machine is 1 lakh. Utility of the existing machine can be used if the company purchases A. Additional cost of utilities 1 lakh. If the company purchases B, all utilities will have to be replaced with the new utility costing 2 lakh. Salvage value 0.20. Year project A, project B and PVF 1 to 5 and extra salvage value at the end of year 5. Targeted return is 15%. You are required to calculate net present value, discounted payback period, desirability factor. What is desirability factor? Profitability index. Profitability index. First, go through the question. Okay, we are required to calculate some of the techniques here: NPV, discounted payback, desirability factor. For NPV, tell me what are the columns needed. I want participation. Year, cash flow, PVF, DCF. That's all. Discounted payback, what columns needed? Year, I'll repeat, cash flow repeated, PVF repeated, DCF repeated, and an extra column called CDCF. Desirability factor, already columns are there. So we will have to do 5 columns: year, cash flow, PVF, DCF, CDCF. I'm going to do that and write year and cash flow alone. Balance you do at home. You want to complete. Even if you don't complete, also doesn't make any difference because no major learning will be there. Working note 1, computation table. Computation table. Project A. Year cash flow. Year cash flow. PVF at some rate would have been given in the question. DCF, CDCF. I want a return of 15%. Technically, the cost of capital is 15%. Year 0. Year 0, 1, 2, 3, 4, 5. Year 0. Okay. How much I have to pay for machine A? 5 lakhs. But that's not the only cash flow. I have to pay 5 lakh. I will receive 1 lakh by selling the old machine. I'll pay 5 lakhs. I will sell the old machine, get 1 lakh inflow. Get 1 lakh inflow. Buy the new machine for 5 lakh. Sell the old one for 1 lakh. Also, I have to buy some utilities which is worth 1 lakh. I have to buy some utilities which are worth 1 lakh. This is machine A. If you do model B, buy for 5 lakh, sell for 1 lakh, also pay 2 lakh for utility and sell your old utility for 20,000. Sell your old utility for 20,000. The initial outflow is obviously different for model A and model B. So come down, initial outflow. Initial outflow equal to negative 5 lakh. This is purchase price. Negative because it's outflow for us. Negative 5 lakh. I'll buy the model. I have to sell the old machine. Sell the old machine. How much do we get by selling the old machine? 1 lakh plus 1 lakh in bracket salvage value. This is inflow plus 1 lakh. On top of it, we are going to use, we have to buy some utility. How much is the utility purchase? Negative 1 lakh. Negative 1 lakh. Outflows are negative, inflows are positive. All put together, how much? Negative 5 lakh. Negative 5 lakh. Negative 5 lakh. Any doubts on this? Focus is on cash flow only. Get the cash flow correctly, problem is over. Negative 5 lakh. Year 0, negative 5 lakh. Clear? Year 1, they have given the cash flow in the question. They have given the cash flow in the question. The cash flows are expected to be year 1, how much? 1 lakh. Year 2, 1 lakh 50. Year 3, 1 lakh 80. Year 4, 2 lakh. Year 5, 1 lakh 70 plus another 50,000. Salvage value will also come in year 5. 1 lakh 70, like we purchase initially outflow. Once the project is over, some salvage value may come. How much? 2 lakh 20. That's all. We are not doing anything beyond this, okay? At home, you complete the table, calculate everything. This is for your practice. Any doubts on this? Machine B also, I'm not discussing anything. You would have understood how to calculate cash flow. Any doubts in this? Any doubts in the question? Can we proceed? Okay. There's a small concept called payback reciprocal. What is payback reciprocal is reciprocal of the payback period. Reciprocal of the payback period. Now let's understand this and then I give the formula. Initial investment is 20,000. It will give me annual cash inflow of 4,000. Useful life is 10 years. Compute payback reciprocal. I invest 20,000 in a project. Every year I get 4,000. First year I get 4,000. Second year become 8,000. Third year become 12,000. Fourth year become 16,000. Fifth year become 20,000. In 5 years I recover the money. 20,000 is my investment. 4,000 is my recovery. To put it simply, payback is investment by the annual cash inflow. Investment by the same number. Investment by the annual cash inflow. 20,000 divided by 4,000. Payback reciprocal is exact inverse. Annual cash inflow divided by the investment. And reciprocal means reciprocal of the payback period. What is payback here? 20,000 divided by 4,000. What is payback reciprocal? 4,000 divided by 20,000 into 100 to express in percentage. Into 100 to express in percentage. Now, right, payback reciprocal is equal to, don't understand the formula, understand the logic. 20,000 by 4,000 is the payback. Inverse of that is annual cash flow, annual cash flow divided by investment into 100. Annual cash flow divided by investment into 100. Divided by investment into 100. 4,000 divided by 20,000 into 100. How much is this? This is indirectly also called as the return from the project. It's not ARR, but it is indirectly return. If you are recovering your money in 2 years, it means 50-50% you recover every year. You recover 50% in first year, 50% in second year. You recover something in 5 years, 20% in first year, 20% in second year, 20 in third, 20 in fourth, 20 in five. That's what is the answer here. Any doubts in this? Clear? 6 and 7 is for your practice. Basically, very simple question. Just do practice at home. Okay, I move to the next technique which we did not discuss in the previous session, which is your internal rate of return, IRR technique. We have used this term at many places, but now you will learn this technique. Now, what is IRR technique? Let's understand it. I invested year 0, 10,000. I invested 10,000. Year 1, I got back 14,000. I invested 10,000. I got back 14,000. Project is over. Any idea how much return have I earned in this? What is the return I earned in this project? Ignore IRR concept and all. What is the return earned in this project? You invested 10,000, got back 14,000 in 1 year. How much did we earn in this project? 4,000 rupees. Can you give me a percentage for that 4,000 rupees? 40%. I earned 40%. IRR is 40%. IRR is 40%. But this is just year 0 calculation. You will have to see differently. But IRR is 40%. Now, what is IRR is? A discount rate at which this is 10,000. This 14,000 present value should become 10,000. The present value should become 10,000. You invested 14,000. No, its present value. Its present value should become 10,000. This is year cash flow PVF DCF. PVF and DCF. What is IRR is the discount rate at which your outflow is equal to your inflow. Present value. Present value. The outflow is equal to inflow. Does it mean that the reality the discount rate is 40%? No, it is just for the purpose of IRR calculation. What is the discount rate we use for NPV calculation? Cost of capital. NPV purpose we use cost of capital. But if you want to do IRR calculation, you are trying to find out a discount rate at which the inflow matches the outflow. Inflow matches the outflow. For example, I do PVF at 40%. PVF at 40%. This is 1. Can you do 1 divided by 1.4? 0.7143. To avoid rounding off, I've written 4 decimal. Do 14,000 into 0.7143. 10,000. Clear? Which means IRR is 40%. Which means IRR is 40%. Is this the only way to calculate IRR? No, there are multiple ways to calculate IRR, but IRR in this example is 40%. What I want is the inflow total should match the outflow total. Or to put it simply, DCF total should be 0. DCF total should be 0. If the DCF total is 0, NPV is 0. NPV is 0. Does that mean real NPV is 0? No. The real NPV will be calculated. For example, in this question, they ask you to calculate NPV. For NPV, we will do PVF at 12%. Maybe 12% is the discount rate. For calculating real NPV, you have to use the real discount rate. For calculating real NPV, we have to use the real discount rate, which could be 12, 15, 18, 20, whatever the question gives. Can you do 1 divided by 1.12? 0.893. 4 decimal, 3 decimal is fine. That time I just wanted to prove it. 14,000 into 0.893. The real NPV is 2502. Real discount rate is 12%. The real NPV is 2502. Real discount rate is 12%. That is the actual NPV and actual discount rate. If you want to do IRR calculation, you are trying to find at what discount rate will you get 0 NPV. Students confuse saying that are we earning 0 NPV? No, don't confuse yourself with 0 NPV. We are just trying to find out a discount rate at which the inflow will match outflow. Is this done in some other way? Yes, we have already done this in some other way. A is equal to P into 1 plus R power N. A is the future value, 14,000. P is the present value, 10,000 into 1 plus R power 1. You will get R as 40%. 1 plus R power 1, 40%. 1 plus R power 1, 40%. Is this the formula for IRR? Yes, this is the formula for IRR. The only challenge I have is when you have one cash flow, you can do this. But year 1 there is a number, year 2 there is a number, year 3 there is a number, year 4 there is a number. For example, year cash flow. Year 0, 40,000. Year 1, 25. Year 2, 30,000. 25 and 30,000. What I am trying to technically find is at what discount rate? At what discount rate will both be equal? Technically, A is equal to P into 1 plus R power N. A is equal to P into 1 plus R power N. A is, there is a 25,000 cash flow, there's a 30,000 cash flow. So very difficult to use this formula. There's a single cash flow, I can use it. You have two cash flow. There's a 25,000 also, there is a 30,000 also. And I also have 40,000 today. I also have 40,000 today. So I can say A divided by 1 plus r power n is equal to p. P is single number. P is single number. What is a single number? 40,000. A is first year 25,000, you discounted to today. Second year 30,000, you discounted to today, and ensure that it becomes 40,000. Formula cannot handle it. Formula cannot handle it. One cash flow, one inflow, one outflow, formula can handle. Can I do it in Excel? Yes, I can do it in Excel and give you the answer. In Excel, I can give you the answer, but you cannot handle with the formula. In Excel, with the formula also, I can get the answer. Basically, we are trying to find out what is the R. R is rate of return. R is rate of return. Here, R is 40%. If you go ahead and discount it at 40%, inflow will be equal to outflow and NPV will be 0. Many students confuse, are we earning 0 NPV? No, we are not earning 0 NPV. If NPV is 0, does that mean we don't earn anything? No, that is also not the concept. We are just trying to find out what discount rate will give 0 NPV, and that discount rate is the return earned by the project. That discount rate is the return earned by the project. Internal rate of return, return earned by the company. This is the discount rate at which NPV of the cash flow is 0. At which NPV of the cash flow is 0. Any doubts in this? You do some calculation and you get an NPV positive. You get a NPV positive. For example, 12%. I got positive NPV. It means IRR is more than 12%. It means IRR is more than 12. I want 0 number. I got a positive answer. I got a positive answer. IRR is greater than 12%. Let me do PVF at 50%. PVF at 50% and a DCF column. PVF at 50% and a DCF column. Year 1. Can you tell me 1 divided by 1.5? 0.667. Multiply 14,000. Multiply 14,000. 9,000. This will obviously give me a negative answer. Negative answer, which is, so concept says this. You get a positive NPV, IRR is greater than 12%. You get a negative NPV, IRR is less than 50% because we used 50%. 0, IRR is equal to discount rate. IRR is equal to discount rate. And when we were doing that YTM approach, I used to tell you that I need one positive NPV, one negative NPV. And if we get exactly 0, that is the IRR. Exactly 0, that is the IRR. Getting exact 0 is very, very difficult. Getting exact 0 is next to kind of impossible most of the scenario. But if we get exact 0, we get to the answer. We get to the answer. How are we going to get to the answer? I'll have to write year, cash flow. Year and cash flow. No changes in that. You'll have to work with year, cash flow, then a PVF and a DCF column. One calculation will give you one NPV. If you get positive NPV, if you get positive NPV, you need to work towards getting a negative NPV. And if you get a negative NPV, you need to work towards getting a positive NPV. And if you get 0 NPV, best, nothing to be done. If I get 0 NPV, problem gets over that time. Problem gets over that time. Now, in order to get this answer, I have to start with some discount rate. I have to start with some discount rate. What can an exam question do is, it can give me something like this and say calculate IRR. If I have a table like this, what I will do, I will try one of the rate, maybe 14, 16, 18, any one rate. I got positive NPV, I will try another rate. I got negative NPV, I'll try another rate. If something like this is given in the exam table, most of the question they will give it. If they give it, no headache, no headache. Just start with one of the rate and you have to revise the rate. How to revise and all, I'll explain. But I will start with one of the rate from the table. Maybe safer side, I'll try 16% in between number. Then one of them I will increase, decrease and get one positive and one negative NPV. Objective is to get one positive and one negative NPV. In case they do not give, then you have to do a calculation called ARR on average investment. ARR on average investment. You have to do this calculation in the calculator because ICI material does not talk about this. I talk about this because what rate to start with. If they give the rate, okay. If they don't give the rate, randomly you keep trying. You may not get one positive and one negative because objective is to get one positive and one negative. Randomly you keep trying rates, then you will not get one positive and one negative. So concept is start with an initial guess rate. What will be the guess rate? 2 by 3. 2 by 3 of ARR on average investment. Is there any logic on this? No logic and all. Historically, any question I have done, if ARR on average investment is 20%, IRR would be very close to two-thirds of that. IRR would be very close to two-thirds of that number. Will it happen all the question? No, may not happen. May not happen. Just as a procedure, we are doing it. How will you do this? Mostly in the calculator. Mostly in the calculator. You got the rate. You calculated NPV. You calculated it. If you get a positive NPV, increase the discount rate. Because as you increase the discount rate, positive value will become negative. As you increase the 12, we got positive. 40, we got 0. 50, we got negative. So I will start with one discount rate. I get positive NPV. Increase the discount rate. You get negative NPV. Reduce the discount rate. Reduce the discount rate. Once one positive and one negative is done, this is the formula. I will be explaining it with a timeline approach also and the formula also now. We had used it earlier, but I'll be explaining. I have explained the timeline approach earlier, but formula I'll explain with the question. Clear? Shortcut for computation of IRR: one outflow, one inflow. Future value is equal to present value into 1 plus R power n. One outflow, one inflow. And if there is a perpetuity, which is a rare question, if there's a perpetuity, you will have to use the formula of perpetuity. What is the formula? Present value of perpetuity is equal to perpetuity amount divided by rate of interest minus growth rate. Rate of interest is the answer. Rate of what we are trying to find is at what R P A is equal to P into 1 plus R power n, that equation will hold good. Will that equation hold good at 10%, 11%, 12%, 13%, 14%, 15% is what we are trying to calculate. We are trying to calculate at what discount rate A is equal to P into 1 plus R power n. That R is what we are calculating. R is what we are calculating, and that R is called IRR. That R is called IRR. Clear? Any doubts on this? So I will start with some random rate. How do I start with the random rate is what we will see in a question. Once you start with the rate, you get positive NPV, increase the rate. You get negative NPV, reduce the rate. One positive, one negative. Then there is a formula or a timeline approach. Both I'll be explaining with one example, one question. Let's see a question so that you understand it. Question 8, part D of that question. Okay, 8D, ABC we'll see later. 8D. Find the IRR of a project whose cash flow is year 0, 1, 2, 3. Negative 1000, 450, 425, 400. Clear? Question D, 8D. They have given the cash flow in the question. They have given the cash flow in the question. Any problem where they give you cash flow is just waste of time. Why it is waste of time is no application of brain there. You have the cash flow. If I give you year cash flow for the earlier 5 technique, you will add a PVF column, you will add a DCF column, you will add a CDCF column, you will add a CCF column. There's zero application. You just need to keep adding and keep calculating. You know the procedure once, there's nothing. The tricky part is always year and cash flow. For example, we did one question some time back. When we did that, the initial outflow was little bit of a calculation. Unless that calculation is asked in the question, it is just a formality. So this is a formality question. They have given the year and cash flow. We have to calculate IRR. Let's do working note 1, computation of IRR. Computation of IRR. Have space for 8 columns. We will open 4 columns. I'll get up, listen, I've been telling this, but students don't follow it properly, then you get stuck. Year cash flow, PVF, DCF, 1 NPV. If I get a positive, I may try another one, another PVF DCF column. Okay, if I get again positive, I may try another one till I get one positive, one negative. 8 columns will ensure that you can do 3 times NPV calculation. You can do 3 times NPV. In this also, you don't get one positive, one negative. Open another working note. Otherwise, what will happen? Year and cash flow, you'll have to keep repeating. So instead of repeating year and cash flow every time, we will have 8 columns, open 4. You get 0 directly, problem over. You get positive, another 2 columns. You got negative, with 6 columns it is over. With 6 columns it is over. Most of our solution will have 6 columns. One positive, one negative will immediately come. In case it does not come, another 2 columns will be needed. Worst case, 8 columns, one positive, one negative will 100% come. Worst case, we may do more also. Now open 4 columns: year, cash flow, PVF, DCF. Have space for 8 columns. I may not open 8 columns, but have space: year, cash flow, PVF, DCF. Year 0, what is the cash flow? -1,000. -1,000. Year 1, 450. Year 2, 425. Year 3, 400. Any doubts in this? Any doubts in this? Clear? Okay. Leave some space and come down. ARR on average investment. This is not needed in exam, okay? You can do it in your calculator also. ARR on average investment is equal to ARR on average investment is equal to average investment is the denominator. What is the initial investment here? 1,000. Average is 1,000 plus 0 by 2. 1,000 plus 0 by 2. Denominator is 1,000 plus 0 by 2. Now listen. Ignore accounting and all, okay? If somebody asks me what is the profit out of this project, profit is 450 plus 425 plus 400 minus 1,000. Minus 1,000. Ignoring the concept of accounting and all that. You ignore all that. What is the profit of the project? 450 plus 425 plus 400 minus 1,000. Minus 1,000. That is the total profit. You have to divide by 3 years. So profit is, numerator is 450 plus 425 plus 400 minus 1,000. Assuming you do this calculation and you get it wrong, doesn't matter. That's why I don't want you to present it also. Divide this by 3 years. This is the average profit. This is the average profit. Average profit is 450, 425, 400 minus 1,000. Minus 1,000. Divide by 3 and tell me the average profit. Sorry? 0.67 divided by 500 into 100. Not mandatory for you to present this in your notebook. I wouldn't want you to do it in exam 100%. Most of the time, need will also not be there to do this step because they may give the table below. Tell me what is the ARR number? 18.33. Initial guess rate. Initial guess rate 18.33 into 2 by 3. No logic for 2 by 3, no logic for why ARR and all. But this will ensure that we get quickly one positive, one negative NPV. 18.33 into 2 by 3. 12.22 rounded off to 12%. We will start with 12. Can I start with 13? Go ahead, you do anything, doesn't really matter. Now I did all this step, no? For example, if the question was like this, 14, 15, 16, 17, 18, don't do the table. Don't do this calculation. Don't do this calculation, initial guess rate and all. Directly start with one of the rates there. Something like this they give 12, 11, 10, 9. Start with one of the rate. Start with one of the rate. No need to do all this computation and all. Okay. Now coming back, we are going to start with 12%. So go to the table, PVF at 12%, DCF. Numbers are small. DCF we will keep it as 2 decimal. Okay. Normally I don't do any decimal in DCF. We normally do it in lakhs and all. Here the numbers are in hundreds. So we will keep 2 decimal. PVF at 12%. 1 divided by 1.12, 0.893, 797, 712. DCF 1000, 450 into 0.893, 401.85, 338.73, 284.8. Tell me the total of that. The total is called NPV. That's all. We are not going to do inflow minus outflow and all. Directly the total will give you the NPV. The total of DCF will give you the NPV. No formula, nothing. Total of DCF. That's all. Positive, negative is auto adjusted there. How much you got? 25.38. I am searching for a number 0, but I got 25.38. That's okay. Any doubts on this? Any doubts on 25.38? Now we will increase the rate. How much can I increase? We try to have a lower gap between the two rates. If you have a very high gap, the accuracy of IRR goes down. But I don't want to go with 1% alone, because 1% may again still give me another positive NPV. So I normally do 2-3% gap. So let's do 14%. Can I do 15? Yes, 15 is also okay. Beyond that, I wouldn't prefer. Very high gap will lead to inaccuracy in answer. PVF at 14%. DCF. If this gives negative NPV, problem is over. If it doesn't give, then PVF at 16%. One 0.877, 769, 675. Objective is to get exact 0, but that is difficult for us to do. Tell me the values. 1000. Second one is on what value? 394.65, then 326.83, then 270. What's the total? Negative, positive? Negative. Okay. Then we are done. We got negative answer. We will now get to the IRR. We got negative answer. IRR will automatically come now. If I had got positive answer, I'll be stuck. Negative will give me the answer. Any doubts in this? It's a very simple technique. We are just trying to find out at what discount rate will we get 0 NPV. Any doubts in this? The same question may ask you NPV also, and for that they'll give a discount rate 10%. NPV will be at 10% only. NPV will be at 10% discount rate, because that is the real discount rate and real NPV. Any doubts in this? Now come down. First let's do a timeline approach, which I had explained earlier in that other chapter. 12%, 25.38. 14%, negative 8.52, 12, 25.38, 14, negative 8.52. Difference in we are first looking at the difference in the NPV. Tell me the difference in NPV. 33.9. From positive it goes to negative. 25 minus of minus 8.52. Difference in discount rate 2%. Clear? Any doubts on this? 2% change in discount rate is equal to 2% change in discount rate is equal to 33.90 change in NPV. 2% change in discount rate changes the NPV by 33.90. I wanted somewhere here where I'll get a 0 NPV. Somewhere here I'll get a 0 NPV. So from 25 I wanted 0. I want NPV to change only by 25. But NPV has changed by 33.90. Question mark. Change in discount rate is equal to 25.38 change in NPV. 25.38 change in NPV. Question mark change in discount rate. We have to do a cross multiplication. 2% equal to 33.90. Question mark equal to 25.38. Tell me this question mark number. Cross multiplication. 2% equal to 33.90. 25.38 is how much? Cross multiplication is nothing but 25.38 into 2 divided by 33.9. How much? 1 point? Okay, 1.5. Any doubts on 1.5? Any doubts on 1.5? Clear? I'll get to the IRR answer in a minute. Any doubts on this? Now, I told you to do 12, make it 14. But ideally, I should have made 12 as 13.5. 1.5% only I should have increased it. But I will not know that 1.5% is to be increased. That is why we tried 14. This is not needed, just for your understanding. I add another 2 columns. This is not needed for you to write. PVF at, if at all I was very clear that it has to be 13.5, I cannot tell this. I tried 12, I told increase it by 2%, whereas I should have told you to increase it only by 1.5%. But I cannot tell that it will be 1.5, 1, 2, I don't know. So we tried 12 and 14, but that was a wrong thing. You should have tried 12 and 13.5. You need not do 13.5 in your notebook. In exam also not needed. This is just for your understanding. Tell me the values. 1 divided by 1.135. 0.8, sorry, 881, 881, okay, 881, then 776, then 684, okay. 1 divided by 1.135, 881, 776 and 684. DCF 1000. No need to write, please don't write this. 450 into 881, 396.45, 425 into 776, 329.80, 400 into 0.684, 273.60. If I add this, you get negative 0.15, which is 0 only, which is for all practical purpose 0 only. I was trying to find where will I get 0. 0 will be at 13.5%. 0 will be at 13.5%. Any doubts in this? Now you wrote this 1.5%. Now write IRR is equal to lower rate plus change, needed change, plus needed change. Lower rate was 12% and you should have changed it by 1.5%. You should have changed it by 1.5%. Lower rate plus the needed change, which is 13.5%. 13.5%. Any doubts in this? Any doubts in this? Clear? Okay, there's another formula also. Formula, it's your wish. You want to do it in a formula way. Same thing. 12 plus. How did you get this 1.5? Tell me the backup calculation for this 1.5. 25.38 into 2 divided by 33.9. Listen for some time. 25.38 into 2 divided by 33.9. This ICI converted into a formula. They converted this into a formula. What is the formula? L1. L1 is lower rate. L1 means L1 is lower rate. NPV at L1. NPV at 12%. NPV at 12%. They converted this into a formula. NPV at L1. L1 is lower rate divided by NPV at L1 minus NPV at L2. 25.38 minus of minus the other number, you will get 33.9. 25.38 minus of minus of minus, you will get the other number into L2 minus L1. They converted this into a formula. I'll explain the formula. Formula is nothing but 12 plus 1.5. Formula is nothing but 12 plus 1.5. 12 is called L1, lower rate. How you got 1.5? 25.38 into 2 divided by 33.9. What is 25.38? NPV at L1. What is 33.9? NPV at L1 minus NPV at L2. 25.38 minus of minus. What is the 2%? L2 minus L1. L2 minus L1. To put it very simply, L1 plus NPV at L1 divided by change in NPV multiplied with change in rate. Multiplied with the change in rate, which is what is given as a formula there. I did not explain the formula earlier also. And when I was explaining this, L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. Somebody comfortable with the formula? Do it. Not comfortable with the formula? Do the timeline approach. Do the timeline. Timeline not mandatory. If you are comfortable with the formula, do the formula way. If you are comfortable with the timeline approach, do the timeline. Now write formula. Formula L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1 into L2 minus L1. L1 is lower rate. We'll write the calculation also. Equal to 12% plus 12% plus NPV at L1 12% plus. How much was the NPV at L1? 25.38 divided by 25.38 minus of minus of minus of minus is how much? 8.52 into 14 minus 12. 14 minus 12. L2 minus L1. 12% plus 12% plus 12% plus divided by how much? 1 point. You will get 25.38 divided by 33.9 into 2, 12%. This is, or you can write without percentage. Finally, you can add a percentage. 13.5%. Any doubts on this? Any doubts on this? We are trying to find a discount rate which will ensure that inflow is equal to outflow. Which will ensure that inflow is equal to outflow. Any doubts on this? Any doubts on the concept here? Clear? Can we proceed? Done. I give you a minute or two. Go through the calculation. Go through the concept. Let me know if there are doubts. 1 minute for you. Okay, let's come to question 11. Somewhere this will help us in revising the techniques. Following is the data available on a capital project being evaluated by the management of X Limited. Particulars: Project M, annual cost saving 1 lakh rupee, useful life 4 years, IRR 12%, profitability index 1.064, NPV, COC, COP, payback, and salvage value. Find the missing value considering the following table of discount factor: 12, 11, 10, 9. Year 1, year 2, year 3, year 4, and total is called annuity factor. The total is the annuity factor. PVAF is also given and the individual values are also given. Go through the question. Okay. The question has said the life of the project is 4 years. Every year we save 1 lakh rupee, which means we earn 1 lakh rupee extra. If you save money, indirectly it will increase your profit and cash flow. So year 0, I don't know what is the investment. 1 to 4 years I learn 1 lakh. 1 to 4 I learn 1 lakh, and at the end of year 4 there is a salvage value. How much is the salvage value? 0. Working note 1, cash flow structure. This will not be fully there, but we'll write it whatever is available. Cash flow structure. Year cash flow. Year 0, we don't know. It's question mark as of now. Objective is to get the cash flow correctly. Year 0, we don't know. 1 to 4. 1 to 4, 1 lakh. 1 to 4 is 1 lakh. Year 4, 0. Okay. Now let's see what is the information they're given. They have given IRR in the question. IRR is the rate of return at which NPV of the project is 0. At which NPV of the project is 0. Does that mean NPV is 0? No, nothing like that. It is just the rate of return at which NPV is going to be 0. Now come down. Working note 2. Computation of cost of project, cost of capital, and NPV. Cost of project, cost of capital, and NPV. Have space for 6 to 8 columns. Okay, mostly 6 columns, but you have space. Year cash flow, PVF at IRR. What is IRR rate given in the question? 12%. DCF. Extra columns we'll see later. PVF at 12%, DCF. Clear? Year 0, I don't know. The question mark. It is a question mark. I have no idea what is the year 0 investment. 1 to 4 years. How much it is? 1 lakh. No need to write year 4 again. It's 0 only. 1 to 4, 1 lakh. 1 to 4 is 1 lakh. NPV is 0. For 12%, look at the question. Look at the question and tell me the annuity factor. Look at the question and tell me the annuity factor. Please follow that, because if you do on your own, sometimes some 0.037, 0.038, some difference can come. So follow whatever question gives. 3.038, 3,03,800. Clear? Now reverse working. This has to be negative 303,800. This has to be negative 303,800. Outflow equal to inflow. Negative 303,800. PVF is 1 and reverse working negative 303,800. Negative 303,800. Reverse working. Reverse working negative 303,800. This does not mean NPV is 0. Okay. NPV is not 0. Cost of project I have calculated. Any doubts on this? Cost of project is 3,03,800. Any doubts on this? Can we proceed? Okay. Now I have used all of this. There's a profitability index given. Profitability index given. PI formula is present value of inflow divided by present value of outflow. Inflow and outflow present value should be calculated at the cost of capital, not at 12%. 12% is the IRR. If you do at 12%, PV of inflow 303,800, PV of outflow 303,800, you will get one time. You will get one time. Whereas the question has given how much? PI is how much? Now write PI is equal to PI is equal to PV of inflow divided by PV of outflow. Inflow divided by PV of outflow. 1.064 is equal to, okay, now listen, the cost of capital or the real discount rate can be 11, can be 10, can be 9, I don't know. Listen for a minute. If I do PVF at 11, just for an imaginary sake, no need to write. No need to write. This will remain 1. This will remain 303,800. This number from 3.038 will change to 3.103 and this will change to 3,10,300. If you make it 12, again, sorry, 10, it change. 9, it will change. But what will not change is this. What will not change is this. So to put it very simply, PV of outflow is 303,800. That is sure. Inflow, I don't know. Inflow is not 303,800. Inflow, you did it at 12%. 12% is not the discount rate. 12% is the IRR rate. Is the IRR rate. You cannot say PV of inflow is 303,800 in this question because that was calculated at 12%. If you say 303,800 divided by 303,800, you will get one time only. You will get one time only. Able to understand this? Now, right, 1.064 is equal to, I don't know this number, divided by 303,800. Tell me that PV of inflow number. Tell me the PV of inflow number. Outflow is 303,800. How much? 323, 243 point. Okay, 243. 323, 243. Any doubts on this? This is the real present value. This is the real present value, and this is what I should use for NPV calculation. This is what I should use for NPV calculation. Any doubts on 323, 423? Any doubts on this number? Can we proceed? Clear? Now write here PVF at actual discount rate, or you can say at cost of capital. At cost of capital, PVF at cost of capital and DCF. PVF at cost of capital. I don't know the cost of capital as of now. Okay, PVF at cost of capital, DCF. Any doubts on this? This is 1. 303,800. This is 323,243. This is the real present value. 323,243. 323,243. Tell me the total of this. How much? 19,443. NPV is 19,443 because NPV has to be calculated at the cost of capital. NPV has to be calculated at the cost of capital. You cannot calculate NPV at the IRR rate. If you calculate, I'll give you the answer directly 0. If you calculate it at the IRR rate, answer is directly 0. This PV of balancing figure 323,243 divided by 1 lakh. 323,243 divided by 1 lakh. 3 decimal should do. 3.232. At 12% we started with a 0 NPV. At 12% we started with a 0 NPV, got the outflow, used PI, got the present value of inflow. Now below the table, right? NPV equal to 19,443. NPV equal to 19,443. Any doubts on this? Look at the table given there. See 3.232. Where are you getting? 9%. It's 3.239. That's rounding off difference. Okay. 3.239. 3.239. That whatever gap you see is rounding off difference here. So from PVAF tables, PVAF of 3.232 correspond to 4 years and 9%. 4 years and 9%. Hence, cost of capital is 9%. Cost of capital is 9%. Cost of capital is 9%. Your cost of capital can only be calculated at the, sorry, your NPV can only be calculated at the cost of capital. So PVF at IRR 12% and PVF at cost of capital, which is technically 9%, which is technically 9%. At 9% only you can do NPV calculation. At 9% only you can do NPV calculation, you can do PI calculation. PI, if you want, at 9% you look at 323,243 divided by 309, 303,800. At 12% you can never calculate NPV and you cannot also calculate PI. NPV you need not calculate. I'll tell you at IRR it will be 0. PI also you don't calculate. At IRR PI will be one time because inflow will be equal to outflow. Any doubts on this? Clear? Almost done. What is the other requirement there? Payback. I give you 3 minutes. Year cash flow, cumulative cash flow. Separately, no annuity. You cannot write it as annuity. Okay. Payback, do the calculation. Year cash flow, cumulative cash flow. 3 minutes for you. Only payback, not discounted payback. Okay. Normal payback. 3 minutes. Start doing it. It'll be year cash flow, cumulative cash flow. You start with negative 303,800. Then it becomes negative 203,800, negative 103,800, negative 3,800, and then you get a positive value. 3 plus 3,800 divided by 1 lakh. 3 plus 3,800 divided by 1 lakh. Negative, again negative, again negative, again negative, then 3,800 divided by 1 lakh, divided by 1 lakh, and you will get to the answer. Any doubts on this? Any doubts on this part? Clear? Can we proceed? With this, my discussion on the basics are over. All the 6 techniques we have discussed, the base is set now. I give you 2 minutes, go through all the concepts, then we will do now advanced question. Please go through all the concepts. Question 12 is homework for you. Go through all concepts. Okay, now we are going to go through the advanced concepts, because most of the question cash flows will not be given directly, and our work would be to calculate cash flow. Let's first understand what can a capital budgeting project do. A capital budgeting project can have two purposes. One is called revenue enhancement, second is called cost reduction. Bharadwaj Institute buys a new building and lets it out on rent. Lets it out on rent. If I buy a new building and let it out on rent, it will increase my revenue and increase my profit. It will increase my revenue, increase my profit. Increase in revenue is equal to increase in profit, an inflow item. An inflow item. Same Bharadwaj Institute bought a building, but instead of letting it out on rent, we vacate this building and go to that building. We vacate this building and go to that building. What it does? It saves us rental expense. It saves our rental expense. Either it can increase my credit side or decrease my debit side. Either a capital budgeting or both can also happen. Both can also happen. Either you increase the revenue or reduce the expense. Both are considered as an inflow in the profit calculation. Both are. If you reduce cost, it is an inflow item. If you reduce cost, it is an inflow item. Cost reduction, reduction in cost, both will improve profit. Both will improve profit. If somebody says my expenses went down, natural answer is profits went up. Profits went up. If profits are going up, cash flow automatically goes up. So in our computation, if there is a cost saving, it is an inflow. That is what we saw in the last question we just did, annual cost saving. If there is a cost saving, it is an inflow. It is an inflow. Similarly, if there is an extra revenue, that is also inflow. Two purposes are there for a capital budgeting project. Sometimes both can also be done. A small example. A company presently incurs a cost of 2 per ton to dispose 1 lakh tons of waste. Some waste is getting created. I spend 2 rupees per ton to dispose 1 lakh tons of waste. It has found an alternative approach to process the waste, enabling it to sell the waste at 20 per ton. But to sell it at 20 per ton, I have to incur how much? 15 per ton. What is the annual cash flow to be considered in the evaluation of the project? Now listen, I have been creating some waste in my manufacturing process. Earlier, I was selling this waste, or I was disposing this waste by paying 2 rupees. By paying 2 rupees. Moment I process this waste, first thing is I will save this 2 lakh. I will save this 2 lakh because I was paying 2 rupees to process the waste. This 2 lakh is an inflow for me. This 2 lakh is an inflow. I save. Incur a cost of 2 per ton to dispose. Now no need to dispose. No need to dispose. So 2 into 1 lakh. 2 into 1 lakh is a saving. Is a saving. Along with that, I earn extra 20 minus 15. 20 minus 15. So I earn 5 rupees from selling the waste, and I earn 2 rupees from saving on the disposal cost. Selling the waste gives me 5 rupee, 20 minus 15, and 2 rupees saving is there. Overall, I earn 7 rupees. I earn 7. 7 into 1 lakh, 7 lakh is the inflow. 7 into 1 lakh, 7 lakh is the inflow. There is a cost saving of 2 lakh, and there is a revenue increase. Revenue means net of expenses of 5 lakh. Any doubts on the concept here? Clear? Now, these are the steps we are going to follow to calculate the cash flow. Till now, every question directly given to you. Now onwards, you will see the challenges. So, what are the steps? First thing is, there will be an initial outflow in any project we do. What is initial outflow? I want to set up a project in Chennai. To set up a project in Chennai, I want to buy land. I want to construct building. I want to buy some plant and machinery. Along with that, I may buy some raw material. I may need some cash for operation. I may have to give credit to debtor. So there are two things which will be there as initial outflow: capital expenditure and working capital. Capital expenditure and working capital. Any project I do, there will be an initial outflow called as capital expenditure and working capital. This is my day zero outflow. Day zero, we call it as day zero, and we will write it as negative. Then every project during the year will earn me something. It will earn, how is it calculated? We'll see in a minute. Every project, as you do the project, you will earn some money out of it. That is the purpose of doing the project. I constructed a land building, 500 crores I incurred. Every year it gives me 100 crore cash flow, 100 crore, 200 crore. How is calculated? We'll see. Then there will be a terminal flow. What is terminal flow? Is one time cash flow. One time cash flow. What is one time cash flow? For the capital expenditure, you will get salvage value. For the capital expenditure, you will get salvage value, but we call it as NSV. NSV is net salvage value. What is the difference? You'll understand. And working capital, whatever money was stuck, will come back to us now, because I don't need inventory. I would have sold all the inventory. I don't need any cash in the project, so I would have taken the cash out. I need not give any credit. Now all debtors money would have been collected. So day one, some money will get stuck. Same money will come back unless question says otherwise. Same money will come back. Day one capital expenditure 500 crores, but what will come back is 5 crores only. Salvage value will obviously be lesser than your capital expenditure. Day one capital expenditure 500 crores. Salvage value could be 10-15 crores. Day one working capital 5 crore. Year 8 5 crore may come back unless the question says otherwise. Clear? Any doubts on this? So I do a project. I have to spend on capital expenditure. I have to spend on working capital. During the project, I will earn something out of the project, and once the project is over, I will sell all machinery, land, building, plant, machinery, everything is sold, and I get net salvage value. I get net salvage value. Whatever working capital is there, I sell inventory, collect money from debtors, use the available cash, pay to the creditor, everything I do, and I have recapture of working capital. This is my initial outflow format. Capital expenditure, working capital, total outflow. In bracket indicates outflow. Okay. This is how we calculate in between cash flow. Now, what is in between cash flow? I start with revenue. I start with revenue. The word there is very clear. Incremental revenue. What is incremental is Bharadwaj Institute is planning another branch. Another branch. Now, because of the branch, our sales earlier was 5 crore, has now become 8 crore. Has now become 8 crore. Capital budgeting says that you cannot say revenue is 8 crore. You only can say extra revenue is 3 crore. Because of the project, what did happen? Because of the project, what did we extra earn or extra spent? Extra earning because of the project. I cannot say that I constructed a new building or I took a new branch and our revenue is entire 8 crore. That 8 crore is not logical. That branch gives how much extra? That branch gives how much extra? So if you have any data in the question, they'll say earlier so much sales, now so much sales, find out the difference. No data is there rightfully. Incremental revenue, incremental cost saving. Any cost saving you do, these are inflow. If you see something in bracket, that is outflow. All cost other than depreciation. You can also deduct depreciation also if you want. Okay, I normally do it a 2 layer, but I can deduct depreciation also. If you deduct depreciation also, you will get profit before tax. If you don't deduct depreciation, you will get PBDT and then deduct depreciation. Then deduct depreciation. Can I do both of them together? Go ahead and do, no problem. Go ahead and do, no problem. You can say, when I say all costs other than depreciation, will be underlined below that. Raw material cost, labor cost, overhead cost, rent cost, maintenance cost, salaries cost. One of the cost is depreciation. One of the cost is depreciation. You can deduct all. You can deduct all and directly call PBT. Most of the question I'll directly write PBT. Otherwise, you can write PBDT, then deduct depreciation and get PBT. Both ways are okay. From PBT, we deduct tax, we get PAT, add back depreciation, cash flow after tax. This format we have seen some time back, but there are some more adjustments here. You get cash flow after tax. Any doubts till cash flow after tax? Any doubts on cash flow after tax? After this, sometimes this in between cash flow could be for year 1, year 2, year 3, year 4, year 5, year 6, can be for many number of years. I did this calculation. Sometimes non P&L items can come. What is non P&L item? I did not pay for the machine fully. I purchased a machine because we are focused on cash flow. I purchased a machine for 500 crores. I paid 200 crores only. Only 200 crores will come here. Only 200 crores will come here. Extra 300, where will it come? Either in year 1 or year 2 or year 3 or year 4 or year 5. Whenever you paid. So one item is payment for original machine. Payment for original machine. Why not above PAT? This is not a P&L item. This is a balance sheet item. This will not impact my profit and loss account. Till CFAT, all are P&L item. All are P&L item. After CFAT, there are some balance sheet item and you get revised CFAT. You get revised CFAT. Any doubts on this? What are the items? You may pay for the original machine. Sometimes you may purchase some additional machine. Sometimes there can be an increase in working capital. What is increase in working capital? I need more inventory, so outflow of money. I need more debtor, outflow of money. You can just see inventory is easy to understand. I need more inventory. I buy, I don't consume it. If you consume, it will form part of P&L. If you don't consume it, it is a balance sheet item. Increase in inventory is an outflow of money. Rare scenario, decrease in inventory. If there is a decrease in inventory, it is an inflow of money for me. I'll explain all the four again. After CFAT is calculated, payment for original machine. What is payment for original machine? 500 crores machine. Year 0, 200 crores. Year 1, another 100 crore. Year 2, another 100 crore. Year 3, another 100. Write 100 in 1, 2, 1, 3 and write 200 in year 0. Right? 200 in year 0. Any doubts on this? Any doubts on the second? After buying a 500 crore machine, in the third year, I bought another 100 crore machine. Please write that, because you cannot write it above CFAT. Depreciation on that can go above. Depreciation on that additional machine can go above. Inventory increased, outflow of money. Inventory decreased, inflow of money. Inventory is working capital. There are other working capital also. Debtor is there, creditor is there. All of that will come. Then terminal flow. Terminal flow is you will get back the capital expenditure in the form of net salvage value and recapture of working capital. This is inflow. Wherever you see bracket, those are outflow. Without brackets are inflow. Any doubts in this? I'll repeat again. I have three types of cash flow. One is initial outflow, where you will have a capital expenditure and a working capital. Capital expenditure could be land, building, plant, machinery. Working capital could be inventory, debtor, creditor, cash, outstanding expenses, prepaid expenses, anything they give. Current asset minus current liability. Once I get that amount, this is my initial outflow. I use the land, building, plant, machinery to manufacture product, earn revenue. After earning revenue, I incur expenses like raw material, labor. So all revenues, if any cost saving is there, deduct all your costs. Deduct all costs related to that project only. Don't bring in any other cost. Okay, we have opened another branch. I don't teach in that branch. My salary cannot be considered there. My salary only in this branch. If I don't teach in that other place, my salary cannot go there. All cost other than depreciation, PBDT, deduct depreciation, PBT, deduct tax, PAT, add back depreciation, CFAT, four balance sheet item. Payment for original machine, purchase of additional machine, increase in working capital less. Only item which is added is decrease in working capital. Decrease in working capital, you get revised cash flow, and then you calculate terminal flow, where there is an item called net salvage value. What is net salvage value? You will understand. And there is a recapture of working capital. Any doubts on this? This you have to do. I still give you a minute, nothing much, but still go through this. A minute for you to go through this concept 9. 1 minute. Okay. A small example. The first example we have already seen in that question. ABC Limited is considering replacement of an outdated machine, which will have a price tag of 5 lakh. Existing machine 1 lakh salvage value. All utilities will be replaced with a new one costing 2 lakh rupees. and the old utility will be sold for 20,000. We did see this in that one question, so I'm not discussing this question. Company acquired a new machine with a total cost of 10 lakh. Initial 80% of the cost was paid upfront, and the remaining 20% was paid at the end of first year. Additionally, there were installation cost amounting to 2 lakh. Machine has a salvage value of 1 lakh and lifespan is 5 years. How much is the year zero outflow and annual depreciation? Tell me, how much do we pay for the machine on year zero? In year zero, how much today? Today, how much we pay for the machine? 8 lakh. 8 lakh plus we also incur 2 lakh installation cost. We also incur 2 lakh installation cost. I assume entire installation cost I pay. There also, if there is a choice of 80-20, then I don't know. That's an assumption based area. Okay, 8 lakh for the machine. The person has to come and install it. Is the same person coming or someone else coming and installing? I don't know. Installation, there will be cost. You buy a AC, there will be an installation cost. So installation cost is how much? 2 lakh. As per your accounting, this 2 lakh will also be capitalized with the cost of the asset. Okay, 8 lakh rupee for the machine, 2 lakh rupee for the installation cost, assuming this is fully paid. Okay, so my initial outflow is how much? 10 lakh. Initial outflow is 10 lakh. 8 lakh for the machine, 8 lakh for the machine, 2 lakh for the installation cost. Can you tell me what is the depreciation I'll charge? Annual depreciation. How much? First question. I did not make full payment. Can I claim depreciation? You'll have to participate. Accounting point. I did not make the payment. Can I claim depreciation? Very much. There's no link between payment and the depreciation. You need not pay even 1 rupee also. Still you can claim depreciation. So my cost of the asset is 10 plus 2. 10 plus 2. 2 is also part of the cost. 12 lakh minus 1 lakh. 12 lakh minus 1 lakh divided by 5 years. So installation cost fully paid. Installation cost is fully paid and initial outflow is 80% of the cost and full installation cost. Can I take an alternate assumption? Possible. I don't know. See, you buy a AC from me and I will only do the installation. AC is 40,000, installation 5,000. I tell you that you pay me 80% of 40,000 and full 5,000. Or I tell you pay me 80% of 45,000. It depends on how we negotiated. Any doubts on the first concept? Okay. Now, for cash flow calculation, there are certain rules which we need to be aware of. Without these rules, it will become difficult for us to do the question. First rule is depreciation. Depreciation is a non-cash item, still relevant because of the tax benefit. How is it relevant? We do PBDT, deduct depreciation, PBT, deduct tax, PAT, add back depreciation. When can it become irrelevant? If the company has tax exemption. Our question say income tax is to be ignored. If income tax is to be ignored in this format, stop at PBDT. Stop at PBDT. Don't deduct depreciation. Tax is not there. Don't add back depreciation. PBDT will be called as CFAT, and then those 4 balance sheet item can come. But PBDT will be called as what? CFAT, or you can say cash flow. After tax word should not come, cash flow. PBDT will be called as cash flow. Reason is, anyway, tax is not there. Why should I deduct depreciation and add it again? Why should I deduct and add it again? Clear? But if taxes are there, deduct depreciation and add back depreciation. Clear? Any doubts on the first point? Any doubts on the first point? Second, opportunity cost. Let's first understand with an example what is opportunity cost. Now, I plan to do a project. Okay, I'm now evaluating the cash flow of the project. Okay, I wrote revenues 10 crore. Revenues is 10 crore, and I had a lot of expenses, 8 crore, everything. This project, I am doing it in my own building. I'm doing it in my own building. My own building, I am going to use it for the project. Will I pay any rent to my own building? No, that is obvious. Will financial accounting allow me to record any rent? I am the proprietor. No, no consider partnership from anything. Can I pay rent to my own myself and record it? No, we cannot record it. What? Costing as well as FM says. Costing as well as FM says is 10 crore is okay, 8 crore is okay. That building is whose building? My own building. That building earlier was giving me 1 crore rental income. That building was giving me 1 crore rental income earlier. That building was giving me 1 crore rental income earlier. Now what has happened is that I am using that building for myself. I don't pay any rent. I don't earn any rent. But this 1 crore is an opportunity cost. This 1 crore is an opportunity cost. Consider it as an outflow. Consider this as an outflow of the project. Cost is not 8 crore. Add a notional opportunity cost of another 1 crore. Add a notional opportunity cost. You would have learned this term called explicit cost or implicit cost when we would have done costing. There would have been a term called implicit cost or an imputed cost or an opportunity cost. Extra 1 crore will be considered as outflow. Extra 1 crore will be considered as outflow. Extra 1 crore will be considered as outflow. Clear? Any doubts in this? Another example. I am a hospital. In a hospital, patients will be told to do a CT scan or an X-ray or something. So what people were doing is they were going to a lab center. Okay, this lab center was giving me 20,000 commission to the hospital. To the hospital, it was giving a commission. To the hospital, it was giving a commission of 20,000 rupees. Now, what hospital has done is they are installing all these machine. They are installing all these machine, X-ray machine, CT scan, all machine I install in my hospital. Because of installation, I will earn revenue. Okay, but I will lose this 20,000. I will lose this 20,000. The lab center obviously will not give me any commission. This 20,000 is an opportunity cost. This 20,000 is an opportunity cost in the calculation. Able to understand the concept? What are we losing? I lost rental income of 1 crore. Opportunity cost. Assuming another example, I open my own institute. My own institute I'm opening. Revenue is there, expenses is there, but my salary is not there. Or my own institute, revenue is there, expenses is there. I was earning some 10 lakh from Bharadwaj Institute. I lose that. Consider it as an opportunity cost. Consider it as an opportunity cost. Clear? Any doubts on this? Only point here is the opportunity cost. Sometimes they will give pre-tax figure. Pre-tax figure means without tax adjustment, and sometimes they may give post-tax figure. If they have given post-tax after PAT subtracted, after the PAT is calculated, subtracted, and if they have given pre-tax, which is normal, reduce it before PBT itself. In the PBT calculation itself, do it. This is considered. Maybe just do one thing. Just make a small change. Considered before PBT computation, considered after PAT computation. After the PAT is calculated, consider it. After the PAT is calculated, consider it. And the other one is before the PBT is calculated. Before the PBT, consider that in the analysis. Before PBT, after PAT. Before PBT, after PAT. Any doubts on this item? 2-3 examples I've given. You should be able to understand it. Can we proceed? Any doubts on this? Done. Any doubts on the 2 points which I've discussed till now? Opportunity cost is not recorded in books of accounts, but recorded in cash flow calculation. Recorded in cash flow. Question will say, I lose an after tax commission of 20,000 after PAT is calculated, deduct it. I lose a commission of 20,000. Only word lose a commission, normal, before PBT. Before PBT. Any doubts on this? Okay. Next concept is called sunk cost. Okay, now let's understand. I plan to do a project. Project is going to be done in Chennai. Okay, the cost of the project is 100 crore. Cost of the project is 100 crore, huge money. So I don't want to spend this huge money initially without doing some extra research, because if I spend and the project is a failure, I will lose a lot of money. So I call a market survey person. A survey person comes to me and I tell him, can you do a market research? I will pay you 1 crore rupee for the research. I'll pay you 1 crore rupee for the research. This is an outflow which I have to pay. So this research guy came, he did research, spoke to a lot of people, understood people's perception, went to many households, understood all this, and understood whether the demand is there for the product or not. He gave me the report. Based on the report, I may decide to invest 100 crores. I may decide not to invest 100 crores also. I may decide to invest 100. I may decide not to invest also 100. Report is favorable for me. I invest 100 crores. Should I pay 1 crore to the research guy? He gave me report. Report is working for me. I have to pay 1 crore. He did all his effort. His work is perfect, okay? But report is saying project is not viable. Report is saying project is not viable. I decided not to do the project. I decided not to do the project. Should I pay 1 crore? Yes, I have to pay 1 crore. So this 1 crore is technically called as a sunk cost. What a sunk cost is, after he has done the report and given me. Now, based on the report, I will decide whether to do it or not to do it. Based on the report, I'll decide whether to do it or not to do it. In the initial outflow, 100 crore capital expenditure will come, but 1 crore research expense will not come. 1 crore research expense will not come, because I cannot tell him that I will not pay you. I will not pay you. Whether I do the project or I don't do the project, I have to pay 1 crore. I have to pay 1 crore. So moment the work is done, whether payment made, not paid, that's okay. Moment the work is done. Now it can be that I tell him that you give me first report, 1 crore I pay. Then I will say I will do the project also. I want an extra research to be done by him. For that, I have to pay another 50 lakh. That 50 lakh is relevant. You are going to pay something extra. That 50 lakh is relevant. I have no problem with that. Already report done. Another example. I am doing some R&D activity. I'm in a pharma company. I came out with a drug for some disease. Now this project, I came out with a, let's assume, a cancer drug, and this product which I have created, now I am to manufacture. For manufacture, I have to spend 2000 crores, and I've already spent some 1000 crores on R&D. Already spent some 1000 crore on R&D. Concept says you do the project, spend 2000 crore, no extra. You don't do the project, spend zero. This 1000 crore is a sunk cost. This is already done. Already done. You have already spent the research money. Now you go ahead and do the project. If you can generate at least 2000 crore, at least 2000 crore you can generate, go ahead and do the project. Don't wait for this extra 1000 also. The concept is, if you have already spent something, it is a historical cost or a sunk cost, or it is an irrelevant cost. Sunk cost or an historical cost, cost of an item which has already been incurred, whether paid or not. Example, market survey, R&D cost. Another example, I book a movie ticket, assuming cancellation option is not there. Assuming cancellation option is not there, you book a movie ticket. Before you book, the value of the ticket is 120 rupees. After you have booked the ticket, you cannot go for the movie. The worth of the ticket is zero for you. The worth of the ticket is zero for you. If somebody says, I want to buy ticket for 50 rupees from you, you should ideally go ahead and sell it for 50 rupees. Because if you cannot go for the movie, the value of the ticket will be what? Zero. You have already incurred it. Already incurred. What is incurred? The moment you paid for it, you incurred it. That's all. Whether you go for the movie or you don't go for the movie does not matter. Before, for example, a friend of mine is asking, can you get us 5 movie tickets? I'm yet to book movie ticket. I will tell him, pay me 120 plus, if at all anything extra is to be done, but 120 I will ask him. If I have to book for him, 120, I will ask him, I've already booked it. I've already booked it. I am not able to go. You are asking me for the ticket. 5 ticket. Ideally, I should sell it at 1 rupee or anything above that. 1 rupee is also technically okay. Technically, 1 rupee is also okay because the worth of the ticket is what? 0 rupees. It is a sunk cost. It is a sunk cost. All sunk cost will be ignored in our analysis. Any doubts till this? There are some more points. We'll take a break. Maybe by 10:30 we'll resume and I'll explain the balance points. Okay, let's continue with the discussion. So we have done three main points for cash flow computation. I'll quickly go through the balance ones. Just give me a minute. Okay, next point is on an area called overhead cost. Now, in costing, we have learnt that overheads will be distributed to a company, to a project on the basis of something called as an OAR. What is OAR basis is? You will do 1 per labor hour, 5 per machine hour, something like that you can do and distribute the overhead expenses. For example, Bharadwaj Institute, we are planning to take evening classes. We are planning to take evening classes. If we take evening classes, we do not incur any extra rent. Rent is not incurred by us for evening classes. But cost accounting will say that you have to distribute a part of the rent expense for evening classes. What financial management says here is, if you are apportioning, if you are distributing, if you are allocating general, all these overheads is irrelevant for the purpose of decision making. In the cash flow calculation, your apportioned, general, corporate, allocated is irrelevant. When I take evening classes, I need one more admin person. We recruit that admin person only for evening classes. The salary paid to that admin person is a specific or an incremental overhead that is relevant. The salary paid to that person is a specific expense for evening classes. It is a specific expense for evening classes that will be considered in our calculation. But whatever expenses I incur for morning classes and I do distribution, all that will be irrelevant for the purpose of decision making. Next point, which is already explained, working capital management, money required for smooth functioning of operation. Whatever you spend initially is outflow in year zero. Any increase happens, outflow in between years. In between is 1, 2, 3, 4, 5. Any decrease happens, inflow in between years, and ultimately it will come back. Ultimately it will come back. Outflow, inflow, and it will become zero. It will become zero. Any increase in working capital is outflow. Any decrease in working capital is inflow. Any doubts on this? Okay, there's another important principle called reward exclusion principle. Reward exclusion principle. Now, when we did WACC calculation, WACC was a weighted average of cost of debt, cost of equity, cost of preference. Weighted average of cost of debt, cost of equity, and cost of preference. And cost of debt is dependent on interest, cost of equity is dependent on equity dividend, cost of preference is dependent on preference dividend. What capital budgeting says that you please ignore all of these in your cash flow. Ignore interest in cash flow calculation, ignore preference dividend in cash flow calculation, ignore equity dividend in cash flow calculation. Then where is it considered? It is considered in WACC, and that WACC is the discount rate of the project. That WACC is the discount rate of the project. Every cash flow we discount it and bring it down. If you receive 1 lakh in year 1, you reduce it to 80,000, 70,000, 60,000. Whatever questions we have done, every question we do, we discount the number. Normal number is 408. Discounted number is 378, 350, 324, 300. The gap is technically interest, PD, and equity dividend. That is technically similar to interest, preference dividend, and equity dividend. Why is it similar? Because you discount it at cost of capital. You discount it at cost of capital. Reward exclusion principle: ignore reward paid for providers of capital. Whoever provides capital, capital means long term money. Whoever is providing long term money, please ignore that in the calculation. Ignore that in the calculation. What is ignored? Interest on long term loan, preference dividend, equity dividend. Where is it considered? WACC calculation. WACC calculation. In fact, it is not only interest, preference dividend, any cash flow between owner and company is to be ignored. What can be a cash flow between owner and company? Repayment of loan, not considered in the calculation, because company pays to its owner. Who is the owner? Debt holder. New loans taken, ignored in the cash flow calculation, because if you take a loan, it is inflow of money, ignored in the calculation. New loan taken, repayment of loan, equity shares issued, equity shares bought back, everything is ignored in the cash flow calculation. Any cash flow between owner and company, from one pocket you're transferring to another pocket, it is ignored in the analysis. Who's owner? Owner means equity shareholder, preference shareholder, debenture holder. So any cash flow between the owner and the company is to be ignored. So these are six important points which we need to be aware. The first point was depreciation, non-cash item, still considered in our analysis if taxes are there. Opportunity cost, cost of benefit foregone, if it is given before tax, before PBT, if it's given after tax, after PAT is calculated. Sunk cost or historical cost, it is irrelevant, already incurred. Overhead cost, apportion, general, corporate is irrelevant. Specific incremental is relevant. Working capital, money required for smooth functioning of the company. If you are contributing an initial working capital, that is outflow. Any increase in working capital, outflow, decrease in working capital, inflow, and a final recapture will happen. And any reward paid to the providers of capital is to be ignored in the cash flow calculation. Any reward paid to the providers of capital is to be ignored in the cash flow calculation. Any doubts till this? Clear? Okay, another concept called net salvage value. Let's understand what is net salvage value. We normally learn a concept called salvage value. Then what is this net salvage value? Let's understand. Now I sell a machine for 5 lakh. I give three situations for this. I sell it for 5 lakh rupees a machine after the project got over. I compare this with something called as book value. What is book value? Value as per my books of accounts after deducting depreciation. One scenario, the book value is 2 lakh. Another scenario, it is 5 lakh. Another scenario, it is 8 lakh. How will you calculate book value? Capital expenditure which you made minus depreciation, whatever you charged every year. You will charge depreciation under SLM method, WDV method, multiple things are there. Gap is either a capital gain or a capital loss. It is either a gain or a loss. This gain or loss will have some tax implication. So gain slash loss, we call it as capital gain. You will learn about this in income tax. This is technically called as capital gain. So I have a gain of 3 lakh, no gain, no loss, and here I have a loss of 3 lakh. I have a loss of 3 lakh. My books is 8 lakh rupee and I'm selling it for 5 lakh rupees only. I'm selling it for 5 lakh rupees only. There's a loss. If you have capital gain, pay tax. There will be a tax rate given in the question for capital gain for business income. Same rate also they may give. There will be a tax rate given. I have to pay 40% tax. So tax 1 lakh 20 paid 0. If you have a loss, technically we save tax. Whenever an organization has a loss, they technically save income tax. How can I save income tax? This loss can be set off against any other income of mine. A business will have multiple income, can be set off against. If Bharadwaj Institute suffers a loss from a new building, new branch we open and we suffer loss, that loss will be reduced from our existing profit and we will pay lower tax. We will pay lower tax. So if you have a loss 1,20,000, 40%, saved. What is NSV is this and this. In between items are of no use. What is NSV is 5 lakh received, 1 lakh 20 paid. 5 lakh received, 1 lakh 20 paid. NSV is 3 lakh 80. 5 lakh paid, sorry, 5 lakh received, 0 payment. NSV is 5 lakh. 5 lakh received, 1 lakh 20 also received, 1 lakh 20 also received. NSV is 6 lakh 20. Three scenario sold machine for 5 lakh, but net salvage value can be 380, can be 5 lakh, can be 620, can be 380, can be 5 lakh, can be 620. Net salvage value different from salvage value, different from salvage value. NSV is equal to sale value plus tax saved on capital loss, tax saved on capital loss minus tax paid on capital gain. Similar example I would have given and done the calculation. Clear? This is another important point. Let's see this example. An asset has an accounting book value of 1 lakh, fully depreciated for tax purpose. It can be sold for 2 lakh. How much is the net salvage value? Nothing for you to write. Can you tell me what is the sale value in this example? 2 lakh. What is the book value? Now listen, it says it has an accounting book value. You will learn all this in income tax. There is a Companies Act depreciation, there is an Income Tax Act depreciation. So accounting value is 1 lakh. But for tax purpose, it is what? Fully depreciated. So I asked the income tax guy, what is the book value? He said 0. He said 0. Because what ultimately matters is what income tax guy will see. In my books of accounts, I can have a different depreciation. In my income tax, I can have a different depreciation. Books, I can follow SLM. Income tax will be WDV. So there can be a difference and all. So book value for tax purpose is 0. Only for tax purpose. We are doing this calculation only to calculate tax paid or tax saved. Only to calculate tax paid or there will be some question which will say ignore tax on capital gain. Don't do any calculation. Ignore tax on capital gain. No need to do any calculation because the question has said ignore tax. Some question will say that taxes are to be ignored or ignore tax on capital gain. Capital profit is exempt. If they give such words, no need to do any of this calculation because income tax is not there for capital gain. Income tax is not there for capital gain. 2 lakh 0, 2 lakh is capital gain. What's the tax rate in the example? I have to pay 80,000 tax. I have to pay 80,000 tax and receive 2 lakh on sale. My NSV is 1 lakh 20. Asset originally valued at 20 lakh has lifespan of 4 years with a depreciation rate of 20% on WDV method. It is specified that there is no scrap value at the end of 4th year. No scrap value at the end of 4th year and the tax rate is 50%. How much is the net salvage value? You will write this along with me. Let's do this. Right, particulars and amount. Particulars and amount. Sale value. Sale value. Sale value. It's a very good example. Read the question, tell me what is the sale value. It is specified that there is no scrap value. That's okay, 0 then. But there can be a book value. There can be a book value. Sale value 0. Less book value. Note 1. Leave some 5 lines, come down. Note 1. Computation of book value. Particulars in 4 years. Particulars in 4 years. I'll explain why this and all. Particulars in 4 years. Opening balance. less depreciation, closing balance. I'll explain this. You first write opening balance, less depreciation, closing balance. What is the cost of the machine we purchased? 20 lakh. Life is 4 years. Depreciation what? 20%. Which method? WDV. SLM means I can calculate 1 year depreciation. Same for second year. Same for third year. Same for fourth year. Very easy to do. WDV is little tricky. Now write opening balance 20 lakh. Opening balance 20 lakh. When I purchased it initially, it is 20 lakh balance. What is the WDV rate? They've said 20%. 20% of 20 lakh. 4 lakh. Clear? Closing becomes 16. Listen, if it was SLM method, no need to do all this because next year 16 opening, 4 again 12, 12 4 again 8, 8 4 again 4. If it is SLM, every year 4 lakh, 20 lakh minus 4 times of 4 lakh. SLM is very easy to do. 4 times of 4 lakh. But here now write 16. Tell me 20%. 3 lakh 20, 1280. 1280. 1280. 20% of 1280. How much? 256. Tell me the value. 1024. 20%. 204. How much is this? 8 lakh. Any doubts on this? In my books of accounts, the value is 819,200. This is how we calculate book value. After 4 years of depreciation. After 4 years of depreciation, the value is how much? 819,200. Any doubts on this? Any doubts on this? Write this. 819,200. Capital loss. Obviously, it is a loss because sale value is 0, books has a value. Capital loss. Entire amount is a capital loss. Entire amount is a capital loss. Sale value 0, book value is 819, 200. Entire value is a loss. How much is the loss? 819, 200. Tax saved. What is the rate they've given? At 50%. Tax saved at 50%. 4 lakh. Leave a line. NSV. It's not a continuation. What is NSV? Sale value plus tax saved minus tax paid plus tax saved minus it's not a continuation. Some student write it as continuously and they make a mistake. Okay, it is sale value plus tax saved or minus tax paid. Sale value is how much? 0. Tax saved 409,600. 409,600. That is the NSV. Sale value 0, but still there is an NSV. Still there is an NSV. Any doubts on the example? And this will also explain how you do book value calculation. If the question was SLM, 20 lakh, first year 4 lakh, if they give 20%, second year 4 lakh, third year 4 lakh, fourth year 4 lakh, book value left over is 4 lakh after 4 years of depreciation. Or if they tell you to calculate, we may calculate as 5 lakh. 20 minus 5 minus 5 minus 5 minus 5, it may become 0 also. It may become 0 also. Any doubts on this example? Okay, the last concept which I teach, we do problem and there are few more concepts, but this is not another concept. Treatment of losses. Like I explained capital loss scenario, now we are going to see treatment of losses. When you make loss at the PBT level, when you do your cash flow calculation, year 1 you make a loss or a year 2 you make a loss at the PBT. What is PBT? Sales, all cost, PBDT, deduct depreciation, PBT. Now, under income tax, multiple scenarios are possible. First scenario is I am an existing profit making company. Example, Bharadwaj Institute. We have branch 1, profit is there in this branch. I open another branch, loss making branch. This loss can be set off against this profit. This loss can be set off against the profit. So if I'm a profit making company, I will get tax saving in the year of loss. Tax saving in the year of loss. When we do our computation, we normally do PBT less tax. In case of loss, tax will be added. It is an income for us. Tax will be like a income for us because we are going to save taxes. We are going to save taxes. Many a times, losses in the practical world, there are scenarios where a profit making company may buy a sick company with only one objective. They want to use their losses and reduce it from their future profits. They will have a lot of losses reported in their books of accounts. Under income tax, some companies acquire another company. Their losses will be set off against these profits depending on whatever the rules income tax is. So if you are an existing profit making company, immediate tax saving. Loss has a benefit. Profit has one disadvantage. Disadvantage is if you make profit, you have to pay tax. Like that, loss has one benefit. What is the benefit? If you make a loss, you save income tax. You save income tax. Sometimes they will say loss has to be carry forward. Loss has to be carry forward. This is what income tax allows. It says something called a set off and carry forward of losses. You will learn all of this in your income tax. Okay, set off and carry forward of losses. Either you can set off immediately. For setting off immediately, I need some profits. Profit itself is not there. Then you carry it forward and set it off against future profit. So what will happen is when you do carry forward, in future you will pay lesser tax. You will not get any tax saving now, but in future you have to pay 50,000, you will pay only 20,000. In future you will pay a lower tax. No carry forward, no detail of existing profit in the question. You will not get any benefit itself. No set off, no carry forward. No set off, no carry forward. I'll explain that second with an example that you'll understand it better. What is first is existing profit making company. In the calculation, tax is a positive item. In the calculation, tax is a positive item. No carry forward, no set off. Tax is zero. That's all. Ignore it. Tax is zero. This situation, following is taken from income statement of a company. Year 1, 80,000 loss. Year 2, 50,000 profit. Year 3, 1 lakh 20 profit. Year 4, 1 lakh 10 profit. Tax rate 30%. Loss will be set off from the profit of subsequent 2 years. How much is the PAT of year 3? You will write along with me particulars and 4 years, right? Particulars and 4 years. Particulars and 4 years. Profit before tax, less tax, profit after tax. PBT, less tax, PAT. Negative 80, 50, 120, 110. I'll explain all the three scenarios. The second scenario is what is relevant here. I'll explain all the three scenarios. First scenario is immediate tax saving. This is first scenario. First scenario means you are a profit making company. Okay, immediate tax saving. What is the tax rate given in the question? 30%. 30%. What is 30% of 80,000? 24,000. Listen, normally you pay tax. How do you pay tax? See here, negative 15, negative 36, negative 33. 30% of profit. This year alone plus 24,000. Immediate tax saving. This is situation 1, which is not what is there in the question. Okay, question is something else. Okay, plus 24,000. So right, immediate tax saving plus 24,000. Immediate tax saving means plus 24,000. You will get the benefit immediately. This is possible if you have an existing profit making company. What does income tax do is it reduces profit as well as it reduces losses. It reduces profit as well it reduces loss. Tell me the PAT number now. Negative 56, negative 56, 35, 84, 77. This will not be the answer to the MCQ, okay? That is something else. Immediate tax saving. Clear? Any doubts on this? Situation 3 you need not write, but I'm just showing you. Situation 3 is no carry forward, no set off, no carry forward, and you are not an existing profit making company. Very simple. 0 minus 80 and that's all. 0 and minus 80. If you cannot claim immediate benefit, you cannot claim later benefit. 0 and negative 80. 0 and negative 80. No benefit of that loss. No benefit of that loss. Not even now, not even in future. Any doubts on this? This is situation 3. Next, right? Carry forward and set off, which is what the question has said. Carry forward and set off. Carry forward and set off. PBT less tax PAT. PBT less tax PAT. Negative 80, positive 50, 120 and 110. Okay, now listen. What is carry forward is year 1, no payment of tax, no saving of tax. No payment, no saving, but some benefit will come in future. No carry forward, no set off scenario means nothing will be there. In this case, year 1 write 0, negative 80. Year 1 0, negative 80. Understand all the 3 scenarios properly. Year 2, what is the profit? 50,000. How much loss was there earlier? Participate, guys. How much loss was there? 80,000. So I tell income tax, I made a profit of 50. I had a loss of 80. From that 80, you take 50,000 rupees. You take 50,000 rupees and make my profit as 0. Make my profit as 0. Income tax, what will happen is that 80,000 which was there, no, you carry it to the year 2. Year 2, your profit now is negative 30 technically. After your 80,000 is adjusted, you are at negative 30. You are at negative 30. Year 2, no tax payment. No tax payment. Year 2, no tax payment. I adjust that 80,000, part of it, not fully, okay? Part of 80,000 I adjusted. Part of 80,000 I adjusted. 80,000 was the loss. 80,000 was the loss. I carry it forward and part of that 80,000 we adjust it. Any doubts on this? Any doubts on this? How much still loss is there? I want participation, guys. How much loss is there? 30,000. Third year, how much profit? 1,20,000. Income tax said pay one on 120. I told them I will not pay on 120. I'll pay on 90,000. What is 90,000? After adjusting my 30,000. So year 3, 90,000 into 0.3. 90,000 into 0.3. I'll pay on 90,000. I will pay on 90,000. How much is this? 27,000 deducted. How much is packed? Sorry? My profit remains 120 only. But in income tax, I'll pay tax only on 90,000. My profit remains first year loss 80, income tax at 0. No, we are not bothered about you. Second year profit 50, income tax again said 0. We don't want to charge you anything. So my PBT and PAT remains same. Third year 120, income tax guys told me to pay on 90,000. Fourth year I have to pay on the entire amount 33,000. Fourth year pay on entire amount. because no losses there carry forward, no carry forward losses there. Anyway, you will understand this in income tax, but it's not a very tricky concept at all. Concept is very clear. Whenever you have a loss, please carry forward that loss and set it off in future. Or if you're an existing profit making company, three scenario: existing profit making company, immediate tax saving in the year of loss. Loss carry forward and set off in future, less tax payment in future. Year 2, no tax paid. Whereas immediate tax saving, year 1 you save tax, year 2, year 3, year 4 we paid tax. Here year 1 I did not save tax, year 2 I have saved tax, 15,000 became 0. Year 3 also I have saved tax, year 2 and year 3 I have saved the tax. That is called set off and carry forward. Set off and carry forward. Any doubts on this? Any doubts on the concept? Clear? Able to understand this? Okay, with this, my main concept discussion is over. I give you some time. Concept 9 till 12, 4 minutes. Please go through full 9 to 12, and then I will start doing questions. Okay, let's come to question 13. X Limited, an existing profit making company. Existing profit making company. Very important word. Existing profit means immediate tax saving. Is planning to introduce a new product with a life for 8 years. Initial equipment will cost 120 lakh. Additional equipment will cost 10 lakh at the beginning of the third year. At the beginning of the third year, I'll have to buy another equipment. At the end of 8 years, original equipment will have resale value equivalent to the cost of removal, but the additional equipment would be sold for 1 lakh. Working capital 15 lakh will be needed. 100% capacity of the plant is 4 lakh units. Capacity utilization, advertisement expenditure, selling price is 100, PV ratio is 60%, fixed cost is 16 lakh. Advertisement expenditure will be as per the above table. 50% tax, SLM method, 12% is WACC, after tax cost of capital, should the project be accepted. Go through this, then I'll start explaining it. You go through this once. Okay, let's see this. It's an existing profit making company. It wants to do a new product with a life of 8 years. Initial equipment will cost me 120 lakh, which is a year 0 outflow, and an additional equipment will be purchased for 10 lakh rupees, which is at the beginning of third year. Original equipment will have some resale value, additional equipment will have some resale value. Working capital, full capacity is 4 lakh unit. This is the units sold. Selling price is given in the question. Some PV ratio is given. Fixed cost is given. Advertisement cost is given. They are asking, should the project be accepted or not? If nothing is mentioned in the question, we calculate NPV. We calculate NPV. NPV positive, go ahead. NPV negative, reject the project. But to calculate NPV, I need to do in between. Step 1, initial outflow. Step 2, in between flow. Step 3, terminal flow. Those 3 steps we have to do. Let's start with step 1, initial outflow. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow, particulars and amount. Right hand side corner in lakhs. We'll solve the problem in lakhs. Particulars amount in lakhs. We'll go step by step. Very simple question. This is capital expenditure. Some amount we incur in year 0. Year 0 means today. What is the initial equipment cost? 120 lakh. Negative 120. Negative 120. Capital expenditure negative 120. There is an additional equipment purchase, but that is an in between cash flow. That is an in between cash flow. Working capital. Some money stuck in working capital also. Working capital will be 15 lakh needed. They have not mentioned when and all. So year zero. Initially itself, I will need 15 lakh. Negative 15. Initial outflow. Negative 135. Negative 135. What we are trying to do is, can we recover this 135 with the 8-year cash flow or not? If we can recover, then project will have positive NPV. Now, whatever questions you did before all of this number was given directly to you, saying that this is the outflow, this is the inflow. Working note 2, in between flow. In between flow. How many years is the life of the project? Particulars and 8 columns. Particulars and 8 columns. You can club some columns. I'll explain that later. Year 1, year 2, 3, 4, 5, 6, 7, 8. Particulars and 8 years. Units sold. We'll multiply this with selling price, that will give us revenue. Units sold. Units sold. We are doing the problem in lakhs, okay? Units sold. What is the full capacity of the plant? 4 lakh. Full capacity is 4 lakh. In that, 20% I utilize in the first year, which means I sell 20% of 4 lakh. Production is equal to sales. No opening, closing stock and all will not come. 4 lakh into 20% I sell. Second year, 4 lakh into 30%. Third year, 4 lakh into 75. Fourth year also 75. Fifth year also 75. Sixth year 50. Seventh year 50. Eighth year 50. Next time when I do this question, I'll club 3 to 5 together, 6 to 8 together. You will understand as we proceed. Capacity utilization. 4 units sold is 4 lakh into 20%. 0.80. 4 lakh into 20%. 4 into 20%. 0.80. 4 into 30%. 1.20. 4 lakh into 20%, 4 lakh into 30%, 4 lakh into 75%, 3 lakh, 50%, 2 lakh, 4 lakh into 20, 30, 75, 75, 75, 50, 50, 50. Clear? What is the selling price given in the question? Multiply with 100. Revenues 80, 120, 300, 300. Multiply with 100. Units into 100. 100 rupees is the selling price. Units into 100. Units into 100. Okay. Now, a question can have revenue, can have cost saving, can have both. Revenue is there, no cost saving here, no cost saving information. Revenue is there. After revenue is returned, tell me what are the expenses question has given. A lot of expenses are there. What are the expenses given in the question? You'll have to be louder. I'm not able to hear it. Sorry. Okay, less fixed cost. Less fixed cost. Guys, you'll have to be louder. Less fixed cost. How much is the fixed cost? Minus 16. Minus 16. Minus 16. Less fixed cost minus 16. Any other cost? You guys please be louder. What is next cost? Advertisement. Advertisement. It's given in the table 30, 15, 10, 10, 10, 4, 4, 4. Any other expense? Louder, louder, louder. Variable cost. There's a variable cost. They've said PV ratio is how much? Which means variable cost is 40%. Variable cost is 40%, less variable cost. 40% of sales. 30% of sales. 32, 8, 120, 80, 80, and 80. Variable cost 40% of sales. Variable cost is 40% of sales. Clear? Done? Can you proceed? Variable cost is over. Next, is there any other expense given in the question? Any other expense? No. I will deduct depreciation also and call it as PBT. I can write PBDT if I want now. I'll directly write PBT. Less depreciation of two depreciations are there. Depreciation of original machine. Depreciation of original machine. Original machine. There is one additional machine we buy. Depreciation on that also is to be considered. Original machine, what is the purchase price? 120. Purchase price is 120. Some salvage values there are not. Original machine. Original machine salvage value. Original equipment will have resale value equivalent to the, what this means is, I want to sell some car. I'll get 5,000 rupees from sale of car. And to deliver that car, I'll have to incur 5,000 rupees. I have to give the car to the other person. So technically my resale value is zero. I don't get anything. If I'm getting, I want to demolish a building. For demolition, I will incur something, and whatever I demolish, that may give me some 20-30,000. And demolition, I incur 30,000. Net, I don't earn anything. So salvage value is zero. Salvage value is zero for the original machine. 120 minus zero. Original machine has a life of 8 years. Original machine has a life of 8 years. 120 minus 0 by 8. How much? 15. Negative 15. Less depreciation of additional machine. We buy one extra machine also. Depreciation of additional machine. Of additional machine. We buy an extra machine, on that depreciation is there. Additional machine. On that depreciation is there. What is the cost of the additional machine? 10 lakh. Any resale value? Salvage value is 1 lakh. Additional equipment will be sold for 1 lakh. Will be sold for 1 lakh. How many years is the life of that additional machine? Original 8 years. When are we buying additional machine? Beginning of third year. Can I charge depreciation in the third year? Participate. Yes, because I bought it at beginning of third year. If I bought it at end of third year, I can't charge. So third year, fourth year, fifth, sixth, seventh, eighth. 6 years life. 6 years life. Not applicable. Not applicable. 1.5. 1.5. Clear? If you don't subtract depreciation and calculate, that is called PBDT. And if you subtract depreciation and calculate, that is directly called PBT. Any doubts on this? Tell me the numbers. Profit before tax. Do subtraction and tell me the numbers. Profit before tax. Year 1, 2, The third year you calculate, fourth, fifth the same, sixth year you calculate, seventh, eighth the same. $80 minus 16 minus 30 minus 32 minus 15. How much is the PBT year one? Negative 13. Next one, 26. Next one, 137.5. Same for 3 years. You will later understand that I could have clubbed the columns together also, but that's okay. 137.5, 80. Now, now all questions were very, very simple. They were giving cash flow. Now we have to do this and then come to the calculation. Any doubts on this? Less for the tax rate given. Tax at 50%. Profit after tax. Profit after tax. First line of the question says what? It is a existing profit making company. If you are a profit making company, on this 13, save 50% tax. Save 50% tax plus 6.5. Plus, the plus word is not needed, but just to focus on that, we are going to add it. Plus 6.5. We are saving 50% tax. Balance is simple. Minus 13 minus, you can tell me the numbers. Minus 13, balance is subtraction only. Minus 68.75, 41.75, balance is just subtraction. In this question, tax will reduce loss as well as reduce profit. Everything will be reduced. Minus 6.5, 13, 68.75, 41.75. Clear? Any doubts on this? We are a tax profit making company. We are a profit making company. Any doubts on this? Can you proceed? Any doubts on the calculation here? Add depreciation. We will write as one line item only, no two separate line item. Add depreciation 15, 15, 16.5. 16.5. Add depreciation 15, 15, 16.5 for the next 6 years. Any doubts on this? Can we proceed? Any doubts on this? 4 balance sheet item can come. First balance sheet item is payment for original machine. What was the cost of the original machine? I want participation, guys. When I ask you a question, I want everyone to talk. 120 lakh, and that 120 lakh is paid in year 0 itself. Leave it. Any additional machine we purchased? Which year? Third year, right? Less. Purchase of additional machine. Purchase of additional machine. Purchase of additional machine. How much? 10 lakh, right? Purchase of additional machine. Any doubts on this? Any increase in working capital, decrease in working capital in the question? Any increase, decrease given in the question? No, no increase, no decrease. CF80. CF80. Purchase I've written minus, okay, it's an outflow. Give me the numbers. 8.5, 28, sorry, 68.75 plus 16.5 minus 10, 75.25, 85.25, 85.25, 58.25. Any doubts on this? Any doubts on this? Okay. I purposefully done one mistake here. I'll rectify the mistake. You rectify with a different pen so that you understand it and don't make that mistake. I have not even explained that, but I still made a mistake. It said 10 lakh machine is purchased when? Beginning of third year. As far as capital budgeting is concerned, we consider all cash flow to happen at the end of the year. To happen at the end of the year. So there's nothing like beginning of third year. Beginning of third year is end of second year. So this will go to second year. It is end of second year. Beginning of third year. Beginning of third year is January 1, 2025, which is same as December 31, 2024. Which is same as December 31, 2024. What is year zero? Year zero is nothing but beginning of year one. There's nothing like year zero. What is year zero? Beginning of year one. Beginning of year one. When you start, you on the day one you buy something. We used to call it as year zero. That's not year zero. That is beginning of year one. That is beginning of year one. So there's nothing like beginning of year three. Please correct it with a different pen and make it to second year. Minus 10 in the second year. And you can write beginning of year 3 is equal to end of year 2. End of year 2. Beginning of year 3 is equal to end of year 2. Third year start is the second year end. Capital budgeting assumes every cash flow to happen. That is why it's not I bought it in the third year. I bought it in the second year and claim depreciation from third year onwards. If you buy it in the third year, you cannot claim depreciation in the third year. So capital budgeting assumes everything will happen at the end of the year. Beginning of year 3 is end of year 2. End of year 2. I purposely made that mistake. Now you correct it and tell me the figures. This is 18. Clear? This is step 2. Step 2 is done where we have to calculate cash flow for every year. This was again given readily to us in most of the question. Can we proceed? Okay. So we have till now done these two steps. Initial outflow, in between cash flow, inflow during the project. Initial outflow, capital expenditure, working capital. In between cash flow, this format we have followed for 8 years. For 8 years. Any doubts on this? Next, terminal flow. Working note 3. Terminal flow. Terminal flow. Particulars and amount. Terminal flow, particulars and amount. Net salvage value in bracket note 1. Recapture of working capital. Recapture of working capital. What is recapture of working capital? Is whatever money was stuck in working capital on day 0. Something was stuck in day 0, it will come back now. How much money was stuck on day 0 in working capital? There it was negative 15, here it is positive 15. Positive 15. Negative 15, here it is positive 15. Clear? Note 1. Computation of NSV. Particulars and 2 column. Original and additional. There are 2 machine. Original and additional. Original and additional. Original machine I have to do NSV. Additional machine also I have to do NSV. Sale value, book value. First let's capture these, and based on that you may have a capital gain or a capital loss. Sale value, book value. Sale value and book value. What is the sale value of the original machine after 8 years? Participate. How much? Zero. Additional machine? 1 lakh. Zero and 1 lakh. Now, what is book value? Understand this way again very clearly. What was the cost of the machine? 120. Original machine, what was the depreciation you provided? It's there in your working note too. 15 lakh. 120 minus 15 into 8 years. 120 minus 15 lakh for 8 years. 15 lakh for 8 years. 120 minus 15 lakh for 8 years. Book value is also 0. Book value is also 0. Not mandatory, sale and book has to match. This question it will match. Many question it doesn't match. 120 minus 15 into 8. Clear? 120 minus 15 into 8. New machine 10 into. What is the additional machine depreciation? How many years? 6 years only. 1.5 into 6. 1.5 into third year, fourth year, fifth year, sixth year, seventh and eighth. Tell me what is the book value? 1. This question, no capital gain, no capital loss. No capital gain, no capital loss. Some other question you will have 100%. Capital gain 0. Tax paid 0. NSV 0. Capital gain 0. Tax paid 0. NSV 0. Any doubts on this? Clear? Capital gain 0. Tax paid 0. NSV 0. Any doubts in this? Again, I've done a mistake. Tell me what is the mistake? You should tell this. This I've already taught you. I've already taught you this. What is the mistake I've done? NSV is not a continuation. NSV is sale value plus or minus tax. This is 0, but this is 1. This is 1. Because sale value is 1, tax is 0. Many students take it in a hurry in a continuation and write 0 and proceed it. So it is not a continuation of the format. Sale value plus or minus tax. This I've already taught you, so you should be in a position to do this. Earlier one I had not explained to you. Sale value plus or minus tax. Sale value is 1, tax is 0. 1 plus 0 is 1. 1 plus 0 is 1. Any doubts on this? Any doubts on this part? Original machine is 0, that doesn't really matter. Additional machine is 1 lakh. Can we proceed? Let's take it up here. 1. Terminal flow 16. What is terminal flow? Is 8th year you will get this 16. 8th year you will get this 16. Any doubts on this? Can we proceed? Any doubts on this? Clear? Any doubts on this? Working note 4. Computation of NPV. 4 columns. NPV 4 columns. Year, cash flow, PVF, DCF. Some discount rate would have been given in the question. PVF at 12%. Year, cash flow, PVF at 12% and DCF. Year, cash flow, PVF at 12%, DCF. Can we write? Year 0. Go to step 1. You will have the year 0 figure. Go to step 1. You will have the year 0 figure. Go to step 1 and tell me the year 0 figure. How much? Negative. Everything is there in your notebook. Okay. Nothing to see in question now. Year 0 negative 135. Year 0 negative 135 initial outflow. Year 1 go to step 2. Step 2 and tell me year 1 figure. 8.5. Year 2 again go to the same step. How much? 18. Year 3 85.25. Year 4, year 5, year 6 58.25, year 7 and year 8 alone, listen, 58.25 plus extra 16 lakh, plus extra 16 lakh, 58.25 last year alone extra. Step 2 plus step 3, step 2 plus step 3 plus step 3, how much? 58.25 plus 16 is how much? Clear? All the numbers are written. Any doubts on this? Any doubts on this? Year cash flow, I give you 2 minutes. PVF at 12%, 3 decimal. DCF 2 decimal. We are doing it in lakhs, so 2 decimal. Okay, 2 decimal and 3 decimal. Close it, you will get the NPV. 2 minutes for you to calculate the NPV. What was the discount rate given in the question? 12%. So 1 divided by 1.12. These are your discount factors. DCF is multiplication of these two. These will be your numbers, and final number is some 136 something, 136.06. Final number is 136.06. Any doubts on this? 2 decimal solving. Any doubts on this? Clear? Right below the company can, conclusion you have to write, conclusion. The company can go ahead with the project, as the same generates positive NPV of rupees 136.06 lakh. Positive means okay, negative means it is rejected. Same question they can ask IRR also. IRR means one positive, one negative, a longer calculation. They can ask discounted payback, year cash flow, PVF, DCF, PVF, DCF, cumulative discounted cash flow. Normal payback, add a cumulative cash flow column. Anything can be asked in the question. Basis this, anything they ask will be in a position to do. Getting the cash flow is the most important part. Any doubts on this? Any doubts on this? Clear? Can we proceed? I give you a minute or two, go through the entire solution. Anywhere there are doubts, let me know. A minute or two for you. Okay. Question 14 is a similar question. Only thing is it will have something called as carry forward of loss. I'll read it. I'll explain some part of it, and then you will do, and some part we'll do it together. XYZ Limited is planning to introduce a new product with a life of 8 years. Initial equipment will be 3.5 crores. Additional equipment will be 25 lakh, will be purchased at the end of third year. End of third year. Very clearly given, end of third year. No adjustment needed for that. From the cash inflow of this year. At the end of 8 years, original equipment will have no resale value. Additional equipment will be sold for 2 lakh 50. Working capital of 40 lakh will be needed and released at the end of 8th year. Released is called recapture of working capital. This is the sales volume first year, second year, third year, fourth and fifth. If you want, you can club it together or you can write it separately. Year 4, year 5, year 6, year 7, year 8. Selling prices 240. Variable expenses 60% of sale revenue. Fixed operating cost is 36 lakh. Loss of any year will be set off from the profits of subsequent 2 years. Loss of any year will be set off against the profits of subsequent 2 years. I'll be explaining what happens. This adjustment alone I'll explain. We have done it in an MCQ form, but I'll explain it. Company is subject to 30% tax rate. Consider 12% to be appropriate after tax cost of capital. Straight line method of depreciation. Calculate NPV and advise the management to take appropriate decision. Ideally, I leave it as homework in the past batches and all, but now I've started doing. But what will we do is I'll give you 12 minutes. In 12 minutes, you have to start from sales, start from your initial outflow, same format. In between flow, units sold, revenues, fixed cost, advertisement is not there, variable cost, depreciation of original machine, depreciation of additional machine, get till PBT. Get till PBT. If you are confident, you can do the balance part also. Not confident, at least till PBT you have to complete. At least till profit before tax you have to do. I'm not explaining any part of it, okay? At least till profit before tax you calculate it. You are getting a doubt, refer the earlier calculation, you will understand it. Till PBT, please complete it. Beyond PBT, I'll take you through. Take around 12 minutes, 12 minutes for you. Okay, let's start discussing this now. Exactly same format. Tell me what is the capital expenditure, initial outflow? 350, 350. Working capital, 40. Initial outflow, 390. Initial outflow is 390. Any doubts on this? This is your initial outflow. Unit sold is given in the question, 0.72, 1.08, 2.60, 4 and 5 I am clubbing it together. Even if you have written separately also it's okay, or if you have written it together also it is okay, wouldn't make any difference. 1.80. Writing separately means the same number will be repeated 2 times and 3 times. Writing it together would mean only one time you write it and then close it. What is the selling price given? 240. So 240 into 0.72, 172.80, 240 into 1.08, 259.20, 240 into 2.60, 624, 240 into 2.7, 648, 240 into 1.8, 432. These numbers you should have got. 432. What is the fixed cost given in the question? 36. See, whether it is 4 to 5 or year 4 separately, year 5 separately, one year amount only we will write. We will write only 1 year. We are not going to do into 2 and all. Minus 36, minus 36. Advertisement part is not there. What is the PV ratio here? Okay, directly given. Variable expenses is okay, 60%. Variable expenses 60% of sales. 172.8 into 0.6. 103.68. 259.2 into 0.6. 155.52. 624 into 0.6 is 74.4. 648 into 0.6 is 88.8. 432 into 0.6, 259.2. Original machine, what is the cost? 350 lakhs. We are doing in lakhs. No resale value, I think. Divided by 8 years. How much? 350 by 8. 43.75. 43.75. Additional machine was purchased for 25 lakh. Additional machine purchased for 25 lakh at the end of third year. So depreciation only for 5 years. At the end of third year. Any resale value? 2.5 divided by 5 years. Divide by 5 years. This is 4. Not applicable. Not applicable. Not applicable. 4.5. 4.5. This is what I wanted you to complete. This the PBT level. If you have not completed some part of it, you can note it down. PBT is 172.8 minus 36, 103.68, 43.75. Loss of how much? 10.63. 259.2 minus 36, 155.52, 43.75. 23.93. 624 minus 36, 374.4, 43.75. 169.85, 648 minus 36, 388.8, 43.75, 4.5, 174.95, 432, 36, 259.2, 43.75, 4.5, 88.55. You can confirm if these numbers are fine. Beyond this, I'll take you through. Some of you could have done that also. It's okay. For others who have not done, I'll take you through. Any doubts in this? Any doubts in any of these numbers? Can we proceed? Year 4 and 5, you can write it separately. I think my printed answer, I would have written it separately. You write it separately, write it together, doesn't make any difference. Doesn't make any difference. We are getting the same number whether you write it separately or you write it together. Clear? Can we proceed? Any doubts on this? Done? Okay. Now, question says loss of any year will be set off from the profits of subsequent 2 years. Next 2 years profit you can set off. If you are not able to set off in next 2 years, you will not get any benefit. So tax at what is the tax rate? 0. No benefit. No benefit, 0. Now below, tax of year 2 is equal to, tax of year 2 is equal to, from 23.93 I will remove 10.63. From 23.93 I will remove 10.63. From 23.93 I will remove 10.63 and pay tax at what rate? 30%. How much? Sorry, 3.99. Balance is same thing. It is a calculation heavy chapter. This chapter will involve a lot of calculation. I really don't have much to explain. That one adjustment alone I had to explain. Balances does calculators work. You will have to be a little faster. With time it will happen. Any number, if you find any error, you will have to tell me. Any doubts till this? 1 minute. Any doubts till this? Okay. Beyond this, I give you another 5 minutes. Another 5 minutes. Add depreciation, purchase of additional machine in the third year, get the CFAT, do the NSV exactly in the same pattern, calculate the NPV exactly in the same pattern. Some 7 minutes. Okay, 7 minutes for you. Please start doing it. 7 minutes for you. Start doing this. Let's close the balance part now. 43.75 is to be added. This year it is 43.75, another 4.5, 48.25. An additional machine is purchased in year 3 for 25. Year 3 purchases for 25 lakh rupees. Additional machine in the third year, we have purchased it for 25 lakhs. And CFAT, first year 33.12, second year 63.69, third year I see has done 3 decimal. I can do 2 decimal also. That's okay. 137.645. Fourth year 170.715. Last, that is last segment, 6th to 8th. Can somebody confirm if these numbers are right? 33.12, 63.69, 137.645, 170.715, 110.235. Ideally, I should not have done this question. Again, I'm saying I'm not teaching you new concept, but it's a time consuming area. That is the reason I've told you to do it, because it is time consumption area. You will have to keep practicing it. Now, terminal flow, original machine sale value 0, additional machine is 2.5. Book value is 350 minus 43.75 into 8, 0 only. It is 0 only. This machine 25 minus 4.5 into 5 years, same 2.5. Later on, I'll be talking about some shortcuts and all. As of now, I don't want to do any shortcut. 0 and 2.5. 0 and 2.5. So NSV is 2.5. NSV is 2.5. 0 and 2.5. NSV is 2.5. Any doubts on this? Working capital, how much was blocked initially? 40. 40 will come back. 42.5. 40 will come back. 42.5. I have exactly followed the previous question pattern only. There's no change in the previous question pattern to this. I've just changed the numbers, in fact, to the previous solution. Any doubts on this? Any doubts on this? Clear? Can you proceed? Any doubts on this? And then finally, NPV calculation. Year 0 outflow is negative 390. Negative 390. First year inflow is 33.12. Second year 63.69. Third year 137.645. 137.645. Fourth and fifth same number, 170.715. Again 170.715. Same number for fourth and fifth. We did not do separate columns, that's all. Same number fourth year, same number fifth year. Sixth, seventh, same number, 110.235. 110.235. Last year alone, 110 plus 42.5 plus 42.5, 152.735. These are the numbers. Clear? Any doubts in this? Well, I really don't have much to explain in this question. I wanted you to practice to understand the difficulty which can happen when you do a complex calculation. It is a 8-year calculation. If the same was a 1-year or a 2-year calculation, it wouldn't take you that much time. Concept remained the same. It's just that you have to repeat it for 8 years. What is the discount rate given? PVF at 12%. This will be your answer. These will be your numbers. 161.069. Last year I've added 42.35. Yeah, 42.5. 161.130. This is your NPV calculation. Next question onwards, whichever question we do, I will not be doing NPV calculation itself, and I will not tell you also to do it. My focus is only year and cash flow. Does it take much time? No, extra 2 minutes or 3 minutes, but I don't want to spend time on that. Our focus will only be on year and cash flow. Any doubts on this question? Any doubts on this question? There was one small change. We have done 3 decimal. Can I do 2 decimal? Yes, you can do it. This question I say has done 3. I have followed 3 decimal, but can be done 2 decimal also. This is your final answer. 161.12. I got 133. More or less same answer. Any doubts on this? Any doubts on this? Can we proceed? Any doubts on this? Done? Can we proceed? Okay, I'll quickly discuss maybe two more concepts and then we do question. Treatment of subsidy or government grant. Now let's understand what is a subsidy or government grant. Many a times the central government or the state government may give me some grant or a subsidy for the purpose of maybe setting up a manufacturing plant in a backward area, in a rural area. They tell me to set up one manufacturing plant and they may give me a subsidy called as capital subsidy, which is one time. Revenue subsidies for the sales which I do, they may give subsidy, or for the cost I incur, they may give subsidy. Revenue subsidy, two parts. Either it could be a taxable revenue subsidy or an exempt revenue subsidy, depending on the data in the question. If you have a taxable revenue subsidy, it will be considered as an inflow before PBT. Inflow before PBT. So this is, if it is taxable, it is an inflow before PBT. And if it is exempt, it is an inflow after PAT. After PAT. The subsidy is an inflow. Subsidy is an inflow. Revenue subsidy. Revenue subsidy is an inflow. If it is taxable, take it as an inflow before the PBT calculation. Before the PBT computation, it is an inflow and pay tax on that. And if it is an exempt one, after PAT, no tax on that. Capital subsidy, you could have come across this term little bit in your accounting also. There is something called as an accounting for government grant. What is capital subsidies? This is for the manufacturing plant. Now I can take an assumption that when a subsidy comes, the journal entry for the subsidy can be bank account debit. This is the subsidy inflow to subsidy. Now this subsidy can be treated as a reserves and surplus, that is subsidy account debit to reserves and surplus, or it can be credited to the cost of the asset. Credited to cost of the asset means you can reduce the asset value. You can reduce the asset value. So bank account debit to subsidy, subsidy came in. Now subsidy account to, you can say it is general reserve, part of reserves and surplus, or to fixed asset, to fixed asset. Subsidy is an inflow. I take it as bank account debit to the subsidy account. Now this subsidy can either be reduced from the cost of asset or not adjusted with the cost of the asset. If you adjust it with the cost of the asset, you will have to claim lower depreciation. If you do not adjust it with the cost of the asset, you will claim normal depreciation. Question will not clearly specify the treatment for capital grant. We'll have to take an assumption and proceed. If the grant is adjusted with the cost of the asset, then it will lead to lower depreciation expense. It will lead to lower depreciation expense. It is an assumption based area. Assumption based area. You can either adjust it with the cost of the asset or not to adjust with the cost of the asset. It will be an inflow whenever the money comes in. Most of the time it will come in year 0 itself, or year 1, year 2, year 3. When if it comes in year 0, initial inflow, year 2, year 3, in between flow, comes after the project, terminal flow. Whenever money comes in, it is inflow. Accounting wise, you can adjust it with the cost of the asset. You may not adjust it with the cost of the asset. If you adjust, asset value goes down, lower depreciation. Do not adjust, asset value remains same, no lower depreciation. Any doubts on the concept here? Any doubts on this? Okay. Other few points. One is, a question may use a term called cash flow before tax. Cash flow before tax. The term cash flow means depreciation is not subtracted. Whenever somebody says cash flow is calculated, in the cash flow, depreciation cannot be subtracted. So if they use the word cash flow before tax, it means it is before depreciation as well as before tax, and this is technically called PBDT, profit before depreciation and tax. Any question, If uses the word cash flow before tax, you will see this word used in one or two question. Cash flow before tax means depreciation obviously not subtracted, and before tax means it has to be PBDT, profit before depreciation and taxes. Same way, net cash flow after depreciation. Cash flow cannot be after depreciation, but if they use the word, I can't help it. Net cash flow after depreciation, but before income taxes, profit before tax is profit before tax. These two words will come at few places. Will come at few places. Net cash flow after depreciation, but before income tax. After depreciation, but before income taxes, profit before tax, and cash flow before taxes, PBDT, cash flow before taxes. The term cash flow means it has to be before depreciation only. Here they are very specifically saying net cash flow after depreciation. Okay, another point. Expenses not paid in the year of incurrence. What is not paid in the year of incurrences? The employee cost or the manpower, the material cost or a rent cost. Let's assume Bharadwaj Institute pays rent. First year rent we are going to pay in the second year. Second year rent we are going to pay it in the third year. Third year rent we are going to pay in the fourth year. Fourth year rent we are going to pay in the fifth year. This is an agreement I enter with my landlord. I had to calculate cash flow. For cash flow calculation, if rent is paid in second year, it is a second year outflow. Rent is paid in third year, it is a third year outflow. Rent is paid in fourth year, it is a fourth year outflow. But income tax will say you are paying first year rent in the second year rent in the third year. For income tax purpose, for income tax purpose, we follow accrual concept. For the concept of capital budgeting, I go through cash flow analysis, but income tax purely accrual concept, they will go with the concept of accrual. So here deduct expenses as per accrual concept for tax calculation, that is sales less expenses less depreciation, deduct everything. What we used to do, we deduct depreciation, add back depreciation. So whatever expenses you deducted which is not paid, please add it back. Which is not paid, please add it back. When? After PAT is calculated. After PAT is calculated. Deduct expenses as per accrual concept. As per accrual concept for tax computation, add back amount which was not to be deducted. Why not to be deducted? Because you did not pay. And deduct amount which is paid. Deduct amount which is paid. So first year accrual concept I will do it. At the end, after PAT is done, add back this rent. Add back this rent. First year you did not pay any rent. That's all. Add back, leave it. Second year, you will consider second year rent in the calculation. Add back second year rent and deduct first year rent. Add back second year rent. Add back what was not paid and deduct what has been paid. Deduct what has been paid. Income tax says no cash flow concept. You follow accrual concept. You follow accrual concept. Able to understand the concept? If you did not pay any expenses, you will see all these adjustments coming at few places. If you did not pay any expenses, go through the concept of accrual. What is accrual concept? Till PBT, whether paid, not paid, please consider it as part of expense. Whether paid, not paid. A classic example is depreciation. Depreciation can never be paid. But I deduct depreciation. After PAT is done, add back depreciation. After PAT is done, add back expenses unpaid and deduct expenses which has been paid. Any doubts on the concept? And the last point, capital budgeting assumes cash flow will happen at the end of the year. It always assumes any cash flow will happen at the end of the year. If question says beginning of year 5, it will be considered as end of year 4. We have seen this in one question. Beginning of year 5, beginning of year 4. Any question says beginning of some year, some investment is done. Any asset purchased at the beginning of the year will be treated as acquired at the end of the prior year. At the end of the prior year. Prior year means fifth year, fourth year, third year, second year, first year. First year, year zero. First year is year zero. Can you give me the answer to this? Quick example. What's the answer? Outflow in year two. Outflow in year two. Clear? Any doubts on this? Any doubts on this? Okay, I give you some time again. I want you to go through from concept 9 till 14. All the concepts are there. Just quickly read it once and then we start doing question 9 to 14. Okay, let's start doing questions now. I come to question 18, page 162. SRT Limited manufactures steel rods and is now considering to purchase a new aluminium smelting and molding plant. Plant will have a cost of 20 lakh to purchase and install the plant. Initial expenses. It has a life of 5 years. Residual value 1 lakh. Production is 1 lakh units per year. Other estimates: selling price, direct cost, fixed cost including depreciation. Including depreciation is 8 lakh per annum. Marketing and promotion cost is 1 lakh and 116 year 1 and year 2. Investment in debtor stock 150 2 lakh. Creditors 1 lakh. Debtor stock and creditor will be recouped at the end of fifth year. Cost of capital, corporate tax rate, depreciation is tax deductible. Compute NPV and profitability index. Advise whether the plant should be purchased. Advise whether the plant should be purchased. Go through the question and then I'll explain. A minute for you to go through the question. Okay, coming to the question. First para, plant will cost 20 lakh to purchase and install. Where will this 20 lakh be considered? Participate, guys. Initial outflow. Life of 5 years with a residual value of 1 lakh. This will help me in calculating depreciation and also net salvage value. 1 lakh units will be sold. Revenue is 1 lakh into 150. Cost is 1 lakh into 100. Fixed cost is 8 lakh per annum including depreciation. So in the fixed cost, depreciation is already deducted. That is considered. So once you subtract all this, you will get PBT less tax, PAT, but you have to add back depreciation. You have to add back depreciation. Marketing and promotion cost not included in the above will be 1 lakh 160 for which years? Only 1 and 2. So when I do my cash flow calculation, revenue is same for all the 5 years. Direct cost is same for all the 5 years. Fixed cost is same for all the 5 years. But marketing promotion is not same. Marketing and promotion 1 lakh for year 1, 160 for year 2, 3450. So in cash flow calculation, in between flow, year 1 separate column, year 2 separate column, 3 to 5 can be clubbed. 3 to 5 can be clubbed because marketing and sales promotion 1 lakh and 160. All this what I say will hold good if it is SLM method. If they say WDV method, then we are gone. Every year separate calculation only. Then investment in debtor and stock will increase in year 1. Year 1 is understood as year 0, beginning of year 1, because you are at the start of the project, working capital will be there. What is working capital? Debtor plus stock minus creditor. Debtor plus stock minus creditor. How much is the debtor increase? 150. Stock increase 2 lakh. 150 plus 2 lakh. Creditor increase 1 lakh. So my working capital in year 0, working capital in year 0 is debtor plus stock minus creditor, and this will be recouped. Recouped of the end of the fifth year is nothing but recapture of working capital. Recapture of working capital at the end of fifth year. Cost of capital, corporate tax rate, that all is okay. Company follows which method? Straight line method of depreciation. SLM is easier for us to do. So here we will first do an initial outflow. In between flow, year 1 separate column, year 2 separate column, 3 to 5 can be a single column. You're not able to, you're not very sure, separate column for every year. If you're not very sure about your calculation, because reason is 3 to 5 I club it together, but suddenly if any extra cash flow comes only for the third year or only for the fourth year, what can be extra? Purchase of new machine, payment for original machine, some increase in working capital, some, if at all anything extra comes, then you will get stuck. If no extra comes, no problem. So if you are not sure, year 1, year 2, year 3 separate column, year 4 separate column, year 5 separate column. You're confident, then do 1, 2, 3 to 5 together, 3 to 5 together. Let's start. Working note 1, initial outflow. Working note 1, initial outflow. Particulars and amount. This is an exam question, a straightforward, simple question. Capital expenditure. Look at the question and tell me the capital expenditure. Minus 20, minus 20. Working capital, inventory plus debtor minus creditor, or current asset minus current liability. Current asset minus current liability. This is outflow. Beginning in year 1 is understood as beginning of year 1, because normally when I start a project, working capital will get stuck. Working capital, how much is the inventory increase? 2 lakh. Debtor increase 350 is the current asset requirement. Creditor increase 1 lakh. So negative 250. Negative 250. Negative 250. Clear? Capital expenditure negative 20 lakh. Working capital negative 250. This working capital will come back in the year 5. Will come back in year 5. Any doubts on this? Initial outflow 2250. 2250. Any doubts on this? Can you proceed? Working note 2, in between flows. In between flows. In between flows is year 1 separate, year 2 separate, 3 to 5 together. 3 to 5 together. Can I do separate for 3, 4, 5? Yes, you can do it. I'm not sure, if by mistake if I do 1 to 5 together, you will get stuck. So if you're not very sure, do separate for all the years. If you're certain, then go accordingly. Particulars and 3 columns. Year 1, year 2, year 3 to first year, second year, and third to fifth year. Revenues. How many units we are going to sell? 1 lakh at what price? 1 lakh into 150. 1 lakh into 150. 1 crore 50 lakh. Year 3 to 5 also same amount. We'll not do into 3 and all. Some students confused there. We'll write only one time. Less, what is the expense given? Direct cost. Direct cost, which is 100 per unit. Direct cost 1 crore into 1 lakh into 100. 1 crore is the direct cost. 1 lakh into 100. 1 crore is the direct cost. 1 lakh into 100 into 100. Clear? 1 lakh into 100. Then what else is there? Less fixed cost. Fixed cost. How much is fixed cost? 8 lakh. This includes depreciation. Okay. So depreciation is no separate subtraction. It includes depreciation. Depreciation is auto deducted in this calculation. Less, there's one more expense. What is that? Marketing. How much? 1 lakh. 1 lakh. 60 0. Profit before tax. Profit before tax. 41 lakhs. 40 lakh 40. 42 lakhs. Let me know if any doubts in any of the numbers. 41, 40, 40, and 42 lakhs. Profit before tax. PBT number 41, 40 lakh 40 and 42 lakhs. The calculations are little bit heavy in some question. Some questions simple calculations are there. What the tax rate? Less tax at 30%. Tell me the amount. 12 lakh 30, 12 12, 1260. Profit after tax 28 70, 28 28, 29 40. Any doubts on PAT number? Any doubts on the PAT number? I'm just writing whatever you guys are saying. Any doubts on the PAT number? Can we proceed? Clear? Add back depreciation. Depreciation, what was the cost of the machine? 20 lakh. Depreciation, cost of the machine is 20 lakh. Any residual value? 1 lakh. Life? 5 years. 380. Cash flow after tax. Cash flow after tax. Depreciation is part of that 8 lakh which you see there, because again students sometimes get a confusion why depreciation is not subtracted. It is subtracted. It is part of that 8 lakh rupee. It is part of that 8 lakh rupees. How much is CFAT? 32, 50, 32, 08, 33, 20. Anybody has any doubts on this? Any doubts on this part? Any doubts on any of the numbers here? Can we proceed? Any doubts? Done? Can we? Working note 3. Terminal flow. Terminal flow, particulars and amount. Particulars and amount. Terminal flow. NSV and underline that. Sale value. NSV and underline that. Sale value. It is always preferable to do the NSV calculation. Many a times NSV and SV may match, but there are questions it doesn't match also. What is the sale value? 1 lakh. Less book value. What was the cost of the machine? 20 lakh. How much depreciation did we provide? 3 lakh 80 for how many years? 5 years. 380 for 5 years. 3 lakh 80 for 5 years. How much you get? 1 lakh. Now listen. This calculation, if you want, you can do in calculator. If SV and BV matches, if SV and BV matches, no need to do NSV. Sale value is equal to net salvage value. Directly you can write. If you want, you need not present it in exam, even in our class. In case sale value and book value matches, in case, so if you see our earlier questions till now, sale value, book value matches, NSV will be equal to sale value. NSV will be equal to sale value. If both 2.5 matches, NSV is equal to sale value. NSV is equal to sale value. So this, now because I've already done 4 5 questions, so now I'm telling you the short way. You can check sale value and the book value in the calculator. Sale value anyway will be given. Book value check. You see same amount. No need to present calculation. You see a different amount. Obviously, you'll have to present the calculation. Here, my NSV will be 1 lakh. This question I'm writing it, but next question onwards, I may do this in the calculator. If I see both same, I will not write the 5 line items. Now, capital gain 0, tax paid 0, NSV is the sale value itself 1 lakh. NSV is the sale value itself 1 lakh. NSV is the sale value. In case SV and BV matches, because if SV and BV matches, no capital gain, no tax payment. If the sale value and book value matches, no capital gain, no tax payment. Any doubts on NSV figure? Any doubts on the NSV figure? Can we proceed? Any doubts on NSV figure? Recapture of working capital. Recapture of working capital. How much is the working capital in day 0? Entire amount will be recaptured. Total terminal inflow. Total terminal inflow. Terminal inflow is 3,50,000. Terminal inflow is 3,50,000. Any doubts on this? Clear? Okay. Can we proceed? I give you, listen, around 3 minutes. You have to do NPV as well as PI. What will you do? Year 0, step 1. Year 1, step 2, cash flow. Year 2, step 2, cash flow. Year 3, step 2. Year 4, step 2. Year 5, step 2 plus step 3. Step 2 plus step 3. Calculate NPV, calculate profitability index. NPV is the total, profitability index inflow minus the outflow. What is the discount rate in the question? 18%. Start doing it. 4 minutes for you to calculate NPV, PI and write the conclusion. NPV, PI and write the conclusion. Year 0, what is the outflow? 22 lakh 50,000. Year 1, we had an inflow of 32 lakh 50,000. Year 2, we had an inflow of 32 lakh 8,000. Year 3 inflow is 3320. Year 4 again 3320. Year 5 is 3320 plus 3 lakh 50, put together 3670. Put together 3670. I will have to discount this now. These are values and the NPV values 81, 44, 884. Some up and down rounding of difference can be, but broadly this is the answer. 81, 44, 884. PI is equal to inflow divided by outflow. Inflow total is 1 crore 3,94,884. 1 crore 3,94,884. So PI is 103,94,884 divided by 22 lakh 50,000. From 4.62 times, or you can call it as 461 percentage. Times is also okay. 4.62 times. Now, should the project be accepted? Yes, the project has to be accepted because, or the plant has to be purchased because we have a PI greater than 1 and NPV is positive. Positive NPV, we go ahead. Any doubts on this? Any doubts on this? Can we proceed? Any doubts on this? Now, this is one chapter where when you get into revision phase, I wouldn't want you to solve more question. Other chapters and all, more question makes sense. This chapter, solving even 20 questions will not serve purpose because in exam 21st question will only come. Same question will not get repeated. Only thing you need to be sure is every question, are you learning anything new? That new part alone you may have to revise and focus more on the concept book concepts only. Because in this chapter, trying to do more and more question will not serve lot of purpose. I can keep doing. In fact, this if I wanted in this material, I could have added another 20 capital budgeting question because they would have been part of some MTP, some RTP, some because normally repetition is not there. In this chapter, repetition will not be there. You will see only a new question in exam. The only thing is, for example, this came in exam. Now, I did not teach this type of a question to a student, but if they are aware of the concept, they'll be able to handle it. It's not that there was anything extra unique in the question. You know the concept, you'll be able to handle it. This came in Jan 25 exam. Like this, questions will keep coming from this chapter, but focus has to be clearly on the concepts here. A lot of practice will not serve purpose. Clear? Can we proceed? Okay, let's come to question 19. Here, what we are going to learn is what is given there, WDV method. That's the learning we are going to have here. Company is considering a proposal to take up a project which requires investment of 850 lakhs in plant and machinery, 150 lakhs in working capital. Project will give cash flow before tax and depreciation. Cash flow before tax and depreciation. What does that mean? PBDT, profit before depreciation and taxes. So they are saying you need not do revenue, you need not do all cost. I'll start with PBDT. I'll start with PBDT. After that, you do. So PBDT is given. Desired rate of return is 14%. Asset must be depreciated at 20% on a WDV basis. On a WDV basis. So every year, separate calculation. And as such, the PBDT number is also different only. So anyway, separate calculation for every year. Scrap value can be taken as 140 lakh. Income tax applicable is 20%. This is the only asset in the entire block. You learn about this in income tax. There's something called as a block of assets method. Not much for you to worry. Only thing is, if there is a block, there will be something called as capital gain or capital loss which will arise once the block is sold. Capital gain tax is 15%. Normal income tax is 20%. So for capital gain alone, you'll have to take 15%. When you do sale value less book value, capital gain, capital loss, you'll have to do 15%. You are required to calculate the NPV of the project, which we will do. Advise the management on the appropriate decision. Also calculate the IRR and desirability factor. What is desirability factor? Profitability index. Now, nothing much for you to read the question. We're going to directly start doing it. Only question I have is, when you follow WDV method, should you charge depreciation at 20% on 850 lakh or 850 minus the salvage value? Should I do minus salvage value? I don't know. I'm asking you a question. Should I do minus salvage value? No, we don't do minus salvage value for WDV method. SLM method, we do minus salvage value and divide by the life. Divide by the life. Working note 1, initial outflow. Again, it's going to be very simple only. Only add on is the WDV method. So this can come in exam where they want to test your understanding of WDV method. Working note 1, initial outflow. Particulars and amount. Amount in bracket lakhs. We'll do it in lakhs. Particulars and amount. Capital expenditure. Moment it's WDV, it will take us decent amount of time to do the calculation because there will be a lot of computation to be done. Capital expenditure, how much is the capital expenditure? 850. Capital expenditure 850. Any working capital? Negative 150. Initial outflow 1000. Initial outflow 1000. Clear? Can we proceed? Working note 2. In between flows. In between flows. In between cash flow. Particulars and 5 years. Particulars and 5 years. Separate calculation for every year. Particulars and 5 years. Normally starting is revenue, but here revenue is not the starting. They have said we are not giving you revenue, we are giving you some other number and you start with that. What is the number they have given? Profit before, let's write the format first and then we'll fill. Profit before depreciation and tax. Profit before depreciation and tax. Let's write the format fully first and then we'll fill it. What should I deduct? Depreciation. Profit before tax less tax. Profit after tax. Add back depreciation. Cash flow after tax. Nothing much to explain from my side. It's something should be very clear to you. This is the format we have been using. PBDT less depreciation, PBT less tax, PAT add back depreciation, CFAT. Can we start? Tell me the PBDT numbers. 290, 320, 360, 390, 270. Any doubts on this? These are PBDT numbers. Now depreciation is not SLM, so I'll have to do a separate note. WDV will need us to do an extra calculation. Any doubts first till this? Note 1. Computation of depreciation. Computation of depreciation. Particulars and 5 years. Opening balance less depreciation, closing balance. Opening balance less depreciation, closing balance. Less depreciation, closing balance. What is the cost of the machine? 850. What is the rate of depreciation? 850 into 20%. Into 20%, 170. Closing balances 680. Take 680 to year 2. 680 to year 2. 136. 136. 544. 544. It is a simple calculation. Calculation is not tricky, just the time consumption. 544 year 3. How much is the depreciation? 108.8. 2 decimal, let's keep it. 108.8. 435.20. 435.20 into 87.04, 348.16, 69.63, 278.53. Any doubts on this? Every year, a separate computation is needed. SLM method would have been fairly simple. WDV method, opening balance into 20%. Copy paste depreciation in working note. Depreciation, copy paste. Depreciation, copy paste. Get PBT. Profit before tax 120, 184, 251, 302, and 200.37. It is a calculation intensive question. What's the tax rate for business profit? There's a different tax rate for capital gain. 20%. At 20%, 24, 36.8, 50.24, 60.59, 40.07. Let me know if you're getting these numbers. Every year, not much for me to explain here. You need to do WDV method depreciation and then now deduct tax at 20%. That's a different tax rate for capital gain, different tax rate for business profits at 20%. Any doubts in any of these numbers? Can we proceed? Add back the depreciation 170, 266, 136, 283.2, 108.8, 309.76, 87.04. This calculation part you should be in a position to handle. Any doubts there, you'll have to tell me. These should be the CF80 numbers. Anywhere you find any error, let me know. These should be your CF80 numbers. Any doubts in any of the numbers? This question we are testing WDV method understanding. Any doubts in this? Can we proceed? Any doubts? Done. Can we? Working note 3, terminal flow. Terminal flow. This question that capital gain and all will come. Terminal flow. Any doubts on the CFAT numbers? Terminal flow. Particulars amount. NSV, underline that. Both items are there. Recapture of working capital is there. NSV also calculation is needed here. Terminal flow. Sale value and book value will not match here. You will see as we write it. Terminal flow. Any doubts on the earlier cash flow numbers? 266, 283, 309, 329 and 229.93. Any doubts on that? Sale value. Tell me what is the sale value of the asset after 140. Book value is there in your note 1, that closing balance of fifth year. Closing balance of fifth year is the book value. Closing balance of fifth year after depreciation. After depreciation, closing balance of fifth year. How much is that? 278.53. Sale value 140, book value 278.53. 0.53. Capital gain, capital loss. Capital loss. Capital loss. How much is the loss? 138.53. Tax saved. What is the tax rate for capital gain? If they are not given a separate rate, we would have done 20%. 15% for capital gain into 0.15. 20.78. 20.78. Leave a line. NSV. Sale value 140 and 20.78. 140 and 20.78. 140 and 20.78. 160.78. Any doubts on this? It is not a continuation of the format. Recapture of working capital. How much is the working capital? 150. Total terminal inflow 310.78. Yep. Can we proceed? Any doubts on this? Done? Okay. I'll give you around 4 minutes. You'll have to calculate NPV, PI, IRR. You will start with 14% because that's the cost of capital. That may give you positive NPV or negative. Increase the rate, reduce the rate. One positive, one negative. 14% we have. You don't do 16%. 16% again will give positive here. I know the answer, so you try 18%. If you try 16, then you have to again try 18. You have to again try 18. The gap should be as low as possible, but in class I don't want to do too much. 14% and then do 18%. Okay, 5 minutes for you and then complete the IRR part also. Clear? Decimal. PVF will be 2 decimal as per the question. Okay, follow whatever is there in the question. PVF will be 2 decimal. 5 minutes for you. Year 0, what is the outflow? Let's participate. Year 0 outflow 1000. 1000 was the outflow. Year 1 we had an inflow of 266, 283.2, 309.76, 329.41, 229.93 plus 310.78. These were our cash flow numbers, and NPV is 135.79. This is at 14%. If I try 18% at 18%, 18 is also giving positive NPV. Okay, then we don't have. Okay, just a minute. I had to do two decimal. This one. Okay, 18 is also giving us positive NPV. 18 is also giving. Are you getting positive NPV at 18%? No. Just give me a minute. What happened? Okay, there is, I think, some error in this table value. I think some error in the table value from my side. Sorry about it. This is not 18%. Then this is some other rate. There is some error in this table from my side. That's sorry about it. Okay, this table I think is of 20%. Sorry about guys. The table is of 20%. The table which you see is of 20%. So I try 20%. There is an error from my side. Yeah, 20%. The table is of 20%. Okay. There's an error from my side in the table. In the table, it is at 20%. The table is 20%. I'll correct that. This rate is 20%. Not sure what I've done in the answer, but this rate is 20%. This rate is 20%. Clear? If you do 14, it's 135.20. If you do 20%, which is a very high gap, but 20% is negative 29.75. That rate is 20%. There is a mistake from my side. Any doubts on this? Any doubts on this? NPV is done. Profitability indexes inflow total 1135.2, outflow is 1000, and profitability index is 1.1352. 1.1352. Any doubts on this? IRR calculation, lower rate 14 plus NPV at the lower rate 135 divided by 135 minus of minus 29.75 into the difference in rate is 6%. The difference in rate is 6%. 20 minus 14. The difference in rate is 6%. There is some error in that table. Your IRR is some 18.92%. IRR is 18.92%. The accuracy, listen, we have done 14 and 20. The accuracy will be on the lower side. The exact answer here is 18.93. We got 18.91. In the solution, I've done 14, 18 and 20. When you do three rates, take L1 and L2 as the one which has lesser gap. So L1 in my answer will be 18, L2 will be 20. 18 and 20, 18% and 20%, and with that IRR is 18.97. 18% and 20%. We did 14 and 20. We did 14 and 20. Answer will be different. Any doubts on this? Any doubts on this? The only thing is in this table, you can change it as 14. Is this 16 is 18, I think. Or is it 18 or not? Okay. 14, 18 and 20. 14, 18 and 20. 14, 18 and 20. We have tried 14 and 20%. Okay. Let's not worry about the mistake which was there. But the concept is simple. Okay, 16 only. Okay, then maybe I have to add another table 18. 14, 16, 18, 20. Okay, that's okay. That I'll correct it in the material. Concept is very simple. Whenever a table is given, take it from the table. There is some mistake in drafting, so let's not worry about that. 14%, you try 18%, you get positive, you have to try 20%. One positive, one negative, and 18 will be L1, 20 will be L2. If you try 14 and directly 20, L1 is 14, L2 is 20. You try 16 and then do 20. 16 is L1, 20 is L2. The gap should be as low as possible. Clear? Any doubts on this? Any doubts on this? No major concept, nothing. How WDV is done is what is done here. I'm not bothered about IRR calculation. I'm not bothered about PI. Now, calculate, advise the management. Advise, if they ask, you'll have to write that the company should go ahead with the project. Positive NPV, go ahead with the project. Any doubts on this? Conclusion is very critical. The company should, sometimes conclusion could be missing in my answer. You will have to write the conclusion. Conclusion, please write it. It got missed out in the solution. Company should go ahead. Positive NPV. Any doubts in this? Any doubts in this? Clear? Can we proceed? Any doubts on this? Can we proceed? Done. Anybody needs any explanation? Can we proceed? Okay, I'll move to question 20. It's a homework question which I'll discuss and then you are going to do it. NC Limited is considering purchasing a new machine to increase its production facility. At present, it uses an old machine which can process 5,000 units of TV per week. NC could replace it with a new machine which is product specific and can produce 15,000 units per week. New machine cost 100 crore, require working capital of 3 crore. 100 crore, working capital of 3 crore, which will be released at the end of 5th year. Which will be released at the end of 5th year. New machine will have a salvage value of 20 CR. Company expects demand of TV to be 10,000 units per week. 10,000 units per week. Each TV sells for 30,000. PV ratio is 10%. PV ratio is 10%, 0.10. Company works for 56 weeks in a year. Illogical, but I can't help it. They've used the word 56 weeks. 52 weeks is what is possible, but they've used the word 56 weeks. Let's go ahead with whatever term used in the question. 56 weeks in a year. Additional fixed cost without depreciation is 10 CR, 40% tax rate. After tax cost of capital is 20%. Relevant rate of depreciation is 25%. Company uses WDV method of depreciation. WDV method of depreciation. Existing machine will have no scrap value. That is some existing machine which we are going to replace. Advise whether the company should replace the old machine. Clear? I'll explain it and then you start doing it. What is the capacity of the machine today? 5,000. We are increasing this to 15,000. So ideally my extra revenue is 10,000 TV. Extra revenue is 10,000 TV. Ideally 5,000 is the existing capacity and the new capacity is how much? 15,000. 10,000 TV into 56 weeks into 30,000 rupees. You can solve the problem in crores. The number will be huge. Okay. 10 ideally. Okay. I'll read then further. New machine will cost 100 crores. Where will this come? Step 1, initial outflow. Working capital 3 crore. Initial outflow, terminal flow. Salvage value for NSV calculation. Company expect demand to be how much? Demand is only 10,000. My capacity will increase from 5 to 15. Sales will increase from 5,000 to 10,000. Sales will increase only from 5,000 to 10,000. Capacity is going to increase from 5,000 to 15,000. If this demand data was not there, extra sales 10,000 unit. Now extra sales is only 5,000 units. Extra sales is only 5,000 units into how many weeks? Don't write sales, directly write into contribution per unit. Why contribution per unit? Sales minus variable cost is automatic. Otherwise you have to write sales separately, variable cost separately. What is contribution per unit? 30,000 into 0.1. 30,000 into 0.1, which is 3,000 rupees. So sales is extra units into 56 weeks. That is contribution. Extra units into 56 week into 3,000 rupees. From there you deduct fixed cost, you deduct depreciation, PBT, deduct tax, PAT, add back depreciation, CFAT. Depreciation 100 CR, WDV method. WDV method you have to follow. Clear? And then you will do terminal inflow. After terminal inflow is done, if I'm going to give you around 15 minutes, in 15 minutes I want till terminal inflow, you still have time, you can do NPV. You don't have time, then only terminal. I don't want to do NPV and all. And question is very clear, decimal may be taken up to 2 units. You'll solve the problem in crores, 2 decimal, PVF 3 decimal only. PVF 3 decimal normally. Your cash flow will be 2 decimal. Cash flow will be 2 decimal. Step 1, step 2, step 3. Step 2, don't write revenue, don't write variable cost. Directly contribution, less fixed cost, less depreciation, PBT, less tax, PAT, add back depreciation, CFAT. Clear? Start doing it. Start doing it. Around 12 to 15 minutes for you. Okay, I will discuss the answer. Working note 1, initial outflow, capital expenditure. How much is the capital expenditure? 100 crores. Working capital 3 crores. Put together 103 is my outflow. Working note 2, in between flow, particulars and 5 years. Contribution is the first line. What is contribution is 5,000 into 56 weeks. 5,000. What is 5,000 is 5,000 units becoming 10,000. 5,000 units into 56 weeks into 3,000 rupees. 3,000 per unit. I'm dividing it by crore to convert into crores. 84 crore is the contribution. 84 crore is the contribution. 5,000 units. 5,000 units into 56 weeks into 3,000 per TV. 3,000 per TV. Less, how much the fixed cost? Guys, participate. Fixed cost is 10,000. Then less depreciation. For depreciation, we'll have to do a separate note. How much was the opening balance? 100. Less depreciation and closing balance. Depreciation rate is 25%. 75 is the closing balance. These are your depreciation figures. 25, 18, 14, 10 and 7.91. We'll have to deduct the depreciation. We get PBT. These are the PBT numbers: 49, 55, 59, 63, 66. Deduct tax. What is the tax rate? 40%. Tax at 40%. PAT. These are PAT numbers. Add back depreciation, CFAT numbers. I add back whatever is the depreciation amount, and these are CFAT numbers: 54, 51, 50, 48 and 47. These are the CFAT numbers. It's the same calculation at your end. It takes time. In Excel I can do it faster. Any doubts on this? Any doubts on this? Clear? Can we proceed? Any doubts on these numbers? NSV calculation. What is the sale value? 20. Book value is 23.73. Capital loss 3.73. Tax saved. What is the tax rate? Same 40% here. Okay. 40. 1.49 is the tax saved figure. NSV is 20 plus another 1.49, and recapture is, how much was the working capital? 3. Put together 24.49. Beyond this, I'm not worried about it. I'm not even discussing it. Any doubts on this? Any doubts on this? Again, I'm saying you, it is a calculation heavy area. You do it on your own. No new concepts will be there. Calculation, you will have to be very accurate in your computation. Any doubts on this? Can we proceed? These were your numbers: 24.49, and then we calculate NPV. Positive we go ahead, negative we reject. Any doubts on this? Can we proceed? Done. Let's come to 21. This we will do. Heading says non-payment of full initial outflow. So this is the adjustment we are going to discuss in this question. Cello Limited is considering buying a new machine. Guys, please come to this question. Leave the earlier question. If at all any important calculation you are doing, you want me to wait, I'll wait. Can we proceed? Any important computation you want to do in the previous question, let me know, I'll wait. NPV calculation and all, don't bother about it. I'm again repeating you. Year cash flow is the critical part. Can we proceed? Okay. Cello Limited is considering buying a new machine which will have a life of 5 years at a cost of 1 lakh 25, scrap value of 30,000 with 80% of cost being payable at the start of the project and rest 20% at the end of first year. That's the only difference. 20% will be paid at the end of first year, 80% would be paid initially. Machine will cost 50,000, selling price 3 per unit, direct cost 1.75, annual fixed cost including depreciation is 40,000. In the first year and second year, special sales promotion expenditure not included in the above cost would be incurred amounting to 10,000 and 15,000. Evaluate the project using NPV method of investment appraisal assuming cost of capital to be 10%. Quickly go through this, then I'll explain. Okay, this is similar to a question we did today. It is similar to which question? We did today. First question I think we did. It is very similar. In fact, same I think, not even similar. If you see here, the same things were there. They said 1 lakh unit, selling price was there, direct cost was there, fixed cost including advertisement was there, marketing promotion was there. For year 1 it was there, year 2 there, 3 to 5 not there. Almost the same thing. Only add on adjustment, 80% paid, 20% not paid. Another important point here is there a tax rate given in this question? Is there a tax rate given? No. You have two choices. One choice is to assume a tax rate and proceed. If you want to assume, you can assume 25% tax rate, which is our India's corporate tax rate. Other option, which ICA has done, ignore the tax. If you ignore the tax, I will do revenue less all cost other than depreciation. I will not deduct depreciation. I will not deduct depreciation and call it as PBDT or cash flow. PBDT or cash flow. I will not subtract depreciation. I will not subtract depreciation. Question has said fixed cost including depreciation. If it includes depreciation, you remove the depreciation. You remove the depreciation and deduct only fixed cost without depreciation. Can I do with the depreciation? Yes, you can do. Then you have to add back depreciation. You have to add back. But here we are going to ignore income tax. If you ignore income tax in that scenario, depreciation will not have any implication. Depreciation will not have any implication. Can I assume a tax rate? Yes, you can assume it. That's an assumption based area. But here I'm going to ignore taxes because tax rate is not given. Some question will specifically say ignore tax. So it's very similar to that question with two adjustment. One is ignore tax. Second is 80% is paid, 20% is unpaid. 20% is unpaid. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow. Particulars and amount. Particulars and amount. Capital expenditure in bracket paid part, paid portion. Capital expenditure in bracket paid portion. Whatever we have paid will only come here. Capital expenditure paid portion. When I say paid portion, year 0, immediately paid. What is the capital expenditure of the machine? How much we have paid at the start of the project? At the start of the project, 1 lakh. 80% we have paid. 20% will come at some other place. Okay, it will come at some other place. We had 4 balance sheet adjustment. I had said payment for original machine, purchase of additional machine, increase in working capital, decrease in working capital. Any working capital data? Working capital as a format, I'm writing it. Even if you don't write, it's okay. 0. Initial outflow 1 lakh. Initial outflow 1 lakh. Any doubts in this? Clear? a small change which has happened. Normally we write 125 full amount. Here we have written only 1 lakh. That's a small change. Working note 2. In between flow. Is the unit same for all the years? Is the unit sold same? Selling price same? Direct cost same? Fixed cost same? Only changes your sales promotion, which is how much? 10,000, 15,000 for which year? Year 1 and 2. Exactly same format. Particulars year 1 to 2 and 3 to 5 separately. Year 1 to 2, 3 to 5 separately. Particulars year 1 to 2, 3 to 5 separately. This is the calculation we did earlier in that question. I'm repeating the same calculation. Only change I'm going to do is no tax and all, no tax part and all. So let's start with revenue. Particulars year 1, year 2, 3 to 5. Tell me number of units and the selling price. Sorry, 50,000 into 3. 50,000 into 3. 1 to 2, 1, 2 and 3 to 5 separately. 1, 2 and 3 to 5 separately. Revenues 50,000 into 3. What are the expenses given? Direct cost how much? 50,000 into 1.75. 1.75. 87,500. 1.75, 87,500. Any doubts on this? Clear? Can you proceed? Less fixed cost. How much the fixed cost given? 40,000 minus. Can you calculate the depreciation figure? Depreciation figure is 1 lakh 25, which is the cost of the machine. Whether paid, not paid does not matter. 1 lakh 25. What is the salvage value of the machine? 30,000. 5 years. From the amount, I have to remove the depreciation quantum. I have to remove the depreciation quantum. Can I subtract the entire amount? Yes, we did in that earlier question, and we called it as PBT. Here, I don't want to call it as PBT because PBT is sufficient for me. Taxes are not there in the question. Income tax, we are going to ignore it. How much is this fixed cost figure? 21,000. Removing the depreciation quantum, 21,000. If you want, you can assume a tax rate and proceed also, or write a note saying that taxes are ignored. One of the two. You have to write a note. Taxes ignored or assume a tax rate. Any doubts on this? What's the next item we have? Sales promotion. And this is the reason why we have separate calculation. Sales promotion. How much? Sorry? 10,000 and PBDT slash cash flow. PBDT slash cash flow. I'll not use the word after tax, but cash flow. PBDT, I can even say CFAT, that's okay. PBDT slash cash flow. Profit before depreciation and taxes slash cash flow. Tell me the year 1 figure. 31,500. Year 2. Year 3 to 5. Any doubts till this? Again, step by step, if you follow, you will get the answer. That's why I have given standard formats. I have not deviated the format in the question till now. Any doubts on this? After this, 4 balance sheet item can come. Purchase of additional machine, not there. Increase working capital, not there. Decrease is not there, but there is a payment pending. There is a payment pending. Original machine you did not pay fully. Original machine we did not pay fully. We are yet to pay one amount. Less payment for original machine. 80% paid initially. When did we pay 20%? Balance 20%. At the End of first year. End of first year. Payment for original machine 1,25,000 into 20%. We did not pay this 20%. We are paying now. First year. We are paying this in the first year. Format driven chapter. As long as you are clear in the calculation, you will keep getting the answer. Any doubts on this? Revised cash flow. Revised cash flow 6,500, 26,500, 41,500 for third year, fourth year, fifth year. 6,500, 26,500 and 41,500. Any doubts on this? Clear? Can we proceed? Working note 3. Working note 3, terminal flow, particulars and amount. Any doubts till this? Anybody has any doubts in the calculation we have done? Any doubts in the computation? Can we proceed? Now listen. Is there an income tax in this question? No. So no NSV calculation. Sale value is NSV because tax anyway can't come. And even if it was there, I would have done comparison. But okay, here no comparison, nothing. Just directly sale value is NSV. Sale value is directly net salvage value. No concept of income tax in this question. So sale value. That's all. Sale value is direct answer. How much is the sale value? 30,000. This is my terminal inflow. Okay. No recapture of working capital. No recapture of working capital. Problem is over. You need to consolidate, calculate NPV. Calculate NPV. Consolidate and calculate NPV. Any doubts on this? Any doubts on the calculation here? No recapture of working capital. No NSV computation because taxes are not there. Income tax is not there in the question. If there it was there, then I'll do sale value, book value, capital gain, capital loss, tax paid, tax saved, and all the calculation. 3 minutes for you. Complete NPV. 3 minutes. Complete NPV. Let's quickly discuss the answer. What is year 0 outflow? 1 lakh. Year 1, 6,500. Year 2, 26,500. Year 3, 41,500. 41,500 and 71,500. What is the discount rate? 10%. This is your NPV answer, 31,712. NPV answer is 31,712. We'll have to calculate and then finally say that yes, we can go ahead with the project as it generates positive NPV. Important part is income tax is ignored in the calculation. Even if it is a WDV method and says income tax is ignored, it becomes very simple because no depreciation is to be calculated itself. Any doubts on this? Clear? Okay, let's take a break of 10 minutes. Okay, let's continue now. We'll move to question 22. Navjeevan Hospital is considering to purchase a machine for medical projectional radiography, which is priced at rupees 2 lakh. The life of the machine is 8 years, salvage value 18,000, annual operating cost 22,500, revenue 120. Presently, the hospital is earning outsourcing the radiography work to its neighbor test center, earning commission income of 36,000 per annum net of taxes. Consider tax at 30%. Analyze whether it will be profitable. Give your recommendation under NPV method and profitability index method. Go through the question, then I'll start explaining. Okay. Again, we have to decide whether a machine is to be purchased or not. First line says, I'm going to buy a machine which is priced as 2 lakh. Where will this come? Initial outflow. Life is 8 years. This is for in between flow and depreciation computation. Salvage value is 18,000. Cost minus salvage value divided by life is depreciation. Cost is 22,500. Where will this 22,500 go? In between flow. Expenses. Revenue of 1,20,000 per year for 8 years. This will also go to in between flow. Presently, the hospital is outsourcing the radiography work to its neighbor test center and earning a commission income how much? Per annum net of. So this 36,000 is after tax. This 36,000 is after tax. I can convert this to pre-tax if I want, or I can leave it as after tax itself. What is this item nature? What is it? Is an opportunity cost, and the opportunity cost is given after tax. So we'll consider it after PAT calculation. We had explained in the concept opportunity cost before tax they give in PBT, after tax they give after PAT is calculated. So every year same number, calculation will not be that heavy. Let's start doing it. Step 1, working note 1, initial outflow. Working note 1, initial outflow. Particulars and amount. Initial outflow. The only adjustment we are discussing here is the opportunity cost. That's the reason we are doing this question. Capital expenditure. I'll not write working capital if it's not there. That's all. If it's there, we'll write, else ignore it. Capital expenditure. How much the capital expenditure? 2 lakhs. Working note 2, in between flow. In between flow. Particulars and amount. How many years is the project? Amount in bracket. Year 1 to year 8. Same calculation. Year 1 to year 8. Same calculation. Amount year 1 to year 8. Same computation. Same calculation for all the 8 years. Revenues. How much the revenues? 1 lakh 20. Revenues 1 lakh 20. Less revenues 1 lakh 20 less operating cost. Operating cost. How much operating expenses? 22,500. Operating cost 22,500. Operating cost 22,500 less depreciation. Depreciation, cost minus salvage value divided by life. How much the cost? 2 lakh. Salvage value? How many years? 8 years. Tell me the amount. 23? Okay, 22? 750. Less depreciation, 22,750. Opportunity cost, that is commission income. We were earlier getting some commission income. Now we will not get that commission income. That is an opportunity cost. This is post tax. It is a post tax. So we will do after PAT. Profit before tax. Deduct all of this and tell me profit before tax. 74, 750 less tax. What is the tax rate? At 30%. 22, 425. 52, 325. Profit after tax 52, 325. PAT 52,325. PAT number 52,325. Any doubts on this? Any doubts on the profit after tax? Can we proceed? Add depreciation. Add depreciation. How much? And less commission after PAT. After PAT. Commission opportunity cost. I lose this commission income now. I lose this commission income. Earlier, hospital was telling it to do it in a nearby center, and they were paying me commission of 36,000 every year. Now I will lose this commission, because if I put up my own that radiography machine, obviously I will not be given any commission. Why will that lab center give me commission? Commission loss 36,000 minus cash flow after tax 39. Any doubts on this? This was the only adjustment why we did this question. Okay, 1 to 8 years 39,075. 1 to 8 years 39,075 is the amount we will get. Any doubts on this? Can we proceed? Any doubts? Clear? Working note 3, terminal inflow. Terminal inflow, particulars amount, NSV, sale value, NSV, sale value. What is the sale value of the machine? 18,000. Book value. Again, I'm repeating this part. You can do it in your calculator also. If you see both same, no need to write the detail number. In class, I'm doing it. If the sale value and book value is same, no need to do calculation. Sale value is NSV. Book values, what is the cost of the machine? Like how much depreciation we charged? 22 for 8 years. You will get the same number. NSV is 18,000. Sale value, book value same. NSV is equal to sale value. If the sale value and book value is same, NSV is equal to sale value. That computation itself is not needed. Any doubts on this? Any doubts on this calculation? Can we proceed? Any doubts? Capital gain 0, tax paid 0, and NSV 18,000. NSV is 18,000. Any doubts on this? No recapture of working capital, all that will not come. Any doubts on this? Working note 4, computation of NPV and profitability index. NPV and profitability index, year cash flow PV of DCF, year cash flow. What is the discount rate given? Sorry? Okay, no discount rate given. I have no choice. I'll have to assume a discount rate. I'll have to assume a discount rate. They have told us to evaluate the proposal using NPV method and profitability index method. I'll have to assume a discount rate. PVF at 10%. I don't know what is there in the answer. Let us assume. Let us assume cost of capital be 10%. Let us assume cost of capital to be 10%. PVF at 10%. DCF. Can I take any other number? Yes, you can go ahead and take any number. PVF at 10%, DCF. Year 0, 1 to 8 together, and year 8 separately one more number. 1 to 8 together is called annuity, and year 8 separately another number. Year 0, 1 to 8, and 8th year. Year 0, 1 to 8, and 8th year. How much is year 0? 2 lakh. 1 to 8 was 39, 75. 075, and extra 18,000. 1 divided by 1.1 equal to 4th, 5th, 6th, 7th, 8th. Before you press the GT button, write the 8th year factor here. 0.467. If you press the GT button, then you have to again repeat it. Before you press the GT button, write the 8th year factor. 0.467, and then press the GT button. 5. 335. Before you press the GT button, please write the 8th year factor and then press the GT button. We'll complete NPV and PI both in this itself. We have assumed a discount rate, not sure what is there in the answer, but we have assumed something and proceed. 16,871 and PI is 216,871 by 2 lakh. 1.0844 times. 0844 times. Any doubts on this? This question, two things. One is that opportunity cost. Second is if cost of capital is not given, how will you handle it in exam? This was an exam question where they did not give. They did not give the cost of capital. We'll have to assume a cost of capital and proceed it. Any doubts on this? Recommendation, you can finally write the company can go ahead with the project. Company can go ahead with the project. Yeah, same 10% only I have taken. Company can go ahead with the project. You write a conclusion. Company can go ahead with the project as the NPV is positive, PI is greater than 1. Profitability index we want greater than 1 and NPV we want positive. Any doubts on this? Can we proceed? Okay, let's come to question 23. It's a little bit different question. Linty Limited, a small sized firm manufacturing company. Its manufacturing plant is situated in Chhattisgarh. Currently, it is labor oriented, due to which there is less production, delay in deliveries, more defect in production. Management is considering the proposal to purchase a new automatic machine which will carry out some operation which at present are performed by manual labor. Two models are available in the market, TMT1 and TMT2. If machine is replaced, it would provide labor saving, reduce the defect as well, have an economic life of 10 years. Only one information relevant, life is 10 years of these two new machine. We are going to buy two new machine, TMT1 and TMT2, life is 10 years. Cost of machine will come in which step? Initial outflow. Saving in direct wages will come where? In between flow, inflow item. It is an inflow item. Savings in direct wages is an inflow item in step 2. Inflow item in step 2. Saving in scrap, inflow item. This is not residual value. This is scrap which is in the manufacturing process. In cost sheet, you would have learned something called as credit for recoveries or scrap. So saving in scrap is also inflow. Additional cost of indirect material, what should I do? It is an expense in that. See, the format said incremental revenue, incremental cost saving, less all cost other than depreciation. So in that, one of the cost is indirect material, another cost is indirect labor, another cost is repairs and maintenance, another cost is depreciation. Another cost is depreciation. You will get profit before tax, less tax, profit after tax, add back depreciation, cash flow after tax, add back depreciation, cash flow after. So this is inflow, inflow, outflow, 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 depreciation, PBT. This is a cost reduction problem. This is a cost reduction problem. PBT. Good part, it is straight line method. 1 year calculation is same for all the 10 years. 1 year calculation same for all the 10 years. Company is in 35% tax bracket, rate of return. What is the annual saving from TMT1 and annual saving from TMT2. The saving can be understood as profit after tax. How much extra profit is an organization making after meeting all their expenses? What are the expenses? Some indirect material, some indirect labor, some repairs and maintenance, some depreciation. After all of that, there will be some saving. So, what is the annual saving from TMT1 and annual saving from TMT2? Then there was payback period for TMT1 and TMT2. Look at this data and tell me, should you do both machine or one machine is sufficient? Both are one. You should do machine 1. You should not do machine 2. Machine 2 has two same answer, 4.42, 4.42. 4.42 and 4.42. Machine 1, 3.6, 4.25, 4.63, 4.55. Once machine 1 is completed, you can put a tick mark and proceed it. Machine 2, no need to do unless you get confused in machine 1 calculation. ARR, should you do one machine, both machine? Either of the machine can be done. We will do machine 1. We will do machine 1. Profitability index, again machine 1. So machine 1 alone is sufficient. Machine 2 has only one reason. The reason is annual saving from TMT2. In class, obviously, I'll do everything. But in an exam scenario, you will not do TMT2 after that profit is calculated. No calculation of payback, no calculation of accounting rate of return, no calculation of profitability index. None of them we will have to do it for the machine TMT2. Able to understand the question? Because in MCQ based, I am able to eliminate some of the requirements. Clear? Working note 1, initial outflow. Working note 1, initial outflow. Particulars and two machines. TMT1, TMT2. If it comes in exam, you need not even write stepwise and all, because it is going to be an MCQ question. The step doesn't serve much purpose. I wanted a formal structure. That is why I do step 1, step 2, step 3. This ensures that we don't miss out anything. I say it doesn't do step 1, step 2, step 3. They'll directly do step 2 and directly step 4. Many a times they don't do step 1, step 3 and all. They'll directly write step 2, step 4. This is just a structure to remember everything. Capital expenditure. Read the question and tell me the figure. Negative 45, negative 50. Clear? Working note 2. In between flow. In between flow. Again, particulars and two machine. In between flow, particulars and two machine. We start with inflow items and then write the outflow item. Saving in cost is inflow, extra cost is outflow. What's the first item? Saving in wages. Saving in wages. This is exactly same as one problem we did in the previous session where there was that automation to be done. So there that manual labor was getting saved. Saving in wages. How much TMT1? 15 lakh. TMT2? 20 lakh. 15 and 20. Saving in wages 15 and 20. Then we have saving in scrap 5 lakh and 6 lakh. What's the next item? Indirect material cost, indirect labor cost, repairs and maintenance cost. All these are expenses. All these are expenses. Less indirect material. Indirect material. Indirect material. How much is the indirect material? 2 lakh. Indirect material 2 lakh. Next, indirect labor. How much? 150 and 180. Indirect labor 150 and 180. 1,50,000 and 1,80,000. Then repairs and maintenance. How much? 4 lakh and 8 lakh. Again, this is there in that format itself. The format said incremental revenue, incremental saving, less all cost other than depreciation. We don't write PBDT, less depreciation, unless they ask PBDT specific requirement. Less depreciation, depreciation, less depreciation. Is there any salvage value given in the question? 45 lakh by 10, 50 lakh by 10. 10 years, less depreciation. How much? 4 lakh 50 and 5 lakh. 4 lakh 50 and 5 lakh. Any doubts on this? Depreciation 450 and 5 lakhs. 10 years life 450 and 5 lakhs. What's the item we get? What is it called? Profit before tax. Profit before tax. Tell me the number. Sorry? 8 lakh and less tax. Profit after tax. Less tax. Profit after tax. What's the tax rate given? 35%. Calculate. 280. 3 lakh. Machine 2 itself I would not have done if the separate MCQ was not there. There was a separate MCQ for machine 2. Else we wouldn't do machine 2 itself. If that asked cash flow of TMT1 and TMT2 as a one single MCQ, that also would have got eliminated. Profit after tax. How much? 5 lakh 20 and 5 lakh 98. This should be MCQ1 and MCQ2. What is the annual saving from TMT1? 5 lakh 20,000. TMT2 5 lakh 98,000. 520 and 592. Add back depreciation. Cash flow after tax. Add back depreciation. Cash flow after tax. Add back depreciation. Cash flow after tax. Depreciation is 450 lakh. CFAT is 970 1098. Any doubts on this? Any doubts on this? Clear? Any doubts on this? Can we proceed? Okay, terminal flow we are not doing it. I'm asking you some question. You tell me and then I'll do it. What is the sale value for the terminal flow? 0. Book value is also 0. Reason is we have depreciated fully. 4 lakh 50 into 10, 5 lakh into 10. No terminal flow calculation. Not even writing it. Not even writing it. Now, what I want you to do is only TMT1. Payback. Accounting average. Average means denominator take average investment. Denominator take average investment and profitability index. Payback will need year, cash flow, cumulative cash flow. Do payback separately, okay? Accounting rate of return, average profit. 1 year profit is average profit. Divide by average investment. Divide by average investment. PI, you can directly write PV of inflow by PV of outflow. PV of inflow is every year into the annuity factor. Every year into the annuity factor divided by PV of outflow. Or you want to do it in the table format, then write year, cash flow, PV of, DC of, year 0 outflow, 1 to 10 together. Don't try to do payback and this together because payback you will have to write 1, 2, 3, 4, 5, 6, 7 separately. In this, you need not write it separately. PI part separate calculation is not needed. So do only machine 1. Okay, do only machine 1. We are not doing machine 2. You are not going to do machine 2. Even in class, I don't want you to do machine 2. Printed answer has it. Around 6 to 7 minutes for you. Payback, ARR and profitability index. 6 to 7 minutes for you. Okay, coming to the payback part, year cash flow, cumulative cash flow, year 0, what is the outflow? 45 lakhs. How much is the first year inflow? 9 lakh 70,000. Year 2, 970. Year 3, 970. It will go on like this. We start with negative 45, becomes negative 35, negative 25, negative 15. Year 4, negative 6. Year 5, I stop at this. That's all. Because moment it becomes positive, it is sufficient. Beyond that, payback, whatever you do has no utility. Beyond this, whatever you do has no utility. Anyway, it's an MCQ based question, and even in exam, I can stop at this stage because beyond this, it has no utility. Beyond this, whatever cash flow, because our formula is what? Base year. Base year is what? 4 plus 6 lakh 20 divided by 970. 620 divided by 970. Answer is 4.63. It will be there in the choices. 4.64 or 63, whatever is there in the choices. 4.63. Other one has to be 4.55. Other one has to be 4.55. Now listen, this also is not needed. There's another shortcut, which is if you get same amount every year. If you get same amount every year, logical. 45 lakh divided by 9 lakh 70 is directly payback. Every year I am getting 9 lakh 70. Amount invested is 45 lakh. Directly I can give the answer. Payback is 4.64. Direct answer 4.64. 45 lakh divided by 9 lakh 70. I did not say the answer purposely. I wanted you to do and then give the formula. So amount invested, in the solution I have done this only. Amount invested divided by the cash flow. Divided by the cash flow. So if you look at the solution, it is presented that way. Cost of project, annual saving, payback A by B 4.64. 4.64 is the saving. Any doubts on this? Any doubts on this? The number of years? Clear? Accounting rate of return is average profit. What was the profit figure we got? 5 lakh 20 divided by average investment. Average investment is opening by closing by 2. 45 lakh plus 0 by 2. 22 lakh 50,000, which is 23.11%. 23.11%. In case that answer is not there, then you may do by initial investment also, because the word average is used. They would have done average investment. We are not even doing the other project. We are not even doing, I'm not even discussing other project. I don't want to even discuss the other project. Then PI part, PV of inflow divided by PV of outflow. Inflow is 9 lakh 70 into present value annuity factor 10 years, and what is the rate of interest they've given? 10 years and 15% divided by 45 lakh. Can I do it in the table? Yes, you can do it in the table also. This I feel saves time, but it's up to you. So 1 divided by 1.15, 10 times you have to, you get the number as 5.9 lakh 70 into 5.019 divided by 45 lakh. Increase, decrease, decimal and all, no problem, because in the MCQ option we'll choose 970 into 5.019, which is some 4868 some number, divided by 45 lakh, which is 1.08. Other one not needed. The other project we need not even do. Clear? We are just closing this calculation with one project. In the printed, both are there, but with one project we are able to get to the solution, able to understand this. Any doubts on this? Any doubts on this? So this is also a question around your cost reduction. Whatever problems we have done, every question we have just followed a standardized format. That's the only thing I can say you. Standardized format. This chapter will take a lot of time. But ideally, in your revision phase, you should solve very less questions and focus more on the concept part, how every concept works, how every MCQ is going to work. Clear? Any doubts on this? Done? We'll take a break now. We'll resume at 10 o'clock. Okay, let's continue with the discussion. Now onwards, we are going to see some of the lengthy problems. Some questions we will do it together. Some questions I'll do only in Excel. You will not be even doing it. You will only be in listen mode because the calculation can go for many number of years and will be unnecessarily your focus will be on the computation. This question we will do it together. Let me first read it, then I'll give you time and then I explain. A large profit making company is considering installation of a machine to process the waste produced by one of the manufacturing process to be converted into a marketable product. At present, waste is removed by a contractor for disposal on payment by the company of 150 lakh per annum for the next 4 years. Contract can be terminated upon installation of the new machine on payment of a compensation of 90 lakh. Compensation is not allowed as a deduction for tax purposes. Basic background here, some waste processing is happening. As of now, the disposal of waste is done by a contractor and I need to pay him 150 lakhs per year next 4 years. I can cancel the contract, but for cancellation I have to pay a penalty of 90 lakh, and this penalty no tax benefit on that amount which we are paying. Machine required for carrying out the processing will cost 600 lakh. At the end of 4th year, machine can be sold for 60 lakh. Cost of dismantling and removal will be 45. Sales direct cost data is given. Sales is given. Material, wages, other expenses, factory overheads, depreciation as per income tax rule. All this information is given. Initial stock of material required before commencement is 60. Stock to be maintained at the end of year 1, 2, 3, 165. Year 4 is nil. Storage will utilize space which could have been rent out for 30 lakh. Labor costs include wages of 40 people whose transfer to this process will reduce idle time payment by 45 lakh and 30 lakh. Factory overheads include apportionment of general factory overhead except to the extent of insurance charges of some 90 lakh. Company's tax rate is 30%. Cost of capital is 40. Ignore tax on capital gain. Ignore tax on capital gain. So no NSV computation. Sale value is NSV. Sale value is NSV because ignore tax is there, but on capital gain, ignore it. Advise the management on the desirability of installing the machine for processing the waste. Go through the question, then I'll start explaining again. You go through the question. Okay, let's go one by one. Initial para, this 150 lakh per annum for the next 4 years is the payment I make to the contractor. What is the use of this information? Where should I consider this information? Step 2, what should I do? Cost, saving in cost. This will be considered as saving in cost. Why saving in cost? Because I am going to install a machine. Moment I install the machine, I'll tell contractor you are not needed. If the contractor is not needed, I will save 150 lakh per year. But for that I have to pay how much? When should I pay? Year 0 itself. So this is part of initial outflow. Part of initial outflow before the processing operation starts. So year 0 will have an outflow of 90 lakh. Normally we have capital expenditure, working capital. This question, third item will come compensation. Then where should I take the 600 lakh? Participate. I want participation. Where is 600? Step 1. Machine can be sold for 60 lakh. Dismantling 45 lakh. What is the use of dismantling then? Sold for 60, dismantling 45. Net salvage value is not net sale value. Sale value itself is only 15. Sale value itself is only 15. Why 15? You're selling it for 60, but dismantling cost 45. So sale value itself is 15. This sale value we compare with book value and other things. That's not needed because ignore tax on capital gain. It's not net sale value. Sale net salvage value. Net sale value itself is 15 only. It is only 15. Sales as it is. Material consumption as it is. Wages, there is some extra information I have to consider. Other expenses as it is. Factory overhead, some extra information is there. depreciation as it is. Initial stock of material before commencement is 60 lakh. What is the 60 lakh? What is this? Working capital. Stock of raw material is 60 lakh when? Start of year 1. Start of year 1 is year 0. Year 0. This 60 lakh will become how much? Stock level to be maintained at the end of year 1 is how much? 60 will become 165 in year 1. 60 will become 165 in year 1. Increase in working capital. 165 will remain 165 in year 2. No change. 165 will remain 165 in year 3. No change. 165 will become 0. Recapture of working capital. Recapture of working capital. In working capital, in the concept, we learned this. Initial working capital 60. Increase in working capital 60 becoming 165. No decrease. Final recapture. Final recapture. 60, 165, remain 165, remain 165, becomes 0. Becomes 0. 0 is basically recapture of working capital. Then storage of the material will utilize space which could have been rent out for 30 lakh per annum. What is the use of this? Opportunity cost. Is it after tax, before tax? Anything mentioned? Anything mentioned there? So before tax. This is before tax. Labor cost include wages of 40 people whose transfer to this process will reduce idle time payment of 45 lakh in year 1 and 30 lakh in year 2. Any idea what this could mean? Sorry? You'll have to be a little louder. Savings in wage, not technique. What happened here is, I am going to pay this 225, 225, 225, 300. But because of this, I will save some idle time payment. How much is the idle time payment? 45 lakh in the year 1 and 30 lakh in the year 2. It says labor costs include wages of 40 people. In this 225 lakh, whatever figure you see, wages of 40 people are there. How much you were paying them? 45 lakh in year 1, 30 lakh in year 2. What were they doing? They were remaining idle. They were remaining idle. So now indirectly by employing them, I don't incur any extra cost. So that idle time is a saving here. Out of the 225, 45 anyway I would have paid. 45 anyway I would have paid. What is that 45? Idle time payment. So the employees are there in the factory. They were not doing any work. They were not doing any work. So earlier you were paying them 45 lakh without work. Now you are going to pay 45 lakh and make them work also. Make them work also. This 225 includes that 45. This 225 includes that 45. That 45 is technically an irrelevant cost. Reason is it is a committed cost. What is committed cost is whether those work is happening or not happening, you have to pay the employees. Bharadwaj Institute, we are doing an evening class. Rent is a committed cost. Whether evening batch happens or does not happen, rent has to be paid by us. So rent is an irrelevant cost for evening batch. Rent is an irrelevant cost for doing evening batch. So out of this 225, 225, 255, 300, we will have to remove this wages for this 40 people. Wages for the 40 people will have to be removed. Why are we removing? That anyway would have been incurred. That anyway would have been incurred. Are we incurring anything additional? Yes, additional is the balance. Additional is the balance. This 40 people wages will be ignored in our analysis because it is a committed cost. What is committed cost is anyway you would have paid it. Anyway you would have paid it. Clear? Any doubts on this? Factory overheads include apportionment of general factory overhead. Till this if I read, include apportionment of general factory overhead. Concept said apportioned, general, corporate, irrelevant, specific, incremental, relevant. What it said is factory overheads include apportionment of general factory overhead, fully irrelevant, except to the extent of how much? 90 lakh per annum payable on this venture. This 90 lakh alone is relevant because this 90 lakh is payable for this venture. Question could have said factory overheads include general factory overhead of 100 lakh. From that table, remove 100, 100, 100, 100. 100 is irrelevant. 100 is irrelevant. What they said is factory overhead include apportionment of general factory overhead except to the extent of how much? 90 lakh per annum payable on this venture. Whatever is payable on this venture is relevant. Whatever is otherwise is irrelevant. If they had not given any note, entire factory overhead is relevant. If they don't give me any note, entire amount is relevant. Clear? Now let's start. Working note 1. Initial outflow. Working note 1. Initial outflow. We'll do this question together. It's a very lengthy problem. Initial outflow. Particulars amount. Initial outflow. Capital expenditure. Amount in bracket in lakhs. Capital expenditure. How much the capital expenditure of the project? Minus 600. Capital expenditure 600. Working capital in bracket stock of material. We need some stock of material. It is at different places. Please read and tell me what is the stock of material I need. I want participation. Everything is explained. Now you will have to participate. 60 lakh minus 60. Minus 60. Compensation paid. Compensation paid. We have to pay some compensation before we start the project. How much compensation? 90. Listen, it says no tax benefit. If there was a tax benefit on this, no, our expenses interest after tax, compensation after tax, compensation into 1 minus tax rate, compensation into 1 minus tax rate. But they have very clearly said no benefit of tax here. Any doubts on this? Initial outflow. Initial outflow 750. 750 lakhs is what I'm going to pay on day 0. Working note 2. In between flow, particulars in 4 years. The amounts are different for each of the year. In between flows, particulars and 4 years. Particulars and 4 years. Our format of computation when we did initially said there are two items of inflow: revenue, cost saving. Revenue and cost saving. Then a lot of expenses can come. PBDT can come. Even if you did a depreciation, PBT come. Then you will complete it. So first is sales. Sales. How much is the sales of this project? 966, 966, 1254, 1254. Clear? Saving in disposal cost. Saving in disposal cost. We are not going to dispose the waste now. I don't need a contractor and I don't need to pay him. How much we were paying him every year? 150 lakh per annum for the next 4 years. So I will save this money now. So that we paid some compensation, that's okay. 150. Saving in disposal cost 150. We are going to save 150 lakhs every year. 150 lakhs will be saved every year. Any doubts on this? Can we proceed? Then in this table, any extra information for material consumption? No. Good part they use the word material consumption. If they use the word material purchase, then you have to do opening stock plus purchase minus closing stock. And they have given stock information. They have given stock information, but they did not give the purchase data. They gave the consumption data. Consumption goes to P&L. Purchase also goes to P&L. Then you have to do opening stock, closing stock. So here consumption means directly we write it. If it was purchase, opening stock plus purchase minus closing stock is consumption. Less material consumed. less material consumed. Direct figure. Material consumed 90, 120, 255 and again 255. Material consumed 90, 120, 255 and 255. Any doubts on this? Clear? Can we proceed? Then they have said wages, but wages extra information is there. Wages include salary of that 40 worker. Labor costs include wages of 40 worker. Whatever you pay to this 40 worker is like rent example for Bharadwaj Institute for evening classes. If I take evening classes, accounting will say rent 5,000 rupees. Logic will say no extra rent cost. Logic will say no extra rent cost. So out of this 225, whatever you are going to pay to this 40 people, you would have paid even without doing work, or you would have paid by doing work. So they're saying it includes wages of 40 people whose transfer will reduce idle time payment by how much? 45 lakh in the year 1 and 30 lakh in year 2. In year 1 and year 2, year 3, 4, maybe they are having work. I don't know what is the information. But in the first and second year, whatever we are paying is including that idle time payment, which anyway would have been done. So 45 has to be removed from 225 and 30 has to be removed from 225. Or as she said, you consider it as a cost saving. Cost saving means you write inflow. We are now doing lower outflow. Both are same. Either you consider it as an inflow or consider a lower outflow. Technically both are same. Technically both are same. Wage cost, less wage cost, 225 minus how much was the idle time payment? 45 and 225 minus 30, others as it is. 180, 195, others as it is. Only for the first and second year there is some reduction. 185, 195, 180, 195, 255, 300. Any doubts on this? I'll repeat again. First and second year, there are some 40 people who are not doing any work in the organization, but still I have to pay them salary. So I smartly moved them from idle time and made them work and pay nothing extra. Pay nothing extra. So in that 225, we are removing the committed cost. We are removing the committed cost. Any doubts on this? Clear? What's the next item? In the table, other expenses. Any extra information on other expenses? So deduct as it is, less other expenses. Subtract that amount as it is. Other expenses 120, 135, 162, 210. No workings, nothing, just directly subtract it. 120, 135, 162 and 210. Clear? What's the next item? Is there any extra information on factory overhead? Yes, they have said. If you tell me factory overhead include apportionment of general factory overhead and end it, amount is zero. Amount is zero. If it's only general factory overhead, amount is zero. Then they're saying except to the extent of insurance charges of 90 lakh per annum payable on this venture. So factory overhead in bracket specific. Specific means for this project 90 lakh. For this project is 90 lakh. We are not bothered about the other expenses. Specific to this project is 90 lakh. Clear? Specific to this project is 90 lakh. Before I write depreciation, there is one more expense in the question. It's not there in the table, it's there below. What is that expense? Which one? Loss in rent. Loss in rent. They are saying storage of material will utilize space which could have been rented out for 30 lakh per annum. less loss in rent, opportunity cost. Loss in rent. We are losing rent. Loss in rent 30. Any doubts on this? There's a loss which is happening on the rent side. Clear? This stage is called PBDT. This stage is called PBDT. We are not writing PBDT. Less depreciation given in the question. We need not do any calculation. What is the depreciation? 150, 114, 84, 63. Any doubts till this? Any doubts till depreciation? Any doubts till depreciation? Okay, beyond this, I don't want you to waste time on calculation. You please copy paste these numbers. This is, just give me a minute. This is your PBT number. You can copy paste. I don't want to do calculation at all. Profit before tax 456, 432, 528, 456. It will take you maybe a minute to do every, maybe 2 minutes will get wasted there. I don't want to do anything there. PBT, I'll not spend time on the calculations. I'll spend time more on the logic. PBT number you can copy paste 456, 432, 528 and 456. Profit before tax 456, 432, 828, 456. If you do calculation, obviously you will get these numbers. Any doubts on this? Less was the tax rate at 30% too. Profit after tax. These are usual calculation. I don't want to spend time there. I'll explain working capital part then. You can copy paste the number from the screen or do calculation. That's your wish. Doesn't matter. Any doubts till PAT? Can we proceed? Any doubts on this? Done. Anybody has any doubts on this? Add depreciation. Add depreciation 150, 114, 84, 63 and then wait. Add depreciation. Can you proceed? Okay. What was the raw material they're talking about in the question? Initially, how much? Initially, 60 lakh. And it will increase to how much? 165 lakh by when? Year. So it is like this. I start on year 0. Year 0 itself, I touch 60 lakh. Year 0 itself, I touch 60 lakh. I touch 60 lakh in year 0. Then it increases to 165 in year 1. At the end of year 1, it becomes 165. Remains 165 for year 2, year 3 and becomes 0 by year 4. So 60 becoming 165 will be recorded in cash flow. 165 remaining 165, no impact. 165 remaining 165, no impact. Year 4, you can either call it as recapture of working capital in step 3 or you can also call it as decrease in working capital in step 2. Both will be same only because you are going to write it in the 4th year. Whether you write it in step 2 or step 3 does not matter. That recapture part, some students used to write it in step 2 in this question. You write it in step 2 or step 3 does not really matter. Now after this, less Increase in working capital. Increase in working capital. From 60 it became 165. From 60 it became 165. 105. Clear? 0, 0, no change. If I want fourth year, I can write another line item called decrease in working capital or recapture of working capital. I don't want to write it here. I can write it in step 3. Either place you write, effect is same. Whether you write it in step 2 or step 3 does not really matter. Any doubts on this? Any doubts on this part? Clear? Get me the CFAT number. Cash flow after tax. Four, 453.6, 382. Any doubts on this? Any doubts in this? Okay. Because a lot of adjustments were there, I give you a minute or two, go through workings till now, and then I do the step 3. 2 minutes for you. You go through the workings. Anywhere there are doubts, you can let me know. Okay. I proceed to working note 3, which is terminal flow. Particulars amount. Terminal flow. Particulars amount. First is sale value. Sale value of machine. No NSV calculation. Sale value of machine. We are going to sell it for how much? 60, but there's a cost of removal of how much? So 60 minus 45 is what I'll get. 15. Sale value of machine 15. I'll be getting 15 lakh rupees by selling the machine. I'll be getting 15 lakh rupees by selling the machine. Any doubts on this? Recapture of working capital. Recapture of working capital. 60 was stuck initially. Another 105 was stuck in year 1. All put together 165 will come back. Can I write this 165 in step 2? Yes, you can write there also. Wouldn't make any difference. Increase in working capital, decrease in working capital. Total terminal inflow 180. Total terminal inflow 180. Any doubts on this? Clear? Able to understand this? We are not doing NPV calculation. You are also not doing it. You will consolidate, calculate NPV. I don't want to do it. I don't want to discuss also. Any doubts on the question? Any doubts on the question? Add lot of adjustments. So ultimately, you will put it in this format. This is what your notebook would have given: 750, then 364, 416, 453. Last year 382 plus 180. No capital gain computation. None of them is needed in the question because question said ignore tax on capital gain. Any doubts on this? Any doubts on the question? A slightly lengthier problem. Good adjustments were there. Any doubts on this? Can we proceed? Let's come to 26. Again, a little lengthier problem. Question 26. Manoranjan Limited is a news broadcasting channel having its broadcasting center in Mumbai. There are total 200 employees in the organization, including top management. As a part of the employee benefit expense, company serves tea or coffee to its employees, which is outsourced from a third party. Company offers tea or coffee 3 times a day to each of its employee. All are very relevant information. 3 times a day. 120 employees prefer tea all 3 times. 40 employees prefer coffee all 3 times. Remaining prefer tea only once in a day. Out of the 200 employee, 120 people want 3 times tea, 40 people want 3 times coffee, and the remaining 40 people only once tea. Third party charges 10 rupees for tea and 15 rupees for coffee, and the company works for. Now this entire information will tell me how much is the tea cost and coffee cost today. How much is the cost of tea and coffee today, and that will become cost saving. You will understand as we proceed. That will become a saving. Looking at the substantial amount of expenditure on tea and coffee, finance department has proposed to the management for installation of a tea and coffee vending machine. Tea and coffee vending machine, which will cost how much? 10 lakh is which step it will go? Step 1 with a life of 5 years. If you install this machine, you will save 120 employees into 3 times, 40 employees into 3 times, 40 employee into 1 time. For tea you will have to multiply with 10 rupees, for coffee you have to multiply with 15 rupees. This is 1 day saving. Like that 200 days you will save. Like that 200 days you will save. We'll do the detailed calculation. Upon purchasing the machine, company will have to enter into an AMC, which will require a payment of how much? 75,000 every year. What is this item 75,000 called? Step 2, your expenses. Machine will require electricity consumption of 500 units per month. 500 units per month, and current incremental cost of electricity is 12 per unit. So 500 into 12 is the electricity cost into number of months. Then packet of coffee bean, tea powder, because we are going to now do coffee and tea. For that you are going to incur coffee bean cost, tea powder cost, sugar cost, milk cost, paper cup cost. These 5 costs I have to do calculation. This entire working will be more like cost accounting rather than financial management. Your grip on cost accounting will get tested here. Each packet of coffee bean will produce 200 cups of coffee. Same goes for tea powder. What is the use of this? This will tell me how many packets of coffee bean will be needed and how many packets of tea powder will be needed. One packet will give 200 cups of coffee and 200 cups of tea. Each cup of tea or coffee will need 10 gram of sugar and 100 ml of milk. Company anticipates that due to ready availability of tea and coffee through vending machine, employee will end up consuming more tea and coffee. Employee will end up consuming more tea and coffee. Earlier, available only 3 times a day, so people were consuming only 3 times. Now it is readily available. It's an estimation. Consumption will increase by how much? 20%. So my cost I will incur for extra 20%. Cost I'll incur. Saving is only original cost only. Saving, you cannot say that you will save more money, because if you had continued doing what you were doing, people would have consumed only 3 times. Now there is a 20% extra consumption. Also, paper cup consumption will be 10% more than the cup served due to leakages in them. So leakage issue. 25% tax bracket, current cost of capital, straight line method. We are required to advise on the feasibility of acquiring the machine. Major computation will be step 2, where lot of cost accounting angle will come into picture. Go through the question. Okay, let's start doing it. We'll put it in our usual format: step 1, step 2, and step 3. That will give us the answer. Step 1, initial outflow. Working note 1, initial outflow. Initial outflow, particulars and amount. Initial outflow, particulars and amount. Particulars and amount. Look at the question and tell me capital expenditure. Capital expenditure is 10 lakh. Capital expenditure is 10 lakh. No working capital, all that is not there. Initial outflow 10 lakh. Now this is a perfect question on cost reduction. no revenue angle. We are just going to buy a coffee vending machine. Because of that machine we are going to save cost. Perfect question on cost reduction. Working note 2, in between flow. Good part, no changes in cost, same amount every year. SLM method, and there are no changes in the cost, nothing they have done. So at least that headache is not there. We are going to write the same cost every year. So particulars calculation amount, I need a calculation column because it is little tricky here. Calculation will need more space. Okay, particulars calculation amount, calculation a broader column. Particulars calculation amount, particulars calculation amount. Saving in tea cost. Saving in tea cost. There are two savings. One is a saving in coffee and saving in tea. Saving in tea cost. How many employees were consuming and what number they were consuming? 120 employee 3 times, 40 employee 1 time. Tea. I'm just talking about tea. Totally 200 employees are there. 120, 40 and 40. 120 employees prefer tea all 3 times. 40 employee prefer coffee. Let's see that later. And remaining prefer tea only once in a day. So right, 120 employees into tea, 40 employees into 1 into 200 days. First tell me this number. Sorry, without multiply amount, I'm yet to multiply with 10. Tell me the number. 80,000 cups, because I'll need this number later. 80,000 cups into 10 rupees. 80, I'll need this number later. So 80,000 cups into 10. 8 lakh rupees I'll save in tea cost. 80,000 into 10. We will save 80,000 cups of tea into 10 rupees. Any doubts on this? Clear? Saving in coffee cost. How many people consume coffee? 40 into how many times? 3 times into 200 days. Give me first number. Not 36. 24, na? 24,000 cups. 24,000 cups. 24,000 cups. This is a saving for us. What is the cost of a coffee? 15. 3 lakh 60. Now for this 80,000 cup, I'll incur tea cost, coffee cost, powder cost, sugar cost, and for 24,000 cup also we'll incur. We'll do all that calculation. Any doubts till this? Any doubts till this? Let's go one by one. What are the costs they have given? First cost is what? No, before that, in the table itself, there are certain costs. One is annual maintenance, which will 75,000 every year. Then there is some electricity consumption, and then coffee bean, tea powder, sugar, milk, paper cup. All this you have to consider. First is maintenance. Maintenance cost. Maintenance cost. How much is the maintenance cost? 75,000 every year. 75,000 every year. Maintenance cost 75,000 every year. Clear? Maintenance cost 75,000 every year. Then next cost they have talked about is electricity cost. Electricity cost, which is how much? 500 units per month and 12 rupees per unit. Electricity cost 500 units into 12 months into rupees 12. Per unit is 12 rupees. This entire computation more focused on cost accounting. How much you get? 72,000. Electricity cost is 72,000. 75 and 72. EB cost is 72,000. Clear? Can we proceed? Then coffee bean cost. Coffee bean cost. Listen now. It says 90 per packet, and one packet will produce how many cups? 200 cups. Listen. Earlier, people were consuming 24,000 cups. Now that will increase a little bit because it is available in the company itself, and people are going to consume more. They have said because of the ready availability of tea and coffee through vending machine, consumption will increase by how much? 20% on an average. So on an average, 20% more consumption will happen on an average. I have to consume not for 24,000. Saving is for 24,000. But now coffee consumption will be not 24,000. It will be 20% extra. So coffee bean cost, right? 24,000 plus 20%. 24,000 plus 20% divided by 200. Why 200? One packet, 200 cups. One packet, 200 cups divided by 200. All this calculation we have been doing in cost accounting. Divided by 200. Multiply with what is the cost of one packet? 90. This is the coffee bean cost. Plus 20% divided by 200 into 90. How much? 12,960. Extra 20% consumption is happening. Earlier 80,000 and 24,000 cup. Now the numbers will increase by 20% each. Any doubts on this? Coffee bean cost 24,000 plus 20% by 200 into 90. Then less. Like coffee bean, the next cost is what? Tea powder. Tea powder cost. Tea powder cost. Tell me, how should I calculate? Participate. 80,000 plus 20% divided by 200. Same into 70. 80,000 plus 20% divided by 200 into 70. 33,600. Powder is 33,600. Coffee bean 12,960. Tea powder 33,600. Clear? Any doubts on this? Can we proceed? Done? Okay. Then we have sugar. Sugar cost. Okay, listen. It says sugar is at a cost of 50 per kg. Each cup of tea or coffee will need how much? 10 gram of sugar. Sugar is needed for both tea as well as coffee. Listen, we are going to consume 28,800. What is 28,800? 24,000 plus 20%. Listen for a minute. 28,800 coffee, 96,000 tea. This is the consumption. 28,800 plus 96,000 tea into 10 gram. 10 gram. Divide this by 1000 to convert into kgs. Divide this by 1000 to convert into kgs into 10 gram divided by 1000. What is the cost per kg of sugar? How much? 50. This is a calculation. 28,800 coffee, 96,000 tea into 10 gram divided by 1000. Why divided by 1000? To convert into kg. Ten gram by 1000 into 50. How much is it? 60 to 400. Sugar cost is incurred on both coffee and tea. Extra 20%. Extra 20% has to be done. 60 to 400. 60 to 400 is the sugar cost. Any doubts on this? Like this, you do the milk cost. I'm doing it in the screen. You do it. It will not be very difficult. Same logic, milk cost. Same logic, milk cost. What is the milk consumption per cup? 100 ml. Divide again by 1000 to convert into liters. What is the cost per liter? 50. 6 lakh 24,000. 6 lakh 24,000. Milk cost 6 lakh 24,000. This computation, as you see, is more of cost accounting. Any doubts in this? Any doubts in this? Can we proceed? Any doubts on the milk cost calculation? What's the next item? Cost pay per cup. Now here there is again one more adjustment. It says 20 paise per cup is okay, but pay per cup consumption will be 10% more than the cup served due to leakages in them. So same calculation. The only thing is, listen, into 1.1. What is 1.1? Is extra 10%. Extra 10%. 28,800 coffee, 96,000 tea into 1.1. 1.1 is extra 10% into 20 paise. Into 20 paise. Into 1.1 into 20 paise. 1.1 into 20 paise. 27,456. 27,456. Any doubts on this? Can you proceed? Any doubts on this? Less depreciation. Depreciation. What is the cost of the machine? Any salvage value? How many years? Let me know the profit before tax. 52, 384. Profit before tax. Others completed. It's okay. I'll wait. You complete and confirm. 52, 584. Profit before tax. 52,584. 52,584. That's the profit before tax. PBT number 52,584. Any doubts on this? 52,584. Can we proceed? Done. Less was the tax rate 25%. 13,146. Profit after tax 39,438. Add back depreciation. Cash flow after tax. Any doubts on this? Any doubts on the CFAT number? A little bit of a lengthy computation. Any doubts on this? Any doubts on any of the calculation here? What is the sale value of the machine after 5 years? Zero. Any book value left? 10 lakh, 2 lakh, 2 lakh, 2 lakh. So no NSV calculation. It is zero only. Sale value is zero, book value is zero. Directly. Working note 3, computation of NPV. In my printed answer, I would have presented working note 3 as terminal flow. In exam, up to you. If you feel it's not there, you can directly move to NPV calculation. Year cash flow PVF DCF. Year cash flow. What is the discount rate given? Sorry, 12% DCF. Year cash flow PVF DCF. Year cash flow PVF DCF. Year zero. Year zero. How much is the outflow? 10 lakh. 1, 10 lakh. 1 to 5. 239,438. Why year annuity factor? 3.05. You'll get rejected. 8 lakh 63. 174. Negative 136. 826. You have to write a conclusion. The company should not buy the machine as the same results in negative NPV. Should not buy the machine as the same results in negative NPV. Conclusion is mandatory. In exam, you don't write conclusion, they may deduct 1 or 2 marks. So, conclusion has to be there. Company should go ahead wherever they have asked. Most of the question they'll ask the conclusion. You are required to advise on the feasibility of acquiring the vending machine. Answer is no, it is not to be acquired. NPV is negative, it should not be purchased. Any doubts on this? Clear? Able to understand this? Any doubts on this? Done? I give you a minute or two, you go through the solution. Any place there are doubts, let me know. 2 minutes for you. Let's come to question 30. LA Private Limited is planning to invest in a machinery that will cost 1 lakh at the beginning of year 1. Net cash inflow from operation is estimated at 36,000 per annum for 3 years. Two options for smooth functioning of the machinery: service, another is replacement. If the company opts to service a part of the machinery at the end of year 1, scrap value at the end of year 3 will be 25. Not to service, replace at the end of year 2, machinery will work for 4th year, will get inflow of 36,000 for the 4th year. It will have to be scrapped at the end of 4th year for 18. Assume cost of capital at 10% and ignoring taxes. Ignoring taxes. Moment it is ignore taxes, we are not going to be bothered about lot of items. Ignoring taxes. Determine the purchase of this machinery based on the NPV. If the supplier gives discount, what would be your decision? Use 4 decimal PVF for decision making. 4 decimal PVF for decision making. Go through the question and then I'll explain it. It's a very simple one. Go through the question. Okay, let's come to this question. They're saying a company is planning to buy a machinery which will cost 1 lakh at the beginning of year 1. Beginning of year 1 means what? Year 0. Cash inflow from operation is 36,000 for year 1, year 2, year 3. Company has two options for smooth functioning of the machinery. The machinery to work well, I have two options. One is service, another one is replacement. If I do service, I have to spend 20,000 rupees in year 1, and I'll be able to sell the machine for 25,000 in year 3. Do 20,000 expense in year 1 and sell it at 25,000. But if you decide not to service, then you have to replace the parts where you spend in year 2 but use machine for year 4. Most important word is ignore taxes. Ignore taxes means ignore depreciation. I'm going to straight away write the cash flow. No step 1, no step 2, no step 3. Working note 1 will be situation 1. There are two options. One is to go for your service, another one is to go for replacement of parts. We will do this, and then the finally saying supplier gives a discount of 10,000. What would be your decision? We'll see that later. First, without discount, let's close it. Working note 1, computation of NPV of option 1 service, year cash flow PVF DCF, year cash flow PVF DCF, cash flow PVF DCF, year cash flow PVF DCF, PVF at what rate? 10%. This is a very simple kind of a question because of no tax adjustment. Year 0, what is the outflow of the machine? 1 lakh. Year 0, 1 lakh. 1 lakh is the outflow. By spending 1 lakh, we are going to get what? 36,000 for how many years? 3 years. But there's one condition. You have to spend 20,000 at the end of year 1, some spare parts. So year 1, 36,000 inflow, 20,000 outflow. 36,000 inflow, 20,000 outflow. I have to spend 20,000 rupees for some service, something they have said. Service a part of the machinery at the end of year 1 for 20,000. You will sell it at the end of year 3 for 25,000. Year 2, what inflow we will get? Participate. How much? 36,000. 36,000. Year 3. Year 3 we will get how much? 36 plus 25. There is some discount. I'll analyze that later. 61,000 close NPV. 10% close NPV. Sorry. Do 4 decimal. Yeah. I think we get a negative amount. 9875. 9875. This option doesn't look feasible. This doesn't look feasible. 9875 negative we are getting. Any doubts on this? Clear? Just call this as NPV without discount. NPV without discount. Call it as NPV without discount. There's another option available. That is, if the supplier gives a discount of 10,000, what will be your decision? I'm calculating both. Decision I'll give in some time. If he gives me a discount of 10,000, the outflow will reduce by 10,000 on day 0. On day 0, it will reduce. NPV will go up by 10,000 rupees. NPV will go up by 10,000 rupees. Outflow will not be 1 lakh. Outflow will be only now 90,000. If outflow goes down, NPV will go up. So NPV with discount. NPV with discount minus 9875 plus 10,000 rupees. 10,000 rupees improvement will happen in NPV. 10,000 rupees improvement in NPV. 1 to 5. Now we are not sure whether this is better or option 2, but at least we are making positive NPV if discount is there. It is just positive NPV if discount is there. Any doubts in this? Able to understand this? Okay. I give you around 5 minutes. Do a similar table for option 2. Option 2 is 4 years life. Check cash flow properly. It is 4-year life. Do option 2 without discount and with discount. I'll discuss it in 3-4 minutes. Option 2. Coming to option 2. In option 2, we are going for some replacement of parts. Year 0, no change. Year 1, 36,000 as it is. Year 2 is 36,000 and you have to spend something in year 2. How much we have to spend? 30,800. We have to spend 30,800. So we will get only 5,200. Year 3, entire 36,000, and as a year 4 now. Year 4, where you will get 36,000 plus some spare part plus salvage value. How much? 18,000. 54,000 we will get. 0.6830. 6830. 36,000 into 0.9091, which is 32,728. 5,200 into 0.8264. 4297. 36,000 into 0.7513. 27,047. 54,000 into 0.6830. 36,882. What is the NPV without discount? 954. And with discount will be 954 plus 10,000, 10,954. Any doubts on this? Any doubts on this? Now, which one do I select? If discount is not there, option 2. Discount there also, option 2 only. Discount there or not there, option 2. Without discount, NPV is negative, not viable itself. NPV become positive, may not be advisable still because the NPV is 125. And here, positive, but very low as compared to the investment. Worth investing as the NPV is positive and higher as compared to option 1. Clear? Any doubts in this? Any doubts in this? I think this is an error there. Any doubts in this? Clear? Can you proceed? Okay, go through question 32, an extremely lengthy problem. It is a study mat question, that is why I'm discussing it. With one point, I'm very clearly saying I don't see this many adjustments coming in an exam problem because this has lot of adjustments. So you first go through this. After you go through it once, including the MCQ choices question, everything you go through once. I give you some 3-4 minutes, then I'll explain it and then we will start doing it. Go through the question. Okay, I will start explaining the question. First, I read the requirement. Which of the following is the best estimate of discounting rate, which is WACC calculation? Which is the best measure of delivery partners required in year one? Number of partners required is one question. Best measure of total revenue of year three, which represents the years of losses, in which year we are going to have loss, and what is the best measure of NPV of the project. NPV is to be computed. Now let's read from the beginning. It is an all equity finance company in the food delivery business, example Swiggy, and is considering an expansion into quick grocery delivery business segment. So Swiggy, then they introduce Instamart, where they are going to do grocery delivery. It is a market leader in the food delivery business with a valuation of 5,750 CR. From the discussion in the recent fundraising, it has been understood that quick delivery business will run for 6 years. Will run for 6 years. After which it will be sold to another entity for a valuation of two times of the investment made in the business segment. So the terminal inflow is two times of the investment made in the business segment. The new segment will be funded by debt, preference, and equity in the ratio of 3 is to 2 is to 5. This will give me WACC. This will give us the WACC. Quick grocery delivery would require 30 crore of investment to start with. Year 0 outflow 30 crore. Another 20 crore at the start of year 2, end of year 1. End of year 1, another 20 crore investment, capital expenditure, and 25 crores in the start of year 4, end of year 3. End of year 3. Operating financial, they are going to have two types of order: quick order and overnight order. Ticket size: in quick order, 5,000 orders will be below rupees 500. 3,000 orders will be between 500 and 1,000. 2,000 orders will be above 1,000, with the average ticket size being, what is the average ticket sizes? On an average, some people will order less than 500 rupees, some people will order between 500 and 1,000, some people will order above 1,000. On an average, 700 per order. Delivery charges applicable if you order below 500, which is 40 rupees per order. So my first income stream is I'll order 40 rupees per order. If you order less than 500 rupees, the company will also charge 5% of the invoice value from the seller for quick delivery product. From customer, I'll be charging 40 rupees. From the seller, 5% of the invoice value, and 7% in case of overnight order. 7% in case of overnight order will be charged. Overnight delivery would be available to only subscription based customer. The overnight delivery is not for everyone, it is only for subscription based customer, and subscription charges are 5,000 per annum. This is another income for me. Every overnight order is expected to have an average ticket size of 750 rupees, and each subscription based customer will place two orders every day on an average. Looks very high, but that's what they've said: two orders every day. We are having 2,000 orders per day. I'll be having 1,000 people subscribing it. 2,000 orders per day, two orders per day on an average. Two orders per day on an average. Quantity of order will grow at the rate of 20, 15, 10, 5% for first 4 years of operation. That is after the first year, 20%, 15%, 10%, 5%. Beyond this, it will remain constant. Proportion will remain unchanged. To attract the customer, I have to spend advertising 7, 8, and 10 for year 1, 2, and 3. Delivery partner will have to be paid 15,000 per month fixed, and another 20 per delivery. Every delivery partner can deliver 30 orders per day, some extra 50 and IT cost. Income tax is 20, sorry, depreciation is 20% per annum on investment. Original investment 20%. Whatever next you make investment, again 20% every year. Next you make again 20% every year. Tax rate 25% after tax cost of debt. Let's close the first one. Discount rate is very simple. They have given cost of debt, they have given cost of preference, they have given cost of equity. WACC is equal to WACC is equal to No table, directly we'll write it. WACC is equal to, what is the cost of debt? 10%. What is the weight of debt? 3 is to 5 is 3 is to 2 is to 5. It is given here. Debt, preference and equity in the ratio of 3 is to 2 is to 5. So into 3 by 10. 10% into 3 by 10. Then cost of preference is how much? 11%. 11%. What is the weight? 2 by 10. Cost of equity 15%. 5 by 10. 15%. 5 by 10. All put together how much? 12.7%. This is the easiest of the lot. Everything else will need lot of calculations to be done. 12.7%. Any doubts on this? Clear? Okay. Now let's understand that this is a new project itself, where there is an initial outflow and then there are in between flow, there are terminal inflow, and I calculate NPV. In that process, I'll be able to find out how many delivery partner are required in year 1. I'll be able to find out what is the revenue of year 3. I'll be able to find out which year we are suffering losses, and also I'll be able to calculate the NPV. Everything will get calculated in this process. Now, it is a 6-year calculation. You are going to do only 1-year calculation. Balance in Excel, I'll drag and show it to you, because if you try writing 6 years, you will take a lot of time, because there are a lot of changes which are going to happen. So 1-year calculation I want you to do. Balance 2, 3, 4, 5, 6, I'll show it in Excel. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow. Particulars and amount. Particulars and amount. Tell me the capital expenditure. At the start of the project, what is the capital expenditure? 30 crores. We'll do it in crores itself. 30 crores minus 30. Minus 30. Initial outflow is minus 30. Any doubts on this? The initial outflow is 30 CR. Clear? Okay. Now, after making this investment, the business will run for 6 years. And financials for the first year of operation, number of quick order, number of overnight order is given, and thereafter some growth and all other things is given. So working note 2, in between flow. In between flow. Particulars calculation year 1. Only 1 year you will do. Other years you will not do. Other years I will just show it in Excel. Particulars calculation year 1, calculation a broader column. Calculation year 1. Lot of adjustments are there. So I don't want you to write year 2, 3, 4, 5, 6, which will take a lot of time. Now, my revenue, there are 4 streams of revenue for me. One is quick order delivery charges. Second is quick order delivery commission. What is commission is 5% of the invoice value. Third, overnight order commission and overnight order subscription income. Subscription income. Totally 4 income sources are there. Totally 4 income sources are there. So now write quick order delivery charges. Quick order delivery charges. We will do it in crores. Final answer we'll write it in crores. Quick order delivery charges. How many quick orders per day? 10,000. In that 10,000, only some order you make a charge. Every order you don't charge. We are charging delivery charge of how much? For order below 500. How many orders are below 500? 5,000 orders. This is per day. This is per day. 5,000 orders into how many days in a year? Mentioned in the last line. 365 days. 5,000 orders per day into 365 days into how much we are going to charge? 40 rupees. Tell me the answer in crores. 7.3. 7.3 crores. 7.3 crores. Now why I'm not doing year 2, year 3, year 4? Because that will grow at the rate of 20, 15, 10, 5, and you have to write every year. It will become challenging. I don't want to get into that now. 7.3 crores. Any doubts on this? Quick order commission. Quick order commission. Who is going to pay the commission? Commission is going to come from the seller. What percentage? 5% of the invoice value. 5% of the invoice value. What is invoice value? The average ticket size per order is how much? 700. Some orders are below 500, some are 500 to 1000, some are above 1000. On an average 700. How many orders in a day? Participate. How many orders in a day? 10,000 orders. 5,000 is where I charge the delivery charges. 10,000 orders per day. 10,000 orders per day into 700 rupees. One order is 700 rupees. One order is 700 rupees. The average ticket size means what is the average value per order? 700 per order into how many days? 365 days into what percentage they said? 5%. Calculate this. 12.775. We'll keep it as 3 decimal calculation. Let's see what is the answer they have given. They have given how many decimal? Even 2 decimal is fine. I have written 3. 2 decimal is also fine. 12.775. Any doubts on this? Overnight order commission. Overnight order commission. How many overnight orders we have? 2,000 orders per day. 2,000 orders per day into some ticket size they've said. What is the ticket size of an overnight order? Average ticket size of 750 per order into 365 days, but the commission is higher here, 7%. I'll keep it as 3 decimal only now. 3.833. 3.833. 3.833. 3.833. Year 2 to 6, I'll only explain it in the Excel or I'll show it in the workbook. I don't want to do it. 3.833. Any doubts on this? Overnight order subscription. We are doing a subscription based work. What is a subscription is? Every customer has to pay how much for subscription? 5,000 per annum, and there are 2,000 orders per day. And question say every customer will be placing some number of orders. Where is it mentioned? Each overnight order will have a ticket. Every subscription will place how many orders? 2 orders every day. 2 orders every day. It's not only one, every customer is going to place 2 orders every day. 2000 orders, only 1000 customers will be there. Only 1000 customers will be there. 2000 orders, one customer, 2 order. One customer, 2 order, 1000 customer, 2000 order. So, subscription income 2000 orders, 2000 orders divided by 2, divided by 2 into how much we are charging? 5000 per annum. 0.5 total revenue. Total revenues. Put a total of all of this. 24 point. Any doubts till this? Any doubts on 24.408? Any doubts on this? Clear? Okay, now listen. Like this, we got 24.40540. That's okay, rounding off. I don't want to discuss much on that. Like that, next year will be 15% growth. Next year will be, how much is the growth in the next year? They've given some growth. Sorry, 20% growth. So this number will grow by 20%. 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 24.405 plus 20% is 29.286. This is the answer. Then next year another growth rate. Next year another growth rate. Next year another growth rate. And sixth year I think there is no growth. Like this, doing it for you for 6 years will be time consuming. That is why I said I will do only 1 year. You have understood the calculation for 1 year. Balance is just a formality. 1 year, if you have understood, balance is just a formality. Keep adding how much growth. They have given a growth rate of 20, 15, 10, 5 for the first 4 years. That is, first 4 years is after the first year. First year they have already given 20% growth, 15% growth, 10% growth, 5% growth, and thereafter you have to keep the same amount because 6 years you have to do the calculation. Any doubts on revenue? Less cost, less cost, less cost. We'll go item by item. In the cost, first information is on some advertising. Then there is some delivery partner remuneration, delivery partner some charges, some lot of information is there. Let's go one by one. First is advertisement. Tell me what is advertisement figure? 7 crores. The revenue calculation was little tricky. You had to go item by item. I have no problem with this question getting an exam, but they should make it year 1, year 2, year 3, year 4, year 5, year 6, same amount. Don't try to make it different amounts. Doing calculation will take away a lot of time. First year itself, it took so much time. Then you have to add numbers. So it will take away a lot of time. In Excel, I can do it faster, but in your notebook, it will take time. Advertisement 7 crores. Then delivery partner salary. Delivery partner salary. I have to pay delivery partner how much? And another, I'll calculate 20 per delivery in some time. Every delivery partner can deliver on an average of 30 orders per day. An additional provision of 50% of extra delivery partner to be made to consider the unexpected spike in orders on special occasion and holiday. In a single day, how many orders are we going to deliver? Participate. How many orders? Sorry? 12,000. 10,000 plus 2,000. In a single day, overall is 10,000 plus 2,000. 12,000. This 12,000 divided by 30 is the number of partner ideally I need, but they are saying extra 50%. Extra 50% to take care of the what? Spike in order on special occasion and holiday. So delivery partner salary 12,000. 12,000 is the number of orders I'm going to deliver, divided by 30. 12,000 divided by 30 plus 50%. Can you tell me this number? 12,000 by 30 plus 50%. 600. I don't need this number in the calculation, but that is the answer to question 2. 600 delivery partner are needed. 12,000 divided by 30 plus 50%. 600 people are needed in year 1. Year 2 number of people will increase because number of orders will increase. Year 3 again because the order will grow at some 20%, 15%. This will also grow. How much you are going to pay them? Into 12. 15,000 into 12. Any doubts in this? Clear? Tell me this, and there is some extra payment. I'll see that extra payment. Tell me how many crores is this? 10.8 crores. 10.8 crores. Any doubts in this? Clear? Then delivery partner commission, you can call it as 20 per order. You have to pay 20 rupees per order. You have to pay them 20 per delivery. 20 per delivery. 20 per delivery. Any doubts first on this? Any doubts on this? 12,000 orders, 365 days, and every order you have to give him 20 rupees. Looks huge, can get into a loss making situation, can't help it. How much? 8.76. We are paying 20 rupees per order to the delivery partner. It's a very good question. I have no problem with the question, just that number of years could have been reduced. Any doubts in this? Clear? Is there any other expense in the question? IT infra. IT infra. IT infra expenses, how much? 8 crore. Then depreciation. Depreciation. Listen, year 1 only one depreciation will come. Year 2 original depreciation and some additional investment you made, on that also depreciation will come. Year 3 1 2 depreciation, like that the depreciation can keep changing. Let's do year 1 depreciation. What is the amount we invested in year 0? What is the rate they've said? Sorry, 20%. 6 crore. Deduct all of this, you should get profit before tax. Again, number can slightly change, that depends on how, some rounding of gap. Profit before tax. I think we'll have loss here. How much is the loss? 16.152. Okay, ideally should match the number. Some small variation can be there. The its loss is only 6.255. Is there any number wrong? Delivery partner. Okay, make a small change in the question. I don't know, that's when the answer will match. Make this as 50,000 per year. Make it as 15,000 per year. This is what the answer seem to have done. 15,000 per year. Just make it as per year, so don't do into 12 here. Don't do into 12 here. 15,000 per year. I can't help it. That's what is there in the answer. 0.90. And now you tell me the profit before tax. $6.252. Any doubts on this? Okay, now we'll complete the balance part, but you mean listen more because I have to explain the next years. So IT and customer care will be same for all the years. Advertising they have given. Delivery partner will keep growing as your orders grow. As your orders grow. If orders grow by 20%, number of delivery partner will grow by 20%. So 20% increase. Commission will also increase by 20%. Depreciation you see. First 30 crore, 5 years 20%. Sixth year you cannot charge. 6 and gone. Second, we invested something 20 crore at the beginning of year 2. At the beginning of year 2. This is not there in your notebook, okay? Because we have done only 1 year calculation, which is 444 for 5 years. 444 for 5 years. 20 crore into 20%. Another investment we are making 25 crore into 20%, which is for year 4, year 5, year 6. Beyond this, we are not doing the calculation. Only 6-year calculation is to be done. Any doubts on this? We are getting 6.255. They have taken delivery partner salary if the per month word is removed in the calculation. Any doubts on this? Then less depreciation, sorry, less tax. Less tax. What's the tax rate? 25%. I am a profit making company because it says I am a market leader in that delivery business, the food delivery business. This is a new segment we are adding. So I'm already a market leader there. So I will be able to claim immediate tax saving. Less tax at 25%. 1.563. Immediate tax saving. Immediate tax saving. Profit after tax, add depreciation. Profit after tax, add depreciation. Negative 4.689. Depreciation is 6. Any doubts on this? One investment we are making in year 1. Read the question and tell me. Read the question. Some investment we are making. We are making an investment of 20 crores in start of year 2, end of year 1, start of year 2, end of year 1. Any doubts on this? It says the additional infusion of 20 crores in start of year 2, 25 crores in start of year 4. Start of year 2 is end of year 1. Less capital investment. It could be for machinery, could be for IT project. I don't know what it is. Some investment we are making. Some investment we are making. Capital investment, how much? 20 crores. CF80. Get me the CF80 number. Minus 18.689. Any doubts on this? Year 1 should not have any confusion. Other years, you will have to repeat the same calculation. So you see, this is the number 18.691. That is rounding off difference. Then thereafter, the next year's calculation. Any doubts till this? To do this computation will take away a lot of your time. We are not doing. I'm also not doing it. What I'll do is I'll give you 2 minutes to go through the calculation and then take a 10-minute break. So I start again after 8:45. I start back. So 2 minutes, go through it and then take a break. Okay. So we are done with the cash flow calculation of 1 year. I'll quickly summarize what we have done till now and then I close the question. The question is almost towards closure now. Listen, we had totally 4 sources of income for the company. One, quick order commission, quick order delivery charge, overnight order commission, and overnight order subscription. These are the 4 revenue sources. The problem for me is not year one. Year two, if I have to do, add 20% to every number. Year three, add 15%. Year four, add 10%. Year five, add 5%. And sixth year, copy paste the same amount. Then expenses, advertising 7, 8, 10. 7, 8, 10, 0, 0, 0. Remuneration, I made it as per year. I've changed it as per year. You calculate the number of delivery partners. How do you calculate number of delivery partners? Is overnight orders, quick orders divided by 30 orders per day. This is the number of partner I need. Add 50% provision for extra and multiply them with 15,000, and 12,000 into 365 days into 20 is the fixed charge which you have to pay. IT expense 8 crores every year. Income taxes 20% on initial 30 CR for year 1, year 2, year 3, year 4, year 5. Only 5 years, because 20% means in 5 years it will get fully used. Then in the second year beginning, I make an investment. Second year, third year, fourth year, fifth year, sixth year. Fourth year beginning, I make an investment. Fourth year, fifth year, sixth year, seventh, eighth is not there. You get PBT, deduct tax, PAT. If there is a loss, you save tax. Then add back depreciation and consider that investment. Working note 3, terminal flow. Terminal flow. Terminal flow. Particulars and amount. Particulars and amount. Now, normally we sell an asset and get something called as your sale value, book value, all that. Here we are not selling the asset, we are selling that business itself fully. Technically, this still can lead to capital gain and all, but that has a very complex calculation that is done in income tax. We are not bothered. They are saying after 6 years, we will sell the subsidiary. We will sell the subsidiary. The new segment will be funded, which will be sold to another target valuation of 2 times of the investment made in the segment. What is the investment made in the segment? Initially 30 CR, another 20 CR, another 25 CR, 30 CR, 20 CR, 25 CR, double of that you please give me, double of that you have to give me. So terminal flow is sale of business, 30 plus 20 plus 25 into 2. Clear? With this, we have to calculate NPV. We are not getting into NPV calculation, right? Because I have not anyway done the cash flow for year 2 to 6. Any doubts on this? Now let's look at the MCQ requirement. Every MCQ requirement will get answered with this. The first requirement is already answered. Second is also already answered. 600 people. Third, best measure of total revenue of year 3. Tell me, what is the year 1 revenue? Year 1 revenue is how much? In your notebook. 24.40. Write that in the calculator. 24.408 plus 20%. Plus 20%. What is 20%? Is growth of the second year. Growth of the second year. And then plus 15%. This is the approximate third year revenue. Approximate third year revenue. Approximate third year revenue. Loss and all, you cannot do it, okay? That calculation is a very lengthy one. With the first year calculation, if you want, you can answer 1, 2 and 3. Balances, you have to complete all the calculation. So all the calculation will show that there is a loss in the first year, second year, third year, fourth year. 4 years of losses are there. 4 years of losses. And the question was asking, which best represent the year of losses? Year 1, 2, 3, 4. All the 4 years loss. And then NPV, that is done after doing all the calculation, 39.34. In the option we have 39.35. Any doubts on this? Any doubts on the computation? First year, I can explain fully. Second year, I did not explain. You want, you do at home. You don't want, don't do at home also. It doesn't really matter. Only thing is, you will have to keep increasing every item. If you keep increasing every item, automatically you will get to the answer. Any doubts on this? Clear? Can we proceed? Done. With this, my investment decision, that is the cash flow focused problems, are done. Still, we will have some more problems on cash flow focus, which is called replacement decision. But I'll now go back to balance concept. Any doubts till this? Any doubts? Again, I'm repeating, don't try to practice more question. Pick your questions which you want to do and just do them. And every question in the heading, most of the time, this question doesn't have anything in the heading, but most of the question in the heading itself will say that if any special adjustment is there, investment decision with only outflow, tax saving on depreciation, or payment of expenses in advance, what happens in there, block of assets method. So if expenses are paid in advance, you can look at that adjustment here. Or combining leverages and capital budgeting, what happens? This was a problem on cost reduction. Here there was a sunk cost reduction, revenue enhancement. In this question, revenue enhancement, cost reduction, apart from that, other adjustments were there. I think we had something called as opportunity cost. We had something called as idle time cost. All of that was there. So every question in the heading may after tax opportunity cost, like that they may say. So you can look at that item and then be done with it. Any doubts in this? Any doubts in this? Okay, I move to the next concept, which is called NPV versus IRR conflict. Let's understand this and then I explain more logic about it. Let's see here. Let's assume there are two projects. Year cash flow A, cash flow B. Year 0, year 1, year 2, year 3, year 4. First project, 1 lakh investment, 1 lakh 30,000 inflow in first year. 1 lakh investment, 1 lakh 30. Second project, 1 lakh investment, you get back 50, 50, 50. I may change the numbers, okay, later on. I'm just writing this. If I'm not getting what I want, I'll change the numbers. PVF at 10%. PVF at 10%. That's the discount rate given in the question. 1 divided by 1.1. These are the factors. DCF of A, DCF of B. NPV is 18,170. NPV is 58,450. Which is better? Project B is better. I want to do IRR also. You know how to do IRR, but I'm just quickly showing it here. 30%, 35%. Let me change the numbers, okay. Which has better NPV? Participate. B. Which has better IRR? A. This is called conflict. This is called conflict. IRR says one is better. NPV says another one is better. IRR is saying one project is better. NPV is saying another project is better. This scenario is called conflict. If a conflict happens, we'll have to see how do we resolve the conflict. Both are good techniques. NPV is considered to be a superior technique, but still, if there is a conflict, how do we resolve is what this segment is. Situation like this can happen. So, NPV versus IRR conflict, situation in which NPV prefers one project, IRR prefers another project. NPV prefers one project, IRR prefers another project. There's something called as reinvestment assumption. You may not understand this now. You can just remember this because it may come as in a question. It will say, why is there a conflict? Why is there a conflict? The reason is something called as reinvestment assumption, which I'll talk about when I go to MIRR concept, which is in the same MIRR concept. So reinvestment assumption, there is something called as reinvestment. What is reinvestment is every year we get cash flow, no? That cash flow, either I use it or I reinvest somewhere else. I reinvest it somewhere else. Where will I reinvest? In a FD, I get FD interest. How can I reinvest? Tell the bank, please add it to principal. Tell the bank, please add it to principal. I do a project. Project gives me some cash flow. Take that cash flow, do another project. Take the next year cash flow, do another project. Take the next year cash flow, do another project. When you invest in another project, NPV says that another project will give you only 10% return. Another project will give you only 10%. That is what NPV says logic. NPV's logic is that another project will give you only 10% return. I don't want to assume a very high number and all. Another project will give you only 10% return. Reinvestment assumption is that other project will give you only 10% return. I may talk about more about this when I go to MIRR concept. IRR says no, that another project will give you 30% return. If you are in project A and you take that money and put it in another project, that second project should give me 30% return, which may be illogical because this project could be very good. Finding such other good projects may be difficult. And for project B, whatever you get, you reinvest, you have to get 22% return. This is what IRR assumption. IRR assumes that whatever money I get, see, every business earns something. Either you use it or reinvest it. What is usage? Give it to shareholder. You can also give it to shareholder or reinvest it. If you keep it in the business, you have to reinvest. Reinvestment NPV says that it is only possible for me to find a project with 10% return. Minimum 10% return, can be more than 10, but 10% is what they want to assume. IRR says no, I can get 30%, 22%. Because of this reinvestment assumption difference, there will be a conflict. If both had a same assumption, ideally both will give same answer, which is what you will understand when I go to MIRR concept. So here NPV assumes that reinvestment will happen at cost of capital. IRR assumes that reinvestment will happen at IRR itself. Now, this is reason. Reason is not very critical for you. Conflict has happened. How do I resolve the conflict? If both the projects have same life, go with NPV. Both the projects have same life, go with NPV approach. If they have different life, for example, this is 1 year project, only 1 year, 2 3 4, nothing is there. This is 4 year project. It can be like this also. Sometimes year 0 0 0 1,80,000. I get only once. This is also a 4 year project only. It is still a 4 year project only. Why 4 year? Invest today, get money after 4 years. So NPV is 18,170 and 22,940. Obviously, project B is better. From a IRR point of view, 30%, 16%, project A is better. Now, there is one issue with this NPV comparison. NPV says that whether you are a 1 year project or a 5 year project or a 10 year project, I will do calculation, give single answer. And this 18,160 is earned in 1 year. And this 22,940 is earned in 4 years. To make them comparable, we calculate every year NPV. That's just called equated annual benefit. You don't divide by 1 year and 4 year, you do something else, but you calculate something called as equated annual benefit. What is equated annual benefit? Is 18,170 is 1 year NPV. 22,940 is 4 year NPV. So they say 18,170 equal to every year benefit, first year benefit, second year benefit, third year benefit, fourth year benefit. If it's a 4 year project, first year benefit into present value annuity factor 1 year. 1 year annuity factor you have to take. 1 year is not annuity, normal factor itself. 1 year annuity factor you have to take and calculate something called as equated annual benefit, every year benefit. What is 22,940? Equated annual benefit into present value annuity factor 4 years. Present value annuity factor 4 years. Can you tell me 10% annuity factor for 1 year? 0.909. 0.909. 4 year annuity factor. 4 year annuity factor. 3 point. So basically, you're earning 18,170 in 1 year. What is every year benefit? 18,170 divided by 0.909 divided by this 0.909 will go to the other side. 0.909 will go to the other side. 22,940 divided by 3.170. This is annual benefit. Every year benefit. Every year benefit. I'll repeat again. I'll repeat the concept again. Very simple. 18,170 is earned in 1 year. 22,940 is earned in 4 years. So now I want to know what did I earn in first year, second year, third year, fourth year, so that overall benefit is 22,940, which is computed using this logic. 18,170 is equal to EAB, equated annual benefit, multiplied with the annuity factor of 1 year, 0.909, and 22,940 is equal to equated annual benefit multiplied with annuity factor of 4 years. 4 years is 3.170, and which is where this formula came. EAB is equal to NPV divided by PVAF R comma life, present value, annuity factor, R comma life. There's something called as EAC, which we will discuss in some time. Clear? This is EAB is equal to NPV divided by PVAF R comma life. In case there is a conflict, life is different. Life is same, no problem. Go ahead with the NPV approach itself. Any doubts in this? Clear? Can we proceed? Any doubts on this? Let's do a question now. Come to question 33. A firm whose cost of capital is 10% is evaluating the following two projects. Annual CFAT in thousands are provided alongside, year 0, 1, 2, 3, 4, X, Y. Calculate NPV, IRR, EAB. Is there a conflict? If so, resolve the conflict. Is there a conflict? If so, resolve the conflict. Nothing much. Cash flow given means there's nothing there in the problem. Only when you have to calculate cash flow and then do it becomes a difficult question. Now, right, project X. Project X. Project X. Year, cash flow, PVF at some discount rate is given in the question. 10% DCF. Year cash flow PVF for 10% DCF. Nothing there in the question. Only thing is that I'll have to finally explain that conflict. Year 0, how much is the outflow? We are doing the it are in thousands, so 2 lakh. Data is in thousands. 2 lakh into 1, 2 lakh. What money do we get back? Year 1, only 1 year project. This is 2 lakh 40,000. 1 year project, 2 lakh 40,000. What is the discount factor? 909. 218. NPV is, we are earning 18,116 1 year. We are earning 18,116 1 year. Any doubts on this? Then below this IRR, A is equal to P into 1 plus R power N. A is equal to P into 1 plus R power N. P into 1 plus R power N. P into 1 plus R power N. Amount is, what's the amount? 2 lakh, future value 2 lakh 40,000, present value 2 lakh into 1 plus r power, how many years was this? 1, r in bracket IRR, r in bracket IRR. How much is IRR? Sorry, 20%. First project is done. IRR is 20%. Again, I'm repeating, if cash flows are given in a question, it is just time pass. It's just waste of time we are doing. There's no concept there. If cash flows are given, you just need to keep writing them. That's all. Any doubts in this? Second project, project Y, year, cash flow, PVF at 10%, DCF. Year, cash flow, PVF, DCF. Cash flow, PVF, DCF. Year 0. Year 0 was the outflow of the project. 2 lakh. 2 lakh outflow. When are we receiving money? Fourth year, how much? 350. Fourth year, 350. 1 divided by 1.1, 0.683. We get 2 lakh. So NPV, this project is better, but it is same as my example which I was saying. This is a 4-year cash flow. 4-year NPV is 39,000 and 1 year NPV is some 18,000. Any doubts on this? Any doubts on this? A is equal to P into 1 plus R power N. Listen, if there is not one inflow, one outflow, and they give 2, 3 inflow, outflow, you do normal IRR. One positive NPV, one negative NPV, all that you have to do. Only one outflow, one inflow, the shortcut works. A is equal to P into 1 plus R the whole power N. What is the future value? 3,50,000 is equal to 350 is equal to, what is the present value? 2 lakh into 1 plus R power 4. 4 years, 1.75 is equal to 1 plus R power 4. Take a square root, another square root. IRR is 15.02%. 15.02%. Clear? Done? 15.02%. Any doubts on this? Can you proceed? Any doubts on 15.02%? Now, let's do a table. Particulars, project X, project Y. Project X and project Y. NPV. Tell me the NPV figure you calculated. X is how much? 18,160. Y 39,050. IRR 20%. So looking at this value, IRR will prefer this and NPV will prefer the other scenario. NPV will prefer the other project. Below this, right? NPV prefers project Y. NPV prefers project Y, whereas IRR prefers project X. IRR prefers project X. Project X. This scenario, this scenario is called as ranking conflict. The question asked, is there a conflict? Yes. This scenario is called as ranking conflict. Some question may ask, why is there a conflict? Conflict arises due to change in reinvestment assumption. Change in reinvestment assumption. NPV assumes reinvestment will happen at cost of capital 10%. Reinvestment will happen at cost of capital. More clarity on this will emerge when I do MIRR. Whereas IRR assumes reinvestment will happen at IRR in bracket 20% and 15.02%. 20% and 15.02%. Clear? How to resolve conflict? Just give me a minute, some net issue. How to resolve conflict, right? How to resolve conflict? Would the life of project X 1 year, right? Life of project X is 1 year, whereas life of project Y is how many years is the life of project Y? 4 years. In this situation, we will have to compute equated annual benefit to resolve the conflict. Equated annual benefit EAB is equal to NPV divided by PVAF R comma life. PVAF R comma life. Present value annuity factor R comma life. EAB of X equal, what is the NPV of X? Sorry, 18,160 divided by present value annuity factor 10% comma 1 year. What is R is the cost of capital, not the IRR. Okay, R is cost of capital. Okay, 10% comma 1 year. Annuity factor for 1 year is the same number. That's all. So 18,160 divided by what is the first year factor? 909. Get me the number here. 19,000. This is what first project is earning me 19,978 in year 1, whose present value is 18,160. 19,978 in 1 year. 1 year. This is after meeting all the requirements. Okay, 19,978 it is earning. EAB of Y 39,050 divided by PVAF 10%, comma 4, 4-year annuity factor. 3.170. 12,319. What is this 12,319 mean is, first year you earn 12,319, second year you earn 12,319, third year you earn 12,319, fourth year you earn 12,319, whose present value is 39,050. What is project X earning? 19,978 in first year. That's all. Only 1 year project it was. 1978 in first year, whose present value is 18,160. What is project Y earning? 12,319 in first year, 12,319 in second year, 12,319 in third year, 12,319 in fourth year. Now what EAB says is, if I look at this, EAB of X is better, which means X is preferable project. Logic for EAB is, first project you earn 19,978 in year 1. Year 1 project got over. Do the project again. Again invest 2 lakh, earn 2 lakh 40. Again invest 2 lakh, earn 2 lakh 40. Again invest 2 lakh, earn 2 lakh 40. You can keep repeating this way and earn more money in X rather than doing it in Y. Rather than doing it in Y. Only tricky part is, will I get that project again or not? Because IRR assumes that you will get such projects again and again. We don't know whether such projects exist, do not exist, which is where NPV is has a logic which says that let's not worry about all of this. You just see the absolute amount and proceed ahead. IRR says that I will have a reinvestment assumption, and if IRR is better and NPV is weaker, conflict arises. For resolving the conflict, if life is same, then IRR and all is discarded. We don't bother about IRR. But life is different. You have to do EAB. Now, right, the company should go ahead, with machine Y, go ahead with machine Y, as the same as higher equated annual benefit, as the same as higher equated annual benefit. Sorry, project X, machine X, machine X as the same as higher equated annual benefit. Any doubts on this? Clear? Able to understand this? In case both the projects had same life, no need to do any of these calculation. You directly go with NPV. Even if you do EAB there, NPV higher, the EAB will be higher because denominator will be same only. If the life is same, denominator is going to be same for both the projects. If the life is same, denominator is same, NPV higher, higher EAB. So life is same, just go with NPV. Life is different, do EAB calculation. Any doubts in this? Clear? Okay, I'll take a break now. We resume at 10 o'clock with the balance questions. Okay, let's go ahead. We just saw something called as NPV versus IRR conflict. If life is same, we go with NPV. Life is different, we go with IRR. Sorry, we go with your EAB approach. Then for life disparity, there is another approach called replacement chain method. Not even a preferred method, but one illustration is there in your study mat. That is why I'm discussing. What is this replacement chain method? NPV versus IRR conflict, alternative approach of resolution. Repeat project multiple times so that life of the two projects become same. Compute NPV after making life same and select alternative with higher NPV. Now, what is this? Let's see this example which we had. I invested 1 lakh, got back 130. At the end of first year, I invested again 1 lakh. Second year, I got back 130. At the end of second year, I again invested, got back 130. I repeated this 4 times so that life of both the project become 4 years. I repeated this 4 times. So what happened is, this 130, I got 130, invested again 1 lakh, invested again 1 lakh at the end of first year. This is called replacement chain method. So you get back 30,000. Next year, what you do is again you get 130 and you invest 1 lakh. Get 130 and invest 1 lakh 30,000 and last year you get back 130. Last year you get back 130. This is another approach which can be followed. In this approach, project A has a higher NPV as well as higher IRR. Project A has higher NPV as well as higher IRR. First project has 10-year life, second project has 4-year life. Repeat the second project so that both the life become equal. You cannot make them 10-10, make it 20-20. Make both as 20 and 20. The life of two projects has to become equal. We are repeating in such a manner that life of two projects become equal. If the life of two projects become equal, calculate NPV, both will give same answer. Calculate IRR, both will give same answer. Yep. Let's see this here. R Private Limited is considering modernizing its production facility. Two proposal under consideration. Cash flow with the project, NPV at 12% and IRR is as follows. Year 0 till 6 years, NPV is given in the question, IRR is given in the question. Identify which project should R Private Limited accept on the basis of replacement chain method. Simpler approach, EAB. EAB is NPV divided by annuity factor. Project A has higher NPV. Project B has better IRR. First project has higher NPV. Second project has better IRR. Now what we are going to do here is, we are going to, project A has a life of how much? 6 years. Project B, so project be completed once, repeat it one more time. The NPV may go up, may go, I don't know, we'll do the calculation. If the final NPV is more than 6,49,000, go ahead with project B. If the final NPV is more than 6,49,000, go ahead with project B. We are going to repeat project B twice. If you repeat it twice, 3 plus 3, 6 years, and this is 6 years. Clear? Able to understand this? Easier approach, EAB, equated annual benefit, which is nothing but NPV divided by annuity factor, 6-year annuity factor and 3-year annuity factor. Working note 1, computation of NPV of project B, continuous investment two times, we are going to invest. By doing 2 times, the life will become 6 years for both. Year cash flow PVF DCF. Year cash flow PVF DCF. Cash flow PVF DCF. What is the investment value of this project? Year 0. Second project. First project, nothing to be done, okay? Because there already the answer is for 6 years. Year 0, how much? 20 lakh. Year 1, 7 lakh. Year 2, 13 lakh. Year 3, 12 lakh. Listen, year 3, you will get 12 lakh. But invest again 20 lakh. You will get 12 lakh, but invest again 20 lakh. Repeat the project one more time. I completed the project in third year. I will repeat this now again by investing how much? 20 lakh rupee. By investing 20 lakh rupee. What will I get out of it? 7 lakh in the fourth year, 13 lakh in the fifth year, and 12 lakh in the sixth year. First time we did, we got 7, 13, 12. Project over. Now with this 12 lakh, I add more money and invest 20 lakh again. Invest 20 lakh again. Which year? Third year. You will get money when? Fourth year, fifth year, sixth year. You want to repeat it one more time. Invest in the sixth year. You will get money in seventh year, eighth year, ninth year. Assuming first project had 9-year life, repeat it 3 times. Had 12-year life, repeat it 4 times. Had 15-year life, repeat it 5 times. You have to repeat so that both the life become equal. Here we invest 8 lakh is the cash flow, negative. Negative 8 lakh is the cash flow. Year 4, I invest 7 lakh. Year 5, I invest 13 lakh. And year 6, I invest. Year 6, I get back. I get 7, 13, 12. No investment, sorry. First 20 invested, 7, 13, 12. Again 20 invested, 7, 13, 12. Any doubts on this? Any doubts on this? First time we invested, we got 7, 13 and 12. We repeated the investment. So that life of two projects become equal. Objective is to make life of two projects equal. Any doubts on this? What is the annuity? What is the factor? 12%. Do it the now life of both the projects is 6 years. Okay, both the projects life is 6 years. Tell me what's the value you get? 8 lakh 300. Now NPV and IRR will be same project better. Mostly you can check the NPV. We decide based on NPV only. We decide based on NPV only now. Decision is always based on NPV only. Now we have removed the life disparity angle. We have made the life of two projects equal. Life of two projects is made equal 8 to 300. Any doubts on this? This is an alternative approach of analysis, but again I'm repeating, logically speaking, best approach is EAB. Same question you write. Solution based on EAB. Solution based on EAB. If problem was silent, I would have done based on EAB. EAB is equal to NPV divided by present value annuity factor R comma life. R comma life. Project A. Project A. Project A. What is the NPV of project A? 649,094. Best approach is EAB. That is the best approach to solve a question. Give me 6-year annuity factor. 6-year annuity factor. Sorry? 4.111. 1,57,892. 157,892. Second project, whatever NPV is there in the question, okay, don't, not the NPV which we have calculated. We have calculated 6-year NPV. Don't go with that. Just go with whatever is there in the question. 6-year annuity factor 157,892. Any doubts on this? Any doubts on this? Project B. What are the NPV in the question? 515. 3-year annuity factor. 3-year annuity factor. 3-year annuity factor. 2 point. Obviously, B will have better EAB because that is what replacement chain method said. B will have better EAB. How much? 2,14,000. So we will obviously go ahead with project B. If problem was silent, I would have done EAB approach. I have not seen ICI testing replacement chain method till now. Only reason I have kept it a question because it is there in ICI study mat. Any doubts on this? Clear? Can we proceed? Any doubts on this? Done? Okay. There's another concept called equated annual cost, EAC, which I had mentioned with EAB there, but I said I'll explain later. Now, there can be practically some project where only outflows are there. Inflows are not even there, only outflows. Projects where only outflows are there. Year 0 outflow, year 1 outflow, year 2 outflow, year 3 outflow, year 4 outflow, year 5 outflow, and maybe in salvage value some inflow can come, but primarily an outflow based project, very rare inflow. Example, a company wants to develop a canteen facility for its employees. A canteen facility is to be done. I can get it done from contractor A or contractor B. For starting the canteen facility, 10 lakh rupees. Every day some expenses are done, I don't collect anything from the employees. So canteen facility, if you do NPV, obviously negative because there is no inflows. So NPV approach doesn't work there, because if you go ahead and do NPV approach, canteen facility will obviously give you losses only. It will give you losses. There can also be a scenario where some projects, they do not give the information regarding sales and all. They only give outflow based information. Inflow information is not even given. Example, I want to buy machinery. Machinery is going to do manufacturing. Whichever machinery I do, it is going to do manufacturing. Sales will happen. They do not give any sales information. They give only cost information. They give only cost information. Why they did not give sales information? Logic is sales is same for both the alternative. If something is same in the alternatives, it technically will not impact the decision because it will have same effect in option 1, same effect in option 2. So in that scenario also, if you do NPV, you are going to get a negative answer. So they say, in case projects which are only outflow, you don't call it as NPV, you call it as present value of outflow. Will the steps change? No, steps do not change. Step 1, initial outflow. Step 2, in between flow. Step 3, terminal flow. Initial outflow, outflow means write negative. In between flow, outflow means write negative. Terminal inflow, write positive. Final answer, you will get a negative answer. No, that negative answer is called present value of outflow. That negative answer is called present value of outflow. In the end, you can maybe remove the sign because the word is present value of outflow. Outflow means it is negative only. So you can remove the sign if you want in the end. If I ask you what is present value of outflow, you should not say minus 50 lakh. You can say 50 lakh is present value of outflow. Both are same. So in the end, I may change I remove the sign, but it is going to be negative. So in case projects are having only outflow, decision is based on PV of outflow, and you will obviously select a project which has lower PV of outflow, which has lower PV of outflow. But in that, one project 3-year, another project 2-year. Contractor A, 3-year canteen facility 50 lakh. Contractor B, 2-year canteen facility 38 lakhs or 40 lakh, 3-year 50 lakh, 2-year 40 lakh. Which is better? You may say 40 lakh is better if you just go by the absolute amount, but one guy is 3-year, another guy is 2-year. To make them comparable, equated annual cost. What is equated annual cost? PV of outflow divided by annuity factor. What is EAB? NPV divided by annuity factor. NPV divided by annuity factor is called equated annual benefit. Outflow, present value of outflow divided by the annuity factor is called equated annual cost. If life is different, we need to compute EAC and select one with lower equated annual cost. Select one with lower equated annual cost. Clear? Able to understand this? Any doubts on the concept? There will be projects where only outflows are given, or there can be a situation where the project only has outflow. Example, canteen facility, only outflow is there. There could be inflow for a project, but I don't give you the information. Then you cannot do the NPV analysis. If you do NPV, you will give a negative answer. Steps remain same, calculation remains same. Final name will be called as PV of outflow. Name will be called as PV of outflow, and we select the one which has lower PV of outflow. We select the one which has lower PV of outflow. Clear? Able to understand this? Any doubts till this? Any doubts on this? Let's see this in a question now. Let's come to 35. ABC Limited is planning to invest in a machinery for which it has to make a choice between two identical machine in terms of capacity X and Y. Despite being designed differently, both machine do the same job. Further details regarding both machine are as given below. Purchase cost 15 lakh, 10 lakh. Life 3 years, 2 years. Running cost 4 lakh, 6 lakh. If the opportunity cost of capital is 9%, you are required to identify which machine should the company buy. Which machine should the company buy? Nothing much for you to read. Any information on sales, anything there in the question? Any sales related information? Any inflow there in the question? Any inflow, one inflow which is rare can be salvage value, but that cannot make the NPV positive. Salvage value alone cannot make the NPV positive. So this is a project with only outflow. Is there a tax rate given in the question? No. So first I will do without tax rate, then I'll assume a tax rate and show you how answer changes. Without tax rate is very easy, nothing to be done. With the tax rate means you'll have to claim depreciation, you have to do all that adjustment. But without taxation, direct answer. Working note 1, PV of outflow, computation of PV of outflow of machine X. I technically need to do 3 steps. None of them are needed because cash flows are given directly. We'll directly write year cash flow PV of DCF. But technically we'll have to write all those steps. Year cash flow PV of DCF. Year cash flow PVF. PVF at what rate? 9%. DCF. Year cash flow PVF DCF. Cash flow PVF DCF. Year 0. How much we are investing in the machine? Negative 15. Negative 15. How many years is the life? 1 to 3 annuity. 1 to 3. 1 to 3 annuity. 1 to 3 annuity. On this 1 to 3, you have to pay how much? Negative 4 lakh. Tell me the annuity factor. 2.531. 10 lakh 12,400. Any salvage value in the question? Any salvage value? If there, Year 3, that is an inflow. One small inflow can come also. Put a total called as PV of outflow. You can remove the negative sign at this stage. Even if you write it also okay, but I feel it is better to remove the sign now. PV of outflow. 25, 12, 400. Better to remove the sign once this is done. Clear? What does this mean is, in 3 years, we are spending approx 25 lakh rupees. In 3 years, we are spending 25 lakh rupees on project X. Any doubts in this? Can we proceed? Working note 2, computation of PV of outflow of machine Y. Machine Y. Machine Y. Year cash flow PV of DCF. Cash flow PV of DCF. What is the outflow for machine Y? Negative 10. Negative 10. Negative 10. How many years life? 1 to 2. 1 to 2. 1 to 2. What's the amount? Negative 6. 1.759. Negative 1055. 400. 2055. 400. 2055. 400. 20 lakh 55,400. Any doubts on this? If I look at absolute amount, machine Y is better. Machine Y is better. You can understand canteen expenses 25 lakh rupees or 20 lakh rupees. Obviously, 20 is better. But this 20 lakh is for how many years? 2 years. And 25 lakh is for 3 years. So they are not comparable. They are not comparable. 20 lakh is for 2 years. 25 lakh is for 3 years. To make them comparable, we calculate EAC, equated annual cost. Any doubts till this first? Any doubts on this? Now write EAC is equal to EAC is equal to PV of outflow. PV of outflow divided by present value annuity factor R, comma life. Present value annuity factor R, comma life. R, comma life. Machine X. Machine X. 25, 12, 400. How many years is the life of this machine? Annuity factor is there in the note itself, 2.531. 2.531. 9 lakh 92,651 is the expense for every year. Equated annual cost is expense of every year. 992,651. 992,651. This is technically the expense I pay for every year, or indirectly you can say, assuming I want to get this machine on rent, You have to pay rent of 9,92,651. You have to pay rent of 9 lakh. Equated annual cost is like the rent payment for a year. For using the machine for 1 year, you have to pay rent of 992,651. Machine Y 20 lakh 55 400. 20 55 400 divided by 1.759. 11 lakh. We will go ahead with, you can write conclusion. The company should go ahead with machine X. Machine X. Go ahead with machine X. The company should go ahead with machine X as it has lower equated annual cost. Clear? Any doubts in this? Done? Can you proceed? Now this was without income tax. Now right. Rework with tax rate of 3%. Rework with tax rate of 40%. Rework with tax rate of 40%. With tax rate of 40%. Computation of PV of outflow of machine X, right? PV of outflow of machine X, write this. PV of outflow of machine X. If tax rate is there, what will happen? Let's see. Tax rate of 40%. Year cash flow, PVF at 9%, DCF year 0 fine, 123 fine, 2.531 fine. Amount will change. If tax rate is there, what happens? Let's see. Year cash flow, PVF, DCF. Machine Y will come in sometime. Let's just focus on machine X. Now come down right. Cash flow is equal to tax saving minus amount paid. Tax saving is inflow, amount paid is outflow. Tax saving is inflow, that is a positive item, and amount paid is a negative item. Amount paid is a negative item. How much is the amount paid by us? Sorry, 4 lakh. Now listen, don't write it. Listen. 4 lakh I will be paying, that is outflow. I will get tax benefit on the amount I pay as well as on the depreciation. On the amount I pay as well as on the depreciation. Can you tell me what will be depreciation per year? Depreciation per year is 5 lakh. 15 lakh divided by 3 years. 15 lakh divided by 3 years. 5 lakh is the depreciation. 5 lakh depreciation, 4 lakh expense, 9 lakh will be my loss. If I prepare a P&L, 9 lakh is my loss. 5 lakh expense, 5 lakh depreciation, 4 lakh expense. Revenue is not there. I have not given any revenue. 9 lakh is my loss. On that loss, I will save 40% tax. On the loss, I will save 40% tax. So tax saving is 4 lakh plus 5 lakh. 4 lakh plus 5 lakh. What is 4 lakh? Amount paid. 5 lakh depreciation. Both are loss in my books of accounts. They are loss in my books of accounts. Into 0.4. This is the tax saving I will generate. This is the tax saving I will generate. I still overall can be a negative outflow. Overall can still be a negative outflow. I'll explain again. 4 lakh expense paid, 5 lakh depreciation. If you prepare a P&L, sales 0, 4 lakh, 5 lakh, PBT negative 9. PBT is negative 9. On the negative 9, you save income tax. You save income tax. Tax saving is inflow. Tax saving is inflow and amount paid is outflow. Write this and tell me what is the net cash flow. Write this and tell me the net cash flow. Negative 40,000. This will reduce my PV of outflow now. Benefit of income tax, this will reduce my PV of outflow. Negative 40,000. Negative 40,000. Any doubts in this? Any doubts on the concept here? Anybody has any doubts on the concept here? Can we proceed? Negative 40,000. On the depreciation, technically, every question I can directly say depreciation into tax rate is the tax benefit, which is why we deduct depreciation and add it back. Now, minus 40,000. Tell me into 2.531 how much? 1 lakh, 1,240. Any doubts on 40,000? Any doubts on negative 40,000? Can you proceed? 16,01,240. Here itself, tell me the EAC also. PV of outflow divided by the annuity factor. Divided by the annuity factor. How much? So my annual cost is going down now. It goes down to 6,32,651. Earlier it was some 9,92, goes down to 632,651 because of the tax angle. 632,651. Any doubts in this? Any doubts in this? Clear? Can we proceed? Any doubts in this? Next machine. Next machine. Next machine. Year cash flow PVF DCF. Year cash flow PVF DCF. Cash flow equal to tax saving minus amount paid. Tax saving minus amount paid. I will get tax saving on the expenses. Tax saving minus amount paid. Minus amount paid. What is the expense we incur every year? 6 lakh. Depreciation 5 lakh. On this I'll get a benefit of 40%. On this I'll get benefit of 40%. Any expense you incur, you technically get a tax benefit on that expense. And any income you earn, you technically pay tax on that. 6 lakh plus 5 lakh into 0.4 minus what is the amount paid? 6 lakh. Cash flow is how much? Negative 160. Negative 160. Till now also the better project could be machine X only, but still with the taxes we are doing the calculation. 160 into 1.759. 7,28,505. Let me know if you get anything different. Gap is now lesser, but still the better machine is X only. The first machine is better. The gap has gone down little bit, but the better machine continues to be machine X. Income tax not there, directly write the amount. Income tax there, you will have to do this calculation. Any doubts on this? Can we proceed? Any doubts on this? Done? Can we? Any doubts? Clear? Okay, I move to the next concept, something called as abandonment decision. Now, let's understand what is abandonment decision all about. Now, till now, we have been learning when should I buy a new machine? Should I buy a machine or not? Should a purchase of machine happen or not? And for that purpose, we were calculating NPV, positive NPV, go ahead, negative NPV, rejected. Similarly, there can be something called as abandonment decision. What is abandonment is when should I give up an existing asset? When should I give up an existing asset? What does giving up an existing asset would mean? Let's assume I have a car. Now, I've used the car for 1 year. I've used it for second year, third year, fourth year, and maybe at the end of fourth year, I want to dispose it. I want to dispose it. Reason, if I keep using it, my expenses are increasing and the salvage value is going down. The scrap value or the salvage value is going down. So I want to know when should I sell an existing asset. For that, very simple. First choice is sell the machine today. Sell the machine today. If you sell the machine today, you will get some money out of the sale of the machine. You will get some value out of the sale of the machine. You sell the machine today. So let's assume by selling the machine today, I will get 5 lakh rupee. Okay, 5 lakh rupees is my inflow if I sell the machine today. Other option, use it for another 5 years and then sell it. Use it for another 5 years and then sell it. If you use it for another 5 years, year 1 you will earn 2 lakh, year 2 you will earn 1 lakh, year 3 you will earn 50,000, year 4 you will earn 80,000, year 5 you will earn some 1 lakh and then some salvage value. So you use it and then sell the machine. In that you get first year some money, second year some money, third year some money, fourth year some money, fifth year. The present value of that is 4 lakh 80,000. You sell it today 5 lakh, or you use it for 5 years. Use it for 5 years. That car I can sell it today. If I sell it today, I earn 5 lakh rupees. Another option is use it for first year, second year, third year, fourth year, fifth, sixth, seventh, whatever you want to, and then sell it. In that process you earn 480. Which is better? Participate. Which is better? Sell the machine today. Sell the machine today. I should go ahead and sell the machine today itself, which is very logical. Sell the machine today, because if you sell the machine today, you get 5 lakh. You sell it after 5 years, today's value of that is 4 lakh 80. This can also be called as NPV. This can also be called as NPV. How will you calculate NPV? Here is present value of continuation. Continuation is 4 lakh 80. Present value of continuation. Continuation is 4 lakh 80. Present value of selling today is 5 lakh. Continuation is 480 and selling today is 5 lakh. NPV is how much? Negative 20,000. So if you continue with the machine, you will lose 20,000 rupees. If you continue with the machine, you will lose 20,000 rupees. If NPV is positive, continue using the machine. NPV is negative, sell the machine today. NPV is negative, sell the machine today. Positive, continue using the machine. In this question, my advice to the company would be that go ahead and sell the machine today. Go ahead and sell the machine today. Able to understand the concept? Abandonment basically means when should I sell the asset? or should I sell the asset or not? For doing this, you have one, you sell today. When you sell today, cash flow is not direct calculation like this. You have to write sale value, book value, capital gain, capital loss, tax paid, tax saved, and NSV. How much you will get by selling it today. Another option is use it first year, second year, third year, fourth year, fifth year, sixth, seventh, eighth, whatever number of years, and then sell it. Whichever gives me better cash flow, I will prefer that. Whichever gives me better cash flow, I will prefer that. Any doubts on the concept here? Any doubts on the concept? Can we proceed? Okay, we'll do questions now. 36 is homework for you. Let's come to 37. It's a very simple question on abandonment. A manufacturing firm is re-evaluating an ongoing machine line. Assume that line has a 5-year life and the expected after tax cash inflow are 30, 35, 40, 45, 50. Machine could be sold today for 1 lakh 60,000 after taxes. After taxes is capital gain, capital loss, tax paid, everything considered. Appropriate discount rate is 10%. Suggest whether the machine can be abandoned. Suggest whether the machine can be abandoned. Today, if you sell, how much money you will get? 1 lakh 60,000. Other option is use it first year. If you use it for first year, how much you will earn? Participate, guys. How much? Second year, third year, fourth year, fifth year, and I'll sell it at the end of fifth year. They have not given any value for that, so no extra value. So is 160 better or earning 30, 35, 40, 45, 50 better? I have to decide. I cannot just add them. I'll have to discount it and then add them. I'll have to discount it and then add. Now, right, abandonment decision. Abandonment decision. Abandonment decision. Split into two. Sell today. Sell today. Sell today. How much you will get by selling today? Could be better, could be weaker, we don't know. Sell today 160. Sell later. I don't know the amount. I don't know the amount. If I sell it later, what is its value today? I don't know. Sell today 160. Great. Sell later. Come down and open year, cash flow, PVF at some discount rate is given in the question. 10%. DCF. Year cash flow, PVF, DCF. Year cash flow, PVF, DCF. Understand the logic, very simple. Abandonment means should you dispose of the existing asset or continue with the existing asset. Year cash flow, PVF, DCF. How much money are we getting from that project? First year 30,000. Second year 35. Third year 40. Fourth year 45. Fifth year 50. Please discount it at 10% and tell me the present value. Discount it at 10% and tell the present value. Tell me the present value at 10% discounting. I don't want the individual numbers. Just tell me the final number. 148. I hope everyone, sorry, different answer. 0.909, 27,270, 005, 148,005. Anybody needs the calculation? Can we proceed? 148,005. Can we? So I get this side 148,005. Which is better? Sell today. This we can call it as an NPV also. We can measure it as NPV also. What is NPV is by continuing how much you are getting and by selling how much you are getting difference. Any doubts first on this? Any doubts on 148,005? Now right, NPV of continuation is equal to NPV of continuation is equal to 148,005 minus 160. You earn 148 and you miss out on 160. If you continue, you earn 148, miss out on 160, which I don't want to do because negative. This is negative. Negative NPV of how much? 11,000. So as the NPV is negative, company should immediately sell. Can I answer without NPV? Yes, you can answer without NPV also. Without NPV also we can answer it. ICI uses the word something called as opportunity cost. Doesn't really matter. Answer is same. Your NPV, whatever I explained, 11,995. NPV of continuation is negative. Asset should be immediately discarded. Asset should be immediately discarded or abandoned. Any doubts in this? Very simple analysis. Abandonment decision doesn't come in exam, but this is needed to explain the next concept. Any doubts in this? Can we proceed? Any doubts on abandonment decision explanation? Can we proceed? Okay. Now comes another important angle called as replacement decision. Replacement decision. Now listen, very, very important explanation. Whatever you have learned till now will again come back here, but with little bit of extra adjustments. Whatever concepts I told you, we learned concept on opportunity cost, we learned concept on sunk cost, we learned concept on overhead calculation, we learned concept on interest rates, reward exclusion principle, some purchase at the beginning of the year. All those concepts will come back here with some extra analysis. First, let's understand a capital budgeting can have three types of decision. One is called new purchase, which is what you have been doing till now. Every question, we buy a machine, use the machine for 5 years and then sell the machine. Buy a machine, use it for 10 years, sell the machine. That is called new purchase decision. Positive NPV, purchase the machine. Negative NPV, don't purchase the machine. Then we learned opposite of purchase, which is called abandonment. What is abandonment is, should you sell the machine today or not? Then comes replacement, which is new purchase plus abandonment. What is replacement is, buy a new machine and sell a old machine. Buy a new machine and sell a old machine. You are going to sell your existing machine and buy a new machine. You are going to sell your existing machine and then buy the new machine. Sell your existing machine and then buy the new machine. When you do analysis, three steps remain same but with some changes. Step 1, initial outflow. Initial outflow for new machine is capital expenditure, working capital, but one inflow can come. What is inflow is net salvage value of old machine, because you will sell the old machine. You will sell the old machine. You are going to sell the old machine and then buy the new machine. You're going to sell the old machine and then buy the new machine. So outflow is equal to initial outflow of the new machine, inflow from sale of old machine today. Inflow from, why I am calling it as minus, when we do our calculation, outflow will be negative, inflow will be positive, but this is the net outflow. Net outflow. Step 2, inflow. What is step 2 inflows? You bought a new machine. The new machine should give me something better than the old machine. Old machine was giving me cash flow of 2 lakh rupees. New machine is giving me 4 lakh rupee. What is relevant is what is the difference? Relevant is only the difference. So CF80 of new machine minus CF80 of old machine. What is CF80 of new machine? Revenues, all expenses other than depreciation, less depreciation, PBT, less tax, PAT, add back depreciation, CF80 of new machine. Do for old machine, find the difference, find the difference. Similarly, terminal flow of new machine, terminal flow of old machine, how much extra, how much extra. So in these type of question, I have to do calculation two times, old machine as well as new machine, old machine as well as new machine, and find out how much extra is the new machine bringing in, how much extra is the new machine. If the NPV is positive, go ahead with replacement. NPV is negative, reject the replacement. NPV is positive, go ahead with the replacement. NPV is negative, reject the replacement. A small example, a company is considering replacement of an existing machine with a new machine. How much would be the initial outflow from the following information? Purchase price of the, can you first read this and tell me what is NSV of old machine? Calculate NSV of old machine. I'll wait for a minute. NSV of old machine. Sale value, book value, capital gain, capital loss. NSV of old machine. Net salvage value of old machine. Old machine, net salvage value. Sale value, book value, capital gain, capital loss, tax paid, tax saved, NSV. How much? 7,000. You're in the right direction, but not 7,000. 5,000. Sale value is 6,000. Book value is 2,000. We have capital gain here. We have capital gain. Capital gain is how much? And I have to pay tax. I have to pay tax. How much the tax paid? 1,000. NSV is, so whatever I pay for the new machine, 5,000 inflow will come. What I have to pay for the new machine? 8,000, 2,000, and working capital is current asset minus current liability. Working capital is current asset minus current liability. Working capital is current asset minus current liability, which is 3,000 minus 1,000. What are we paying? Purchase price, installation cost, capital expenditure, working capital. Capital expenditure 10,000, working capital 2,000, and you will sell the old machine. You will sell the old machine. So 10,000, 2,000, old machine will give me 5,000. Old machine will give me 5,000. Able to understand this? Any doubts on the concept here? Any doubts on the concept here? Clear? Can we proceed? In the initial outflow, now format will have capital expenditure, working capital, NSV of old machine. NSV of old machine. When you do in between flow, new machine separately, old machine separately, difference is called as the incremental cash flow. Terminal flow, new machine separately, old machine separately, difference is called as terminal flow, and the net difference is analyzed as NPV. Any doubts on the concept here? Any doubts on the concept? Can we proceed? Any doubts on the concept? Clear? Just give me a minute. Okay, let's do questions now. Let's come to question 38. You go through the question and then I'll explain. You go through 38. A minute or 2 minutes for you to go through the question. Okay. MNP Limited is thinking of replacing its existing machine by a new machine. Replacing the machine by a new machine, it's a replacement decision, which will cost 60 lakh rupees. Step 1, initial outflow. Initial outflow 60 lakh rupee. Company's current production is 80,000, but if you install the new machine, it will increase to 1 lakh. So new machine I'll do with 1 lakh units. Existing machine I'll do with 80,000 units. The selling price will remain unchanged at 200. A table is given. Existing machine has an accounting book value depreciated for tax purpose. It is estimated that machine will be useful for 5 years. The existing machine can be used for another 5 years. The new machine is also for another 5 years. You will see in the question. Supplier has said, I'll accept the old machine for 250. Market price is 150. It will become 35,000. New machine has a life of 5 years and a salvage value of 250. Calculate NPV of the replacement decision. So what we are going to do is, first step 1, initial outflow, particulars amount, capital expenditure, working capital, and NSV of old machine. NSV of old machine. Working note to in between flow, old machine separately, new machine separately, incremental difference. Incremental difference. Terminal flow, old machine separately, new machine separately, terminal difference. Working note 1, initial outflow. Initial outflow. Initial outflow, particulars and amount. Initial outflow, particulars and amount. Particulars and amount. Capital expenditure. Format, everything going to remain same with small changes. Capital expenditure, negative 60. Capital expenditure, negative 60. Concept is going to be almost same only. Working capital. Working capital. Any working capital requirement given in the question? Zero. Working capital is zero. NSV of existing machine today. I want to sell the existing machine today. I will sell the existing machine today. Reason is, I am buying a new machine. I don't need the old machine. I don't need the old machine. Come down. Note 1. NSV of existing machine. NSV of existing machine. I am buying a new machine, hence disposing of the old machine. I don't need the old machine now. By selling it, I may get some 1 lakh, 2 lakh, 3 lakh, some number I'll get that will be reduced from my 60 lakh outflow technically. NSV will be written as positive here because you're going to get an inflow, and indirectly 60 lakh may go down to 58, 55, 54, some number. Sale value. What is the sale value of this existing machine today? What is the sale value of the existing machine today? They have given two choices. Supplier has offered to accept the old machine for, and market price of the old machine today is, obviously I'll go with the supplier. Supplier, anyway I'm buying a new machine from him and he is ready to give me 2 lakh 50. I'll obviously give it to him. Other way around, this is 250, market is 450. I'll give it in the market. I'll give it in the market. So my sale value is 2 lakh 50. Sale value is 2 lakh 50. The old machine I will get 2 lakh 50,000. Less book value. Book value. Tell me, what is the book value? What is the book value? Why are we calculating the sale value less book value? What is the purpose of calculating? To calculate capital gain, capital loss, which works as per Income Tax Act. This adjustment which you're seeing now was done as one MCQ in 2 days back in the class. When I initially started, I did that MCQ. We have done this MCQ earlier itself, but that time you wouldn't have paid that much attention. That time itself I had explained, we are doing this calculation only for the tax purposes. Only for the tax purposes. There is an income tax book and there is a Companies Act book. We are only bothered about what happens in income tax. Companies Act, we are not bothered. So in books of accounts, you can have value, least bothered about that. It is fully depreciated for tax purpose. So book value is 0. Capital gain 50. Capital gain 250. Capital gain 250. Any doubts on this? Capital gain is 2 lakh 50. On this, tax paid, what is the rate? 1 lakh rupee you have to pay. Leave a line NSV. Sale value plus or minus tax. Sale value plus or minus tax. Sale value plus or minus tax. Let me know what is NSV. Please participate. 1 lakh, 2 lakh 50,000, which is your sale value minus 1 lakh tax which you pay. 1 lakh 50,000. Any doubts on this? I write this 1 lakh 50 here. 58 lakh 50,000 is the initial outflow. I will have an outflow of 5850. Initial outflow is 58 lakh 50,000. How will I have 5850? Buy the new machine for 60 lakh, sell the old machine for 1 lakh 50,000. Any doubts on this? Working note 2, in between flow. Particulars, new machine, old machine. You can write in any order, old first, new first, that's okay. Particulars, new machine, old machine. The gap between the two is the extra income. New machine and old machine. New machine, how many units we are going to do? 1 lakh units, so in bracket 1 lakh. Old machine, new machine, old machine, 1 lakh and 80,000. 1 lakh and 80,000. I write the format, you fill it later. Revenues less material cost. I'm writing the format, you also write format and then you fill it. Wages and salaries, whatever table, less supervision. Only request is don't look at the answer. You do it, you will make some mistakes. Repairs and maintenance, power and fuel, depreciation, overheads, PBT, less tax, PAT, add back depreciation, CFAT. Various items are given in the question: material, wages, supervision, repairs and maintenance, power and fuel, depreciation, overheads. Deduct all of this, you will get profit before tax, deduct tax, profit after tax, add back depreciation, cash flow after tax, add back depreciation, cash flow after tax. New machine is for 1 lakh unit, old machine is for 80,000 units. Every data is given: 75 rupees, 63 rupees. You do whatever you want to do. New machine and old machine. Clear? I give you around 5 minutes. Complete this table and then I'll discuss. 5 minutes for you. Okay, I'll discuss the answer now. The revenues are, what is the selling price given in the question? 200 per unit. 1 lakh into 200 into 200, 2 crore. 80,000 into 200, 1 crore, 60 lakh. Only request is I didn't want you to see the answer. Some of you have tried seeing it. It is not at all acceptable. 1 lakh into 63.75, 63 lakh 75,000 and 80,000 into 75, which is 60 lakh. Wages and salary 1 lakh into 37.5, which is 37 lakh 50,000, and 80,000 into 51.25, which is how much? 41 lakhs. Supervision 1 lakh into 1 lakh into how much? 25, which is 25 lakh, and other side is 80,000 into 20, which is 16 lakh. Repairs and maintenance 1 lakh into 7.5, 7 lakh 50,000, and 80,000 into 11.25, which is 9 lakh. Power and fuel 1 lakh into 14.25, which is 14 lakh 25,000, and 80,000 into 15.5, which is 1240. Depreciation 1 lakh into how much? 5, and the other one is 80,000 into 0.25, 5 lakh and 20,000. Over it's 1 lakh into how much they've said? 12.5, 12 lakh 50, 80,000 into 10. Any doubts in these numbers? Any doubts in these numbers? Anybody has any doubts in these numbers? If you don't have doubt, I have a lot to worry about. Any doubts in these numbers? That you have to tell. No, why will I tell you? You will have to tell me what is the confusion here? What is the change I have to do? Overage is irrelevant. Overage is irrelevant. What is the word used there? Allocated. More than the word allocated, the important is corporate. It is a corporate overhead. It is a corporate means general. 0, 0. Any doubts? Depreciation is also wrong. Depreciation is also wrong. Existing machine is already fully depreciated. How can I claim depreciation under Income Tax Act? Books of accounts, no use. Under Income Tax Act, it is 0. Under Income Tax Act, it is already fully depreciated. If an asset is already fully depreciated, how can I claim depreciation on that asset? Already fully depreciated. And this is also wrong because under income tax, I have to follow SLM method. This is what the question has said, which is 60 lakh cost. What is the salvage value of the new machine? Divided by how many years? This is what depreciation, that into 5 is the books of accounts, has no utility, has zero utility. These two mistakes I did. Some of you should have done the mistake. I see some of you going through the answer when I tell you to do it. It doesn't serve any purpose. If that is what you want to do, then I'll give you the answers directly. I want you to practice, make mistake, correct with a different pen. Unless you make mistakes, you will not understand concepts. What is the depreciation figure? 11 lakh 50,000. Beyond this, just a formality. Tell me the PBT figure now. Deduct all of this. PBT figure is 40 lakh 50,000. PBT figure is 40 lakh 50,000. Let me know if you get anything different there. You can check the numbers and tell me in case you're getting anything different. Are you getting these numbers? 40 lakh 50. Guys, participate. I'm not talking to my laptop. I'm talking to you guys. You'll have to tell me, is it right, wrong? Tell me the PBT for the other one. 21. 21 lakh 60,000. 21 lakh 60,000. Profit before tax 40 lakh 50,000 and 21 lakh 60,000. Two places mistakes would have been done. In case you have not looked at the answer, I am 100% sure two places you would have made mistake, and which is what past students many times have made. Just looking at the answer will not serve any purpose. Again and again I keep repeating this only. Why do I give you time? Because if I do, I will not make that mistake. And if I don't make the mistake, you will also not make it and you will feel okay, everything is fine. This is easy to understand. What is the tax rate given in the question? 40%, 16 lakh 20 and 8 lakh 64, PAT 24 30 1296, add back depreciation 1150 0, 1150 and 0, add back depreciation 1150 and 0, 3580 and now the new machine does not give me 3580. The new machine gives me what is incremental, extra. What is the benefit of new machine is that extra part. Incremental CF80. Tell me the difference. Incremental CF80. Tell me the difference. 22. Listen, in this question, we are yet to do terminal flow, but till now, I invest 58 lakh 50,000 and earn 22 lakh 84,000 extra for first year, second year, third year, fourth year, fifth year. Extra earning is 2284. Extra earning. What is extra is new machine minus the old machine. New machine minus the old machine. 2284 is the extra CF80. Extra CF80. Any doubts on this? Can we proceed? Any doubts on this? Working note terminal flow. Particulars new old. Particulars new old. New old. New machine old machine. Listen, when we did step 2, we calculated new machine minus old machine. What practically is only one machine is going to exist. It's not that both machine exist. But still we did new machine separate calculation, old machine separate calculation and found out the difference. Same way, terminal flow also, new machine one calculation, old machine another calculation and the gap. It's not that both machine will exist. The calculation is done as if old machine continues, as if new machine is purchased and the difference So NSV underline that. NSV underline that. Sale value. Tell me the sale value of the new machine after 5 years. 2 lakh 50,000. Sale value of the old machine after 5 years. Sale value of the old machine after 5 years. How much? It's given. There is a value. No. Where is 2 lakh? You will have to be louder, guys. I'm not able to hear it. 35,000. They said market price of old machine today is 1 lakh 50 and expected to be 35,000 after 5 years. Book value. What was the cost of the new machine? Everyone participate. 60 lakh and I charged 11 lakh 50 into 5. 11 lakh 50 into 5. 11 lakh 50 into 5. We have charged 11 lakh 50 into 5. 60 lakh minus 1150 into 5. How much? Listen, old machine today itself is already fully depreciated. So the value will be only 0. Listen, in a replacement decision, NSV of old machine is computed 2 times. You compute in step 1 as well as in step 3. You compute in step 1 as well as in step 3. Step 1, sale value today, book value today, capital gain today, tax paid today, NSV today. This will really come to me and that is why it was considered as an inflow. In step 3, to find out what extra is coming, we do old machine separately, we do new machine separately. So here old machine sale value after 5 years, book value after 5 years, capital gain after 5 years, tax paid after 5 years, and NSV after 5 years. After 5 years, one calculation, today one calculation. Any doubts on this? Any doubts on the computation or logic here? Now, capital gain, capital gain, capital gain of new machine is 250 minus 250, which is 0. Old machine has a capital gain 35,000. Incremental concept, just keep in mind, incremental means extra. What is extra coming out of the new machine? Tax paid 0. What is the tax rate? 14,000. Leave a line. NSV, sale value plus or minus tax. NSV, sale value plus or minus tax. Sale value plus or minus tax. Sale value plus or minus tax. Sale value is 250, no tax payment. So NSV is 250. NSV is 250. Other side 35,000 minus 14,000. And what ultimately matters is how much extra. Incremental. Incremental. One of the core concept is incremental concept. Incremental. Incremental terminal inflow. Extra is 229. New minus old always. New machine minus old machine. There can be a rare scenario where terminal inflow can be negative also. How? New machine 2 lakh, old machine 4 lakh. Rare scenario. New machine 2 lakh, old machine 4 lakh. 2 minus 4 will become negative 2. New machine minus old machine. New machine minus old machine. Always your incremental CFAT, if you see, it is new minus old. Similarly, if you see terminal inflow, new minus old. Any doubts on this? Any doubts on this? Clear? Any doubts on this? Now we will have to consolidate this and calculate NPV. Positive NPV, go ahead with replacement. Negative NPV, reject the replacement. Next, working note 4, computation of NPV. Computation of NPV, year cash flow PV of DCF. Year cash flow PV of DCF. What is the discount rate given in the question? PVF at 15%, DCF. Step 1 will give me year 0 figure. Step 2 will give me 1 to 5 figure. Step 3 will give me terminal inflow. Everything remains same. Only thing is earlier you were doing one column. Now you are forced to do a new machine column and an old machine column and find the difference. That's an extra calculation we are forced to do. Year cash flow PV of DCF, year 0. Year 0. Year 0. Look at step 1 and tell me the outflow. 5850. 5850. Very simple concept. Step by step you go, you will get to the answer. 5850. 1 to 5 years. Look at step 2 and tell me what is the inflow. 2284. Tell me the 5th year annuity factor. 1 divided by 1.15. Before you press the GT button, write the 5th year factor also because you will need that. 1 divided by 1.15. First year, second year, third year, fourth year, fifth year. I'll first write the 5th year factor. 3.352. 3.352. 3.352. Fifth year is 0.497. 3.352. 352. 0.497. Any doubts? Your cash flow was 2,29,000. Complete this. If you get positive NPV, go ahead. Negative NPV, reject it. NPV is positive. Company should go ahead with replacement. What is replacement? Sell the old machine, buy the new machine. Sell the old machine and buy the new machine. Any doubts on 1919 Conclusion: the company should go ahead with the replacement of old machine with the new machine. We are having positive NPV. We should go ahead with the replacement. We should go ahead with the replacement as the new machine is better than the old machine with the positive NPV generation. Any doubts on this? Clear? Any doubts on this? Able to understand this? It's very similar to the previous. The cash flow calculation, everything concept is already done. Just that I'm doing two extra column now, new, old. Earlier we were doing just one column and we were closing it. In this, there can be a situation where you have to do 5 years new machine, 5 years old machine. All that can come on. You will see as we proceed. Any doubts on this? Clear? Done? Clear? Okay, let's take a break of 10 minutes. Let's come to question 41. Question 41. I'll come back to other questions later. Okay. Question 41. WX Limited has a machine which has been operation for 3 years. Its remaining life is 5 years with no salvage value in the end. Current market value is rupees 2 lakh. Company is considering a proposal to purchase a new model of machine to replace the existing machine. Relevant information is as follows: existing machine, new machine, cost, life, salvage value, output, selling price, annual operating hours, material cost, labor cost, indirect cash cost. Company uses written down value method of depreciation. Written down value method of depreciation at 20%. Has several other machine in the block of asset. What is block of asset? I'll explain in this question. Income tax rate is 30%. Does not make any investment if it yields less than 12%. Advise whether existing machine is to be replaced or not. Very similar to the previous question, but only thing is it is something called as block of asset method. Go through the question. Okay, before I do this question, I'll explain something called as block of assets method, which is there in income tax. People who have already done DT, for them this will be very simple to understand. People who are yet to do group 1, for them it could be little difficult to understand. So let me first explain that and then we proceed. What is block of assets method is under Income Tax Act, you don't charge depreciation on every asset individually. They follow something called as a block of assets method where all assets are clubbed together. All assets are clubbed together and you charge depreciation on the entire block value. So under block of assets method, no capital gain or capital loss unless the block is exhausted. What is block is exhausted is I had an asset with 1 lakh rupee. I add another asset with 2 lakh rupee. I add another asset with 3 lakh rupee. I add another asset with 4 lakh rupee. I sell an asset for 1 lakh rupee. I sell an asset for 2 lakh rupee. When I add an asset, block value increases. When I sell an asset, block value decreases. Buy, block value increases. Sell, block value decreases. Till there is a block value, the block will not get exhausted. How can it become exhausted? You purchased 1 lakh, so purchased 2 lakh and sold something for 5 lakh. Rare scenario. Purchase for 1, purchase for 2 lakh and sold it for 5 lakh. Block value will become negative. Block is exhausted. Block value will become negative. Block is exhausted. That time only capital gain or capital loss will arise. That time only capital gain or capital losses arise. Or there was only one asset in the block. That asset you sold, block is exhausted. That asset you sold, block is exhausted. Whether value becomes negative or not, value is exhausted. So no capital gain or capital loss unless the block is exhausted. Most of the time, no CG calculation. Then depreciation will be calculated on something called as incremental value of block. What is incremental value of block is, there was an earlier block value, add something to the block, remove something from the block, extra value arises. Extra value arises. So you will understand this when I do the question here. Depreciation is on the incremental value of the block. Because it is WDV method, I'm going to do it in the Excel. I'll first do a detailed approach. Then I'll explain a shortcut approach. Shortcut, when I explain directly, students were not understanding it. So I'll explain a detailed approach of calculation. Then I'll do a shortcut approach. Both will give same answer. Both will give same answer. Clear? We will do a detailed approach. Then we will do a shortcut approach. Now coming to the question, WX Limited has machine which is in the operation for 3 years. Remaining life is another 5 years. Today, if you want, you can sell it for 2 lakh rupees. Today, you can sell it for 2 lakh rupees. No capital gain, capital loss. Reason is, one machine will go, another machine will come. Block of assets method, no capital gain, capital loss, which is mentioned in the last line of the question. It has several other machine in the block of asset. It has several other machine in the block of asset. So it could be having some 10 machines, 20 machines, 30 machines, we don't know. Several other machines are there in the block of assets, because of which what will happen is block will not get exhausted. Once block is not exhausted, no concept of capital gain, no concept of capital loss. This is the only thing you need to know. No capital gain, no capital loss, and depreciation is calculated little differently. I'll explain that also. Particulars: existing machine, new machine, cost, life, salvage value, output, selling price, all that data is given. You are required to advise whether the existing machine is to be replaced or not. I will be doing it. I don't want you to do anything here. Okay. Working note 1 will be initial outflow. Initial outflow. Particulars and amount. Give me the capital expenditure for the new machine. Capital expenditure for the new machine in lakhs. Capital expenditure for the new machine, cost of the machine 10 lakh rupee. We could have done it if it was SLM method. WDV, I don't want to spend, you will spend a lot of time on the calculation, and there is a shortcut approach, detailed approach. Shortcut you can try in notebook, but shortcut students were not understanding initially. So I'll do a longer approach, then I'll explain the shortcut approach. 10 lakh is the capital expenditure. No working capital. Sale value of old machine. No concept of capital gain, capital loss. Okay, 2 lakh. Net initial outflow 8 lakh. Net initial outflows 8 lakh rupees. Any doubts on this? Any doubts on this 8 lakh rupee? Working note 2 is in between flow. In between flow. I'll first explain the longer approach, then we'll come to the shorter approach. Old machine. Old machine. How many years is the life? 8 years total life. 3 years is over. Let's not worry about what is over. Balance is 5 years. Balance is 5 years. Only challenge is WDV method. The biggest problem for me in this question is WDV method. Otherwise, we would have done it together. Okay. Tell me the sales. Just focus on old machine and tell me the sales. Old machine, tell me the sales. 30,000 into 15. 30,000 into 15. Sales is 30,000 into 15. 4 lakh 50,000. It will be a very lengthy calculation. Long approach I'm explaining, then I'll explain a short approach. Short approach, many students did not understand initially. That is why I'm doing a longer approach. Sales is 4 lakh 50. Any doubts in this? Tell me what are the expenses. I want participation, guys. Material cost 30,000 into what? 4. 1 lakh 20,000. Then what is the next expense? Labor cost. How many hours? That is per hour they've mentioned. 3,000 hours into 40 hours into 40 per hour. 3,000 hours into 40. 120. 120. Then we have indirect cash cost. Indirect cash cost is how much? 50,000. PBDT. There's a reason for writing PBDT. 160. 160 less depreciation. PBT less tax. PAT. Add back depreciation. CF80. Add back depreciation and CF80. PBT less tax. PAT. Add back depreciation. CF80. Now depreciation has to go through WDV method. It has to go through WDV method. So below this, note 1, computation of depreciation. What was the cost of this machine? How much? But was acquired how many years back? Acquired how many years back? 3 years back. Already 3 years is over. Another 5 years is there. Another 5 years is there. And the depreciation rate is 20% under which method? WDV method. Let me visualize now. Particulars, year -3, year -2, year -1. What are these years? These are already gone, already over. Why I'm writing, you will understand. Okay, year -3, -2, -1, and then future. Year 1, year 2, year 3, year 4, year 5. It is WDV method is the challenge. The challenge is only W. Last question also 4 years ago was there, but that was SLM method. I didn't have any problem. Year -3, -2, -1, 1, 2, 3, 4, and 5. Opening balance less depreciation, closing balance. What was the cost of this machine? 3 lakh 30. What was the depreciation rate? 20%. So I charge depreciation into 0.2. This whatever I'm doing is not there in your workbook. Okay, in workbook I've given a shortcut approach which students were not getting it, so I'm explaining the detailed approach. 330, 20%. Closing balance is 264. This becomes the opening balance. You charge depreciation. It goes on like this. Okay, now what is critical for me is these figures: 1 year, second year, third year, fourth year, and fifth year. 3 years already over. I'm not bothered about it. I'm not bothered about all those years. What I'm bothered about is only the future. What I'm bothered about is only the future. Future is year 1, year 2, year 3, year 4, and year 5. Any doubts in this? Any doubts in this? Clear? Can we proceed? So I write the depreciation figure now. In case you find difficulty with the complex question, ignore them and go with at least the base set of question. Exam complex calculations will not come mostly, but if it comes, I cannot leave it because then students will say we did not complete it. That is why I'm discussing it. But in case you're finding it difficult to do the complex computation, mostly the WDV method, any other question, you'll be in a position to handle it very fast. This has not been tested that much, but it can come because these are study material question. I get PBT What is the tax rate given in the question? 30%. I get PAT. I have to add back depreciation. All this calculation will obviously take a lot of time at your end. We get CFAT. This was for the existing machine. This was for the existing machine. Any doubts on this? Any doubts on this? Then I'll come to the shortcut in some time. Any doubts on the existing machine? I give you a minute. You can just go through the calculation which is presented here and the depreciation. Nothing is there in the notebook. Nothing is there in the notebook. A minute for you to just go through this. I'll repeat the calculation for new machine. I'll have to repeat the calculation for new machine. Tell me the revenues of new machine. New machine, what is the revenue? 75,000 into 15. 1125. 1125. Material cost is what? 75,000 into 4. 75,000 into 4, which is 3 lakh. Labor cost is how much? Into 70. 72 lakh 10,000. Indirect cash cost is how much? 65,000 directly. Okay, 65,000. I have to do now depreciation calculation. Now, particulars and 5 years. Particulars and 5 years. Under block of assets method, what will happen? I'll explain you. We were at this level. We had a block value of 168,960. We had a block value of 168,960. That was the value of the block. That was the value of the block is how much? 168,960. The value of the block was 168,960. On this value, you added another machine. Under Income Tax Act. This you will understand in income tax. Some of you would be able to relate to it. For some of you, it could be little challenging. 168,960 is the value of the block today. On top of it, you buy another machine. What is the cost of another machine? 10 lakh. You sell your old machine. That will be removed from the block. Add new machine, remove old machine. Add new machine, remove old machine. Sorry, add new machine and they remove the old machine. So from 168,960, my block value will go up by 10 lakh and will go down by 2 lakh. Go up by 10 lakh. What is 10 lakh? Capital expenditure of the new machine. What is 2 lakh? The sale value of the old machine. 168 is already there. Add 10 lakh, remove 2 lakh. Add 10 lakh, remove 2 lakh, and then I'll tell you the shortcut once this is done. This value is, can you tell me what is the opening balance now? 968, 960, 968, 960, 168, add 10 lakh, remove 2 lakh. Under income tax, even if you buy asset worth 10 lakh, no, they'll allow depreciation only on 968, 960. This is how income tax works. 168, add 10 lakh, remove 2 lakh. Add 10 lakh and remove 2 lakh. This is called block of assets method. Add 10 lakh, remove 2 lakh. Add 10 lakh, remove 2 lakh. Any doubts on the calculation here? Same thing now. What is the WDV rate? Depreciation rate? 20%. Clear? And now I will be writing less depreciation. These figures, less depreciation, these figures. PBT, less tax, PAT, add back depreciation, CFAT. All those rules remain same, okay? Now I have new machine, I have old machine, I have to find the difference. I have new machine, I have old machine, I have to find the difference. Once all these are done, I'm going to explain the shorter approach. I'm going to explain the shorter approach. Any doubts on the calculation here? Most important calculation is 168 plus 10 lakh minus 2 lakh. Later on, I'll say you this is not even needed. There is a short way to get to the answer, but students were not understanding the shorter way. I tried explaining a lot, but they were finding it little difficult to grasp. So my incremental CF80 is new machine 443, old machine was 128. These are the numbers: 321, 311, 303, 297, 292, which is what you will see in the book, but with a shorter approach. It would have been a shorter approach: 321, 311, 303, 297, 292. But I have not done such a detailed calculation there. I've done a shorter approach. I'll explain the shorter approach now. Any doubts on the numbers here? It is exactly same as one important concept: 168 plus 10 lakh minus 2 lakh. This also you don't need. You really don't need even this also, because there is a shorter way. Any doubts first on this? Any doubts on this? Shorter approach. Shorter approach, which is what there in the book. Shorter approach is what there in the book. Okay, I'll now explain the shorter approach. This is what it is possible for you to do in exam. Any doubts on the cash flow? Once that cash flow is calculated, problem is over. Write it here. Calculate NPV. Go ahead with positive. Reject the negative. All that is okay. All that is not my headache. Go ahead with positive NPV. Reject the negative NPV. All that is fairly simple, straightforward calculation. Only challenge is doing so much computation. If somebody gives me an Excel sheet and tells me to do it, I'll do it like this only: new machine separate calculation, old machine separate calculation, find out the difference. Now what I did is incremental PBDT, incremental PBDT less incremental depreciation, incremental PBT less tax, incremental PAT, add back, depreciation, incremental CF80, which is what ICI did, and they are perfect in doing this calculation. What is incremental PBDT? You have to do 1 year for old machine, 1 year for new machine. In this question, I purposefully wrote PBDT because I will need PBDT. I will need PBDT. PBDT is 5 lakh 50 and PBDT is 1 lakh 60. 5 lakh 50 and 1 lakh 60. So this difference is every year same amount: 5 lakh 50, 1 lakh 60. Incremental depreciation, no new machine calculation, no old machine calculation. Block of assets method say that you have to claim depreciation. You have to claim depreciation on, you have to claim depreciation on purchase price of the new machine minus the sale value of the old machine. Purchase price of the new machine minus the sale value of the old machine. Don't do anything else. Claim depreciation on purchase price of new machine, sale value of old machine. Purchase price of new machine, sale value of old machine. Under block of assets method, no need to do 968, no need to do all that earlier calculation. Can you tell me what is the purchase price of the new machine? 10 lakh. Sale value of the old machine 2 lakh. Please charge depreciation only on 8 lakh. Directly on 8 lakh. Purchase price of new machine, sale value of old machine. Charge depreciation on 8 lakh. Charge depreciation on 8 lakh. I take it up. Depreciation figure, only one calculation: no old machine, no new machine. Purchase price minus sale value. I'll explain this again once I'm done with this part. Incremental PBT, what is the tax rate? 30%. Incremental PAT, depreciation and CF80, which is what are those numbers with such a lengthy calculation. We had to do such a lengthy calculation. Reason is I could have done this directly also, but students were not understanding it in the past batches. So you see the numbers here: 321, 311, 303, 297, 290 to 661. Now I'll explain what you need to do. Incremental PBDT. What is incremental PBDT? PBDT of the new machine minus the PBDT of the old machine, which is what you will see in the solution. In the solution, PBDT 3 lakh 90. How did 3 lakh 90 come? 160 5 lakh 50 difference. 160 5 lakh 50 difference. Depreciation. This itself is a very lengthy calculation. This itself is a very lengthy calculation. You remove all this and please write this table in your book. Depreciation, this is the table. Particulars, year 1, year 2, write it in the book itself. Remove that entire calculation. This itself is a very lengthy calculation. I don't need that also. Particulars, year 1, year 2, year 3, year 4, year 5. Year 1, year 2, year 3, year 4, year 5. Write this please. Depreciation in the book itself. Particulars and 5 years. Particulars and 5 years. Remove this. This also is same only, but this is a very lengthy calculation again. Remove this. Particulars, year 1, 2, 3, 4, 5. Year 1, 2, 3, 4, 5. Particulars and 5 years. Particulars and 5 years. Particulars and 5 years. Opening balance. Opening balance. What is opening balance? Is cost minus sale value. Cost minus sale value, which is 8 lakh. Less depreciation. You please do the calculation. 8 lakh. 20%. 160. 640. 640 opening balance. 128. 512. 512. 102 400. 409 600. It will go on. That calculation there is very lengthy computation. This is the table you should have. 8 lakh, 160, 640, 640, 128, 512, 512, 102 400, 409 600, and goes on like this. It goes on like that. Clear? And my answer is done that way. PBDT less depreciation, PBT less tax, PAT add back depreciation, CFAT. Again, my request in this chapter, I had one option to remove these questions, another option to discuss these questions in the class. Reason for discussing the question is they are study material question. I didn't want to remove them. So in case you find it very challenging, then ignore these questions. If you find it very challenging, ignore. I normally don't say this for any topic, but here, because of the huge computation, for example, question 41 is in that category. If you are not able to follow the calculation, ignore it. Ignore question 41. Question 39 is not that difficult. That calculation is easy to follow, no problem. 38, not a problem. 37, not a problem. 36, 35, 34, all that is not a problem. If you are not able to follow 32, ignore it. I really don't have a choice. Question 32 can be ignored. In case in the revision phase, you are finding it difficult. Now also you are finding it difficult. Student, focus on the complex question. There were 2-3 questions which I said I will do and you will be in listen mode. So in that category, even in the previous session, yesterday we did, I think we did 29. If you want, you ignore it. We did 28, if you want, you ignore it. Other questions, you should be in a position to handle. Other questions, I don't see challenge. 28, 29, and the question which I just discussed, and that quick delivery commission question which we did together, but we did not do all the years. If you are finding it difficult, don't focus on those questions. First complete everything else. You still have time, then please do these questions. I had a choice to remove the question. I didn't do it. I have discussed it in the class, but I leave a choice to you. Okay. With this, that question will get over. You will get the cash flow. Then you will calculate the NPV. Put the cash flow and calculate the NPV. With this, this chapter is almost over. I have few more questions which I'll discuss in the next session, and then we will move to the next chapter. A heavier chapter because of these extra question. Okay. One choice is to remove those. It will become very, very simple for you to do. Any doubts? Any doubts on this? Clear? I'll end with this then. Okay, let's come to some balance spending question. Today this chapter will get over. Let's come to 42. WX Limited is considering a proposal to replace an existing machine. Details of existing machine and the new machine are as under: cost of machine, existing, new machine, estimated life, present book value. Out of the life of 10 years of present machine, 5 years have already lapsed. Management can continue with this machine for the remaining lifetime. Activity level is same. Residual value of new machine is 60,000. There will be a saving of 240 in the variable cost. If the old machine is sold, then it will fetch 90,000. Minimum return of 11%. No depreciation is to be charged in the year of sale. You are required to comment on the suitability of replacement of the old machine. I give you a minute, go through the question. Okay, let's understand the question. Company is planning to replace an existing machine. So obviously this is a problem on replacement decision. We are planning to replace an existing machine. What is the life of the existing machine as per the question? 10 years. And how many years is already over? 5 years. So the existing machine has a balanced life of 5 years, and the new machine has a life of 5 years. My step 1 is initial outflow, where I write capital expenditure, working capital, and NSV of the old machine today. What is NSV of the old machine? What is the sale value of the old machine today? 90,000. Book value is given here. Book value is given here. How did that 187,500 come? Is very simple. 375 by 10 is 37,500. So 37,500 into 5 years is the depreciation charged, which is 187,500. 375 minus 187 is balance 187. 375 minus 187 is balance 187. Now, management can continue this machine, or I can shift to the new machine. What is the benefit of the new machine? What is the benefit of the new machine? Saving of 2,40,000 in the variable cost by the new machine. The new machine and old machine separate cash flow and all not possible, because they have not talked about what is the revenue of the new machine, what is the revenue of the old machine. They have not talked about fixed cost. They have just told only one information: variable cost will reduce by 2,40,000. So here we are going to follow something called as directly the incremental analysis. What will happen in incremental analysis is saving in variable cost is inflow, then depreciation will be deducted because there are no other expenses. Depreciation will be deducted. You will get PBDT less depreciation, so PBT less tax, PAT, add back depreciation, CFAT, and then we close. Now, new machine is going to be useful for how many years? 5 years. Old machine balance for how many years? 5 years. Every year I save the same amount. Depreciation, have they mentioned any method of depreciation? So we'll follow SLM method. We'll follow SLM method. Only changes, no depreciation is to be charged in the year of sale. So when I do my in-between flow, 1 to 4 years will be a separate calculation. and fifth year will be a separate calculation. Reason is fifth year you will not charge depreciation. In the last year, depreciation will not be charged because question has said no depreciation is to be charged in the year of sale. So 1 to 4 a separate calculation, year 5 a separate calculation. Good part SLM method. WDV means every year separate calculation. 1 to 4 separate computation, year 5 separate computation, because last line says no depreciation should be charged. So assuming I shift to the new machine, fifth year no depreciation on new machine. Assuming I had continued with the old machine, no depreciation for the 10th year of the old machine. It would have become 10th year as far as the old machine is concerned. Clear? That's the only add-on adjustment. Working note 1 initial outflow. Working note 1 initial outflow. Initial outflow. Particulars and amount. Initial outflow. Particulars and amount. Capital expenditure. Initial outflow. Particulars amount. Capital expenditure. Tell me what is the capital expenditure of the new machine? 5 lakh, negative 525, negative 525, capital expenditure negative 525, NSV of old machine. I'm going to sell the old machine. By selling the old machine, we will get back some 1 lakh, 2 lakh, some amount will come back to us. Come down, note 1, computation of NSV of old machine. NSV of old machine. NSV of old machine. We are going to sell the old machine and that is going to give us some income. NSV of old machine. Sale value. Tell me what is the sale value of the old machine? If I sell it today, it is 90,000. Another NSV will be done later. We'll see that. 90,000. Sale value at year 0. Book value. What is the value today of the old machine? 187,500. Again, I'm writing it because sometimes if they don't give 375 minus 37,500 into 5 years. 5 years have got over. 375 minus 37,500 into 5 years. Into 5 years. 375 minus 37,500 into 5 years. How much is the book value? 187,500. Capital gain, capital loss. Participate. I want participation. Capital gain, capital loss. Capital loss. Book value is higher. Capital loss. How much is the loss? 97,500. Capital loss 97,500. Capital loss 97,500. Capital loss 97,500. Tax saved. What is the tax rate? 30%. 97,500 into 30%. 29,250. 29,250. 29,250. Tell me the NSV figure. NSV of old machine. 119,250. 119,250. This amount I will get by selling the old machine today. I will sell the old machine today and earn 119,250. Earn 119,250 by selling the old machine. Any doubts on this? Any doubts on this? Clear? Can you proceed? Initial outflow. Initial outflow. How much is the outflow? 405 750. 405 750. That is my initial outflow. That is the initial outflow. Any doubts on this? Clear? Can we proceed? Initial outflow is 405 750. Now I'm going to use the new machine in place of the old machine for a period of 5 years. Ideally, they should give me amount to calculate CFAT of new machine, CFAT of old machine, and then we find the difference. Here, no information like that. Only thing I know is that there will be a saving of some 2,40,000 every year. There are no expenses detailed. So we will have saving in cost and deduct directly depreciation. Which depreciation? Incremental depreciation. What is incremental depreciation? New machine depreciation minus the old machine depreciation. How many years? First year, second year, third year, fourth year, no for fifth year, because depreciation is not charged in the year of sale. Depreciation is not charged in the year of sale. Last line says no depreciation is to be charged in the year of sale. Next, working note to in between flow. Working note to in between flow. Particulars and two columns, year 1 to 4, year 5. Year 1 to 4 and year 5. 1 to 4 and year 5. Year 5 separate because last year we cannot charge depreciation as far as the question is concerned. That's the information in the question. No depreciation is to be charged in the year of sale. Year of sale would basically mean the last year of the machine life. No depreciation is to be charged in the year of sale. Saving in variable cost. Saving in variable cost, how much? 2,40,000. Saving in variable cost 2,40,000. Saving in variable cost 240. Less depreciation. Tell me, what is the depreciation of the new machine? Cost minus salvage value divided by life. New machine depreciation. Cost minus salvage value divided by life. What is the cost of the new machine? 5,25,000. Salvage value 60,000. Life 5 years. So it is divided by 5 years. Fifth year we can't claim depreciation. That is, I don't know why the question said that, but whatever it is. How much is the depreciation? 93,000 minus. This is new machine depreciation. We follow incremental concept. Old machine depreciation is 375 by 10 years. Old machine depreciation is 375 divided by 10 years. Divided by 10 years. Any doubts on this? Any doubts on this? Minus 37,500. 37,500. 55,500. Year 5 0. I cannot charge depreciation in year 5 because that is the year of sale of the new machine as well as the old machine. Whichever machine we would have used, we would have sold in that year. Less depreciation is incremental depreciation. Maybe I specifically add the word incremental. Any doubts on this? You close it now. I'm doing it in the screen. You keep doing it. Profit before tax. You keep doing it in your notebook. Profit before tax, less tax, Profit after tax first to fourth year 184,650 and last year only 168. 1 to 4 184,650, last year 168. 168, 184,650 and 168. Any doubts in this? Clear? Can you proceed? Any doubts in this? Done? Clear? Working note 3, terminal flow. Terminal flow, particulars, new machine, old machine. Particulars, new, old. New and old. New and old. We're going to sell the new machine in its fifth year of life, old machine in its 10th year of life. If at all we had used the old machine till that, new and old. Two NSVs are computed, one on year 0 because that is a real sale happening, and another in year 3 or year 5 just to compare what is the incremental cash flow. Sale value. What is the sale value of new machine after 5 more years? Sorry? 60,000. Old machine? No. 90,000 is today. There will be if the old machine is sold, it will fetch 90,000. It can't fetch 90,000 after 5 years and all. It will fetch 90,000 today because today the value is 90,000. They have not mentioned anything about what will happen after 5 more years, which means the sale value of the old machine after 5 more years is 0. The sale value of the old machine after 5 more years, is 0 because they have not mentioned anything. 0. Book value. Book value is a little tricky. Tell me what will be the book value of the new machine. Let's see if you're getting it right. What will be the book value of the new machine? Book value of the new machine. Book value of the new machine. Sorry, you will have to be louder. Right, wrong doesn't matter. At least participate. I want some number from your side. Right, wrong doesn't matter. What is the book value? 1 lakh 53,000. Yeah. 5 lakh 25 was the cost. 93,000 for 4 years only we charged. Fifth year we did not charge. Wait. This side, today the book value is 187,500. Today the book value is 187,500. Another 4 years depreciation would have been charged. Another 4 years depreciation would have been charged. Fifth year, which is the year of sale, depreciation will not be charged. You can also understand old machine as 375, which is the original cost, minus 37,500 into 9 years. 10th year no depreciation. 10th year no depreciation. 10th year no depreciation for the old machine. Fifth year no depreciation for the new machine. Tell me the book value. How much? 153 and 37,500. 153 and 37,500. 1,53,000 and 37,500. 153, 37,500. Any doubts on the number here? Clear? Can we proceed? Any doubts on the number here? Can we proceed? Done? Can we? Sale value is done, book value is done. Capital loss 93,000, 37,500. Capital loss 93, 37,500. If depreciation was charged in the year of sale, if at all it was charged, then the sale value and book value would have matched here. The sale value and book value would have matched here because you would have charged 93,000 depreciation and 37,500 depreciation. That is the depreciation amount. 93,000 for the new machine, 37,500 for the old machine. Any doubts till this? Tax saved. Tax saved 30%. NSV. Net salvage value. Let me know the NSV figure. Yeah, tell me guys. 87, 900, 11, 250. 87, 900 and 11, 250. Incremental cash flow. New minus old. Incremental cash flow. Incremental cash flow. New minus old. New minus old. How much? 76, 650. Incremental cash flow. New minus old. 76, 650. Any doubts on this? Clear? Can we proceed? Any doubts on this? Done. Working note 4, computation of NPV. This question did not have much challenges because SLM method was there. Computation of NPV, year cash flow, PVF, DCF. PVF at what rate? 11%, DCF. Year cash flow, PVF at 11% and DCF. PVF at 11% and DCF. Cash flow, PVF at 11% and discounted cash flow. Discounted cash flow. Can we discuss? Any doubts till now? Year 0, look at the step 1 and tell me what is outflow. Guys, you'll have to be louder, please. 405, 750. 405, 750. Year 0, 405, 750. 1 to 4 years together an annuity. 1 to 4 years together an annuity. Same number is there. 5th year separately we will write. 1 to 4 together an annuity. How much is 1 to 4? 184. Give me the 4-year annuity factor. 184,650. 1 to 4. What is the annuity factor? 3.102. Multiply. 5 lakh 72,784. 572,784. Any doubts on this? 572,784. Any doubts on this? Year 5 separately the amounts are different. That's why I did not club it in the annuity calculation. Year 5 the figures are different. We have not clubbed it in the annuity calculation. What is the year 5 number in the P&L? That is step 2 168 and step 3 70 76 650. Okay, tell me the total. 246. Okay, 244 650. 1 divided by 1.11 0.59 593 no 593 244 650 into 0.593 145077. NPV is 312111. NPV is 312111. So we will go ahead with the replacement. Conclusion you can write, the company can go ahead with the replacement. Company can go ahead with replacement. Go ahead with replacement as the NPV is positive. This question on replacement, no major challenge would have come because it is WDV method. SLM method, sorry, it is SLM method. WDV leads to lot of calculation issues. Any doubts on this? Can we proceed? Any doubts on this? Clear? I give you a minute or two, go through the entire solution. Anywhere there are doubts, you can let me know. A minute or two for you. Okay, I will explain this block of assets method again before I get to the next question. Block of assets method is basically used in Income Tax Act, where you don't charge depreciation on individual asset. You technically club them together as part of a block. What is block? A block is one where the rate of depreciation is same. So under Income Tax Act, we have different depreciation rates for different assets. So if the rate of depreciation is same for 2 3 asset classes, you club them together. So you already have a vehicle, you buy another vehicle, it gets added to the block. The block value increases or decreases based on purchase and sale of machine. Based on purchase and sale of machine. First thing is, there will not be any capital gain or capital loss unless you have only one asset in that block, and that asset is sold. There is only single asset in the block and that asset is sold, then block will get exhausted. Or your block value today, the value of all assets together is 2 lakh rupees. 20 assets are there, value of all of that put together is some 20 lakh rupees. You are selling some 5 machine for 30 lakh rupees. If your sale value is more than the block value, capital gain will arise. Or there's only one asset in the block and that asset is also sold, otherwise no capital gain. What is block exhausted? Single asset sold. 5 assets are there, all the 5 are sold. 10 assets are there, all the 10 are sold. 15 assets are there, you sell only 5 out of that, but the sale value is more than the block value. The sale value is more than the block value. In that scenario, capital gain or capital loss will arise, otherwise no concept of capital gain. Depreciation follows a block approach where I want to calculate incremental depreciation. Incremental depreciation is on incremental block value. Earlier, the block value was 10 lakh, we were charging 1 lakh depreciation. Now the block value will become 15 lakh, we will charge 1.5 lakh. Extra depreciation is 50,000. Extra depreciation is 50,000. How is that value became 10 became 15? In this 10, add purchase value of the new asset minus sale value of the old asset. So technically you are going to charge depreciation only on the incremental value of the block. Incremental value of the block. What is incremental value of the block? Old block value compared with the new block value. That is called incremental. What is old block value? 10 lakh. New block value 10 plus something minus something. That plus and minus is the incremental. What is plus? Purchase price of new machine. What is minus? Sale value of old machine. So you are going to charge depreciation on purchase price of new machine minus the sale value of old machine. What we normally do, we charge depreciation on purchase price of new machine. We charge depreciation on purchase price of new machine. Here, charge incremental depreciation on incremental block value, directly the incremental, which is purchase price of new machine minus the sale value of old machine. An example, a company follows block of assets method of depreciation, has several other machine in the block. Several other machine means no capital gain, capital loss. Company is selling an existing machine with book value of 3 lakh for how much? 5 lakh. Ideally 2 lakh is capital gain, but I have so many assets in the block, capital gain will not arise. Only thing is, if the block had a value of 20 lakh, you normally remove 3 lakh from the asset. You would have learnt in your depreciation accounting that only book value is to be removed, balance is profit or loss. Income tax says no, all this headache I don't want. 20 lakh is the block value, remove 5 lakh from the block, remove 5 lakh. What is removed? Sale value. So sale value will be removed and the purchase value will be added. Purchase value will be added. Depreciation rate 10%. How much is the tax paid on sale? Zero tax payment. Zero tax payment because there is no capital gain, no capital loss. Reason is there are several other machine in the block. In case I am not following block of assets method, sale value 3 lakh, book value 5 lakh, capital gain, capital loss 2 lakh, tax paid, tax saved will come. So in case block of assets is not followed, there is capital gain. There is capital gain. 3 lakh compared with 5 lakh. So how much is the tax paid on sale? Zero. What is incremental depreciation? Purchase price of the new machine minus the sale value of the old machine. 10 minus 5 into 10%. 10 minus 5 into 10%. So nil tax paid and depreciation of 50,000. Nil tax paid and depreciation of 50,000. Under block of assets method, capital gain or capital loss will not arise unless the entire block is exhausted. Unless the entire block is exhausted by the organization. Clear? Able to understand this? Any doubts on this? Any doubts on the concept here? Can we proceed? Let's come to 43. HMR Limited is considering replacing a manually operated old machine with a fully automatic new machine. Manually operated old machine with a fully automatic new machine. Old machine has been fully depreciated for tax purpose. Has been fully depreciated for tax purpose. So it is already fully depreciated for income tax purpose, but has a book value of 240 on 31st March. Zero utility of this book value. The machine has begun causing problem with the drawdown and it cannot fetch more than 30,000 if sold in the market at present. If you sell it in the market, you will get 30,000 rupees for the old machine. It will have no realizable value after 10 years. Maybe it has another life of 10 years and no realizable value after 10 years. Company has been offered rupees 1 lakh for the old machine. Rupees 1 lakh for the old machine as a trade-in on the new machine, which has a price of 4,50,000. The new machine has a price of 4,50,000 and old machine he is going to take it for how much? 1 lakh. Expected life of new machine is 10 years with a salvage value of 35,000. Salvage value is 35,000. Company follows straight line method but for tax purpose. WDV at 7.5% is considering that this is the only machine in the block of asset. This is the only machine. If it is the only machine, you sell the machine, capital gain, capital loss will arise. You sell the machine, capital gain, capital loss will arise because it is the only machine. It is the only machine. When you have only one machine, capital gain, capital loss will obviously arise when you sell that machine. Another point, but still depreciation has to be charged on block value. What is block value? purchase price of new machine minus the sale value of old machine. Purchase price of new machine minus the sale value of old machine. Given below is the expected sales and cost from both old machine and new machine. So good thing they've already given me all of this. Sales is given, material cost is given, labor cost is given, variable overhead is given, fixed overhead is given. Can you at this stage tell me the PBDT number? I want PBDT number, both the machine. There are reasons I'll explain later. Tell me the PBDT number of both machine. PBT plus depreciation, reverse. Do PBT plus depreciation rather than doing sales minus so many items. PBT plus depreciation. PBT plus depreciation. How much is old machine? 348 750. And the other one? 4. I'll explain this later, but I've got the PBDT number. Okay. Depreciation is of no use here because this is books of accounts, because old machine is already fully depreciated. So old machine has to be 0. New machine 41,500, no utility because we have to follow WDV method. PBT, tax, all that is fine. From the above information, analyze whether the old machine is to be replaced or not. If required rate of return is 10%, last line, ignore capital gain tax. So no NSV calculation, ignore. Otherwise NSV is needed. Otherwise NSV is needed. Ignore capital gain tax. Now what we will do is initial outflow, capital expenditure of new machine, sale value of old machine, and you get your outflow. Working note to in between flow will be particulars year 1 till 10 years separately. First line item will be incremental PBDT, incremental PBDT, and then depreciation under WDV method we will calculate. Incremental PBDT. Can I do incremental sales? Yes, you do it. Right? Incremental sales difference. Incremental material cost, write the difference. Incremental labor cost, write the difference. Incremental variable overhead, write the difference. Incremental fixed overhead, write the difference. The final number will be incremental PBDT. Why to get into all of that? We will just write incremental PBDT, which is same. Less depreciation, WDV method. You have to do a separate statement. Incremental PBT, less tax, PAT, add back depreciation, CFAT. Terminal inflow, new machine separately, old machine separately, no NSV calculation. No NSV calculation. Reason is question has said ignore capital gain tax. If that word was missing, if the word ignore capital gain tax was missing, then you have to calculate capital gain here, because this is the only asset in the block. Assuming they say no block of asset method, no block of asset method, depreciation of the new machine will be on 4,50,000, which is the purchase price. Now depreciation will not be on 450, depreciation will be on purchase price of new machine minus the sale value of old machine. Purchase price of new machine minus the sale value of old machine. Reason, block of asset method. Reason is block of asset method. Working note 1, initial outflow. Initial outflow. Initial outflow. Initial outflow. Let me know the capital expenditure figure and sale value of old machine. Capital expenditure. How much is capital expenditure? 4,50,000. 4,50,000. Sale value of old machine. Sorry, 1 lakh. My depreciation will be charged on 350 when I do the calculation. Depreciation will be on 350. Incremental block value. Incremental block value. Whatever is the earlier block value, I'm not interested in knowing also. Incremental will be 350. How much is the initial outflow? 350. Clear? Any doubts in this? Clear? Able to understand this? Any doubts? Working note 2, you can maybe make it as horizontal, vertical, it's up to you. Particulars and 10 columns are needed. 10 columns are needed. So not sure whether you'll be able to write it in your portrait format. You can change it as landscape and do it. That's your wish. I leave it to you. Particulars and 10 columns. Particulars and 10 columns. Particulars year 1, year 2, 3, 4, 5, 6, 7, 8, 9. Particulars and 10 years. If it comes in exam, maybe they may reduce the number of years, but adjustment is not very heavy. That is why I'm doing it. In case it was a very heavy adjustment, I would have done it in Excel and you would have just listened to it. Particulars in 10 years. Particulars in 10 years. Particulars in 10 years. Incremental PBDT. Incremental PBDT. Particulars in 10 years. Incremental PBDT. PBDT. Incremental PBDT. Leave some 10 lines, come down. Incremental PBDT. Leave some 10 lines and come down. Please write this: old machine PBDT, new machine PBDT, and difference. Leave some 10 lines and come down. What is PBDT? PBT plus depreciation. You have already given me the figure. Leave some 10 lines, come down. Old machine PBDT. Old machine PBDT. New machine PBDT. Leave some 8 to 10 lines and come down. Old PBDT, new PBDT. Old machine PBDT, new machine PBDT. PBT plus depreciation. Old machine and new machine. 348, 428. What is PBDT? PBT plus depreciation. Our sales minus material. What is the incremental? How much is the difference? 80,000. Can I do old separately, new separately, and do the calculation? Very time consuming. It will become extremely time consuming because old machine you have to do 10 years, new machine you have to do 10 years, and then find out the difference. It will become extremely time consuming. That is why we are not doing old separately, new separately. Table is almost there. Only headache is they have changed the question from SLM to WDV. That is the only problem. How much you said? 80,000. 80,000 less depreciation. We'll have to do a separate working note for this. PBT less tax, PAT, add back depreciation, CFAT. Question has said ignore capital gain tax. If entire tax was ignored, then also it would have become very simple. Less depreciation, PBT, less tax, PAT, add back depreciation, CFAT. Come down. Note 1, computation of depreciation, particulars in 10 years. Computation of depreciation, particulars in 10 years. Computation of depreciation. Particulars in 10 years. Opening balance, less depreciation, closing balance. What is the depreciation rate? Okay, listen for a minute now. The opening balance will be always, purchase price of new machine minus sale value of old machine. On this only I can claim depreciation. Purchase price of new machine minus the sale. Normally you claim it on purchase price of new machine. If it is not block of asset method, directly do it on 4 lakh 50. So purchase price of new machine is 4 lakh 50. Sale value is 1 lakh 350. Now listen, I give you around 10 minutes. Opening balance, claim depreciation for 10 years, take the depreciation up, get PBT, deduct tax, PAT, add back depreciation, CFAT, terminal inflow, only sale value, no NSV calculation, only sale value, and then calculate NPV. Around 10 to 12 minutes for you. It is time consuming area. Opening balance is 3 lakh 50. You start with 3 lakh 50. How much is the depreciation rate? You keep claiming 7.5%. 10 minutes for you. Okay, the depreciation rate was 7.5%. WDV method 7.5%. You get 26,250. Closing balance is 323. This becomes the opening balance. Claim depreciation. This will go on for 10 years. This will go on for 10 years. And these are the values. This will be the depreciation quantum. I copy this depreciation here. After the depreciation, we get PBT. Tax rate is how much? Into 0.3. In case so many years of calculation is asked, you can do one time saving trick, which is because so much calculation is there. Directly you can write PAT as 70% of PBT. Rather than writing tax, you can directly write PAT as 70% of PBT. Less tax, no need to write itself. It will save maybe some time because 10 years of tax you have to write. Directly you can say PAT is 70% of PBT. We add back depreciation and this gives us CFAT. After the CFAT is calculated, terminal inflow, new machine, what is the sale value of the new machine after these are your in between flow: 63 875, 63 284, 62 738, 233, 61 765, 61 333, 60 933, 65 63, 221 and 59 904. Any doubts in these numbers? Any doubts in these numbers? Then what is the sale value of new machine? New machine, there is a sale value, no? 35,000. Salvage value of 35,000. Old machine? No, 0. Old machine will become 0. They are very clearly mentioned in the question. If sold in the market at present, it will have no realizable value after 10 years. Old machine is 0. Incremental terminal flow is 35,000. You consolidate and calculate NPV. So this part I am not explaining much. 35,000, 0, 35,000. This is for the new machine. Old machine is anyway 0. No NSV calculation. No NSV calculation. And you club it together and calculate NPV. NPV is positive. We go ahead with replacement. NPV is positive. We go ahead with replacement. It is a time consuming question, but not lot of complex calculation. So still can get tested in exam. These type of question can get tested. Maybe they'll reduce the number of years. Any doubts on this? Can we proceed? Any doubts on this? Done? Okay, let's come to one more question, which is again on timing of replacement. 44. A and company is contemplating whether to replace an existing machine or to spend money on overhauling it. A and Co currently pays no taxes. So headache is over, no income taxes there. Currently pays no taxes. Replacement machine will cost 90,000. Require maintenance of 10,000 at the end of every year for 8 years. At the end of 8 year, it will have a salvage value of 20,000. Existing machine require increasing amount of maintenance. and salvage value will fall every year. Maintenance cost increasing, salvage value declining. Opportunity cost of capital. When should the company replace the machine? Present value of annuity and present value of rupee 1 to be received after 8 years is given. Go through this, I'll then explain it. Okay, let's understand this. I want to replace a machine with a new machine. The replacement machine will cost me 90,000 rupees. It will need maintenance at the end of every year for 8 years, and at the end of 8 years it will have a salvage value of 20,000. This is the new machine. New machine has a life of how many years? 8 years. This is the data for the existing machine. They have given salvage value present. Present means you can sell it today. They've also given a salvage value at the end of year 1, which means you can sell it at the end of year 1. Year 2 salvage value also given, so you can sell it at the end of year 2. Year 3 salvage value is also given, you can sell it at the end of year 3, and a year 4 salvage value is also given, you can sell it at the end of year 4. So totally 5 alternatives are there. You can sell it today, sell it at the end of year 1, year 2, year 3, year 4. After you sell, fifth year onwards, whichever alternative we analyze, we are only going to use new machine. Fifth year onwards, whichever alternative, be it replace today, fifth year new machine. Replace at the end of year 1, fifth year new machine. Second year, fifth year new machine. Third year, fifth year new machine. Fourth year, fifth year new machine. So what ICI said is, we will restrict our analysis to the first 4 years, because fifth year onwards any alternative will involve only new machine. So here our approach is going to be slightly different. First thing we are going to do is, this new machine data which is given, we calculate something called as equated annual cost of the new machine. Why equated annual cost is, there are no inflows here. What does this equated annual cost is? In simple word, EAC is the rent to be paid for using the machine for 1 year. EAC is like the rent to be paid for using the machine for 1 year. So ICI said, assume that you sell the old machine today and buy the new machine. Instead of buying, you assume in your mind that you're taking it on rent. You're taking it on rent. That is how the solution has been drafted. Very well drafted solution. So first thing what we are going to do is, we are going to calculate EAC of the new machine. If you replace it today, you will get the salvage value of the old machine, pay first year rent, pay second year rent, pay third year rent, pay fourth year rent. After fourth year, every scenario you have to pay rent of the new machine. Assume as if you are not buying the machine, you are taking it on rent. What is the rent cost? Equated annual cost. Equated annual cost is the rent cost. In replace today, sell the old machine and pay rent of first year, second year, third year, fourth year. If you replace it at the end of year 1, pay first year maintenance, because some maintenance cost is to be paid. Sell it at the end of first year, pay second year rent, third year rent, fourth year rent. After that, every scenario it's only the new machine. Every scenario it's only the new machine. After fourth year, I'm not interested in knowing the analysis, because after fourth year, every scenario will be only new machine. If you replace it at the end of year 2, pay first year maintenance, pay second year maintenance, sell the old machine, third year rent, fourth year rent. If you replace it at the end of third year, first year maintenance, second year maintenance, third year maintenance, third year salvage value, and fourth year pay the rent of the new machine. If you replace it at the end of fourth year, first year maintenance, second year maintenance, third year maintenance, fourth year maintenance, and at the end of fourth year sell it. Sell it, you will get some salvage value. After that, everywhere it is only the new machine. After that, everywhere it is only the new machine. So they said, let's restrict our analysis to 4 years. Can I do fifth year, sixth year, seventh year, eighth year? You can keep doing any number of years. There's no end to the number of years. It will become lot of computation. They said, let's restrict our analysis to the first 4 years, which is very logical. After fourth year, in alternative 1, new machine will be used. In alternative 2, new machine will be used. Working note 1, identification of alternatives. Identification of alternatives. Identification of alternatives. Alternative 1, replace now, replace now and use the new machine for 4 years. Replace now, or just write replace now. The use the new machine is not needed. Replace now. Alternative 2, replace at end of year 1. These are self-explanatory alternatives. You will keep writing this end of year 2, year 3, year 4. Replace at end of, technically replace in year 0, year 1, year 2, year 3, year 4. Replace now, year 1, year 2, year 3, year 4. Clear? Working note 2, computation of equated annual cost in bracket like rent of new machine. Equated annual cost, either you buy the machine or pay yearly rent, equated annual cost like rent of new machine. Year cash flow PVF DCF, year cash flow PVF at some rate is given in the question, 15% DCF. Year cash flow PVF at 15% DCF. Year cash flow PVF at 15% and DCF. Cash flow PVF at 15% and DCF. Year 0, what is the outflow of this new machine? Participate guys please. Minus 90, minus 90. There are only outflows, no inflows, only some salvage value will come. Minus 90,000. 1 to how many years is the life? 1 to 8, 1 to 8, 1 to 8. How much you have to pay for this machine? 10,000 maintenance is to be paid. 10,000 maintenance is to be paid. See, if I buy, I have to pay 90,000. I have to pay 10,000 and I'll get some salvage value. Another option, just take it on rent and pay the rent. Don't need to pay all of this. 10,000. Annuity factor is given in the question. 4 decimal annuity factor. They have 4 decimal annuity factor in the question. Last line has the annuity factor. 4.4873. 4.4873. 4873. They have given 4 decimal annuity factor. Let's follow that. Any doubts on this? At the end of year 8, at the end of year 8, I will sell this machine. I will sell this machine and get some inflow. I will sell this machine and get some inflow. How much is the inflow? Sorry, 20,000. Factor is given in the question, 0.3269. This alone is inflow. PV of outflow, present value annuity factor and equated annual cost. When you put a total, you can remove the sign at this stage. Even if you write the sign, that's okay. One two eight 335. 128 335. 128 335. 4.4873. Sorry, 28. 28,600. Any doubts on the number here first? Now understand this. See, buying a machine, paying 90,000 and paying 10,000 every year is same as taking it on rent and paying 28,600, only one amount, 28,600 every year. So what you will pay? 28,600 for 8 years. So this cash flow and person, instead of buying, he takes only one thing, 28,600 he pays. He does not pay anything on year 0. He does not receive anything in year 8. Technically, whether you do 90,000, 10,000 for so many years, or you pay 28,600, both number technically will be equal. Whether you take it on rent, some rounding of difference can be there. Whether you take it on rent or you buy it and use the machine, both values are same. What is EAC? Is like the rent cost. EAC is like the rent cost. If somebody wants to use the machine for 1 year, he has to incur 28,600 as the annual cost, or you can call it as the annual rent. Clear? Any doubts on this? Any doubts on this? Next, selection of alternative. I'll need 12 columns. Not sure how will you manage space. 12 columns will be needed. 12 columns will be needed. Year cash flow will have 5 sub columns. PVF, DCF will have 5 sub columns. Year cash flow 5 sub columns. The sub columns are alternative 1, 2, 3, 4, and 5. It is year cash flow PVF DCF only. I want to do it in one table. Other option is to do every alternative one table. Year cash flow PVF DCF. DCF also 5 sub columns. Year cash flow PVF DCF. Year cash flow PVF DCF. Cash flow 5 sub columns. Space not there, then you'll have to do year cash flow PVF DCF for alternative 1, then again alternative 2, again alternative 3, 4, 5. That's up to you. Or maybe 3 alternatives we do here and 2 alternatives we do in another working note. Your choice. Year cash flow PVF DCF. PVF and DCF. What is the discount rate given in the question? Sorry, PVF at 15%. This is little different from the other set of question. PVF at 15%. Year 0 till 4 years. Beyond 4 years, we are not doing any analysis. Beyond 4 years, we are not doing analysis. Can we start? Okay. PVF will be 4 decimal here. Okay. They've given data in 4 decimal. We'll do 4 decimal. Write the PVF numbers also. 4 decimal PVF numbers. 1 divided by 1.15. 4 decimal PVF numbers. 8696756165755718. Can we start? What is alternative 1? Replace now. I will sell the old machine. I'll sell the old machine. By selling the old machine, how much inflow I get? I will sell the old machine. By selling the old machine, we get an inflow of how much? 40,000. Salvage value is 40,000. I don't buy the new machine, okay? Don't think that we are buying the new machine. We are taking it on rent. We are taking it on rent. Just assume that we are taking it on rent. In reality, I may buy it, but just assume we are taking it on rent. First year pay 28,600, second year 28,600, third year 28,600, fourth year 28,600. Keep paying 28,600 for 4 years. As if you are taking it on rent. As if you are taking it on rent. 40,000 inflow, 28,600 rent for first year, second year, third year, fourth year. Any doubts on this? Any doubts on this? As if we are taking it on rent. As if we are taking it on rent. Any doubts on this? Alternative 2. What is alternative 2? After 1 year. So alternative 2 after 1 year means year 0 nothing happens. No cash flow. No cash flow. Nothing is going to happen. Year 0 no cash flow. Friend, is there a doubt? You don't do discussion among yourself. You ask me your doubts. I'll be able to clarify. Any doubts? In alternative 2, we replace it at the end of year 1. I will have to pay 10,000 on maintenance and sell it for 25,000. Pay 10,000 on maintenance and sell it for 25,000. Second, third, fourth year, pay rent of the new machine. Pay rent of the new machine. You are replacing it at the end of year 1. Here, outflow of 10,000, inflow of 25,000, 15,000 is my cash flow. 15,000 is my cash flow. 10,000 outflow, 25,000 inflow. Pay rent 28,600, 28,600, 28,600. Pay rent 28,600, 28,600, 28,600. 10,000 and 25,000 inflow. What is alternative 3? Year 0 nothing happens. Year 1 nothing will happen. You just need to pay maintenance. No sale and all. You need to pay maintenance. Year 1 you need to pay maintenance of the old machine. How much is the maintenance of the old machine? 10,000. Pay 10,000. Year 2 pay maintenance and then sell it. How much is the maintenance? Salvage value? So I have to pay 20,000, get only 15,000. So negative 5,000. Pay 20,000, receive only 15,000. Pay 20, first pay 10,000, then pay 20,000, then pay 20,000, receive only what? 15,000. After that, rent of the new machine 28,600, 28,600. Pay rent of the new machine 28,600, 28,600. Where is the confusion? You have to tell me what is the confusion. Which number? 10,000 is alternative 3. Replace at year 2. So year 1 old machine 10,000 you have to pay. Year 2 old machine 20,000 you pay and then sell it. And then sell it. So pay 10,000 in year 1 maintenance. Pay 20,000 in year 2 and then sell it for 15,000 rupees. Salvage value. Salvage value is the selling price. 5,000 rupees. Negative 5,000. Thereafter new machine rent. Thereafter new machine rent. Any doubts on this? Can we proceed? What is alternative 4? Year 0 nothing happens. First year pay maintenance cost. How much is the maintenance cost? 10,000. Second year pay maintenance cost. Third year pay maintenance and then sell it. 30,000 you pay. 10,000 is salvage value. So pay 30,000. Receive only 10,000. Receive only 10,000. So 20,000 is outflow. Pay 30. Pay 30 and receive 10,000. pay 30,000 and receive 10,000. Thereafter, pay the rent of new machine. Moment old machine is sold, after that it is always the EAC of the new machine. After that, it is the EAC of the new machine. Once it is done, I'll explain again one more time. Alternative 4, what are alternative 5, what are we doing? Year 0, nothing. Year 1, pay maintenance. How much is maintenance? Year 2, pay maintenance. Year 3, pay maintenance. Year 4, pay maintenance. And sell it. 0, 40,000. After this, if at all you write 5th year, negative 28,600 for all. 6th year, negative 28,600 for all. 7th year, negative 28,600 for all. 8th year, negative 20. So after 4 years, I said no point in doing it, because after 4 years, it's going to be same. I'll explain one more time. I sell it immediately, 40,000 inflow and 28,600 for 4 years. I sell it at the end of year 1, 10,000 maintenance paid, 25,000 inflow and 28,600 for 3 years. Then 10,000 maintenance paid, 20,000 paid, 15,000 salvage value, 28,600 for 2 years. Alternative 4, 10,000 maintenance paid, 20,000 maintenance paid, 30,000 maintenance paid, 10,000 salvage value, and then 28,600. Alternative 4, 10 paid, 20 paid, 30 paid, 40 paid. Now you do the analysis, whichever has lower PV of outflow, whichever has lower PV of outflow, we go ahead with that. Any doubts on this? Any? After 4 years, can I write 5th year? Yeah, you can write. You write 28,600 for all. 6th year, can I write 28,600 for all? 7th year, can I write 28,600 for all? 8th year, can I write 28,600 for all? 9th year, can I write 28,600 for all? No point in doing it. Till 4 years, we are restricting our analysis. Complete this DCF part. I'll give you some 3 minutes. Complete the DCF part and then we discuss the answer. Okay. You will have to just do a normal multiplication, nothing much to be done here. 40,000 into this. Your PV of outflow here is 41,653, first alternative. Then second alternative, it is 43,738, which is more than the first alternative. The second alternative, the amounts are going up. Third alternative, 47,635, further going up. This alternative, okay, I think alternative 1 will be the best. Maybe every alternative, it is only going up. Reason is the maintenance cost is increasing for the old machine. It is preferable to shift it as early as possible. Preferable to shift it as early as possible, which is year 0. Either you do a combined table like this, or you do a table individually like this. Year 0, 1 to 4, then year 1, 2 to 4, year 1, 2. You can do an individual table. Net answer is going to remain same. There's not going to be any difference. Rounding of differences can be there, but otherwise, either by mistake I've done 3 decimal PVF there. It should not be 3 decimal. It has to be 4 decimal, because the question had data on 4 decimal. By mistake I've done 3 decimal in the solution. It has to be 4 decimal. It has to be corrected to 4 decimal. PVF should be 4 decimal. Reason is the question had given 4 decimal PVF. So I should have continued with 4 decimal PVF in the analysis. I don't know why I did 3 decimal, and which is why there is a difference in the answer. Clear? Machine should be replaced immediately as it has lower present value of outflow. As it has lower present value of outflow. Any doubts on this? Any doubts on this? Done? Okay, let's take a break now. Okay, we have 2 more concepts which are pending. The chapter is almost over. I'll first explain the first concept, do few questions, and then the last concept. Capital rationing. Now let's understand what is capital rationing. It is similar or same as a concept which we have done in cost accounting called as limiting factor. When we did marginal costing, we learned a concept called limiting factor. A similar concept is capital rationing. Capital rationing is basically a situation where the available money is not sufficient to do all acceptable projects. Acceptable project is one which has positive NPV. So I did my analysis and we found project 1 is good, project 2 is good, 3 is bad, 4 is good, 5 is good. To do 1, 2, 4 and 5, I need to spend 1 crore rupees, but I have only 60 lakh rupees with me. So check if capital rationing exists. If capital rationing exists, it is a situation where I need 1 crore, but I have only 60 lakh. I need 1 crore, I have 2 crores. Do all the acceptable projects. Do all the acceptable projects, nothing to worry about. But in case you do not have the money, in case you do not have the money, then you need to see how can you manage the situation, which projects to take up, which not to take up. Similar, when we did limiting factor, you would have understood that I have demand for 4 products. I have to compromise on some product demand. Similarly, I have to compromise on some project here. We will rank the various product in the order of profitability index. Why profitability indexes? PI measures how much we are earning for every 1 rupee of outflow. PI is PV of inflow by PV of outflow. If I earn 3 rupees for every 1 rupee of investment, that is a better project as compared to earning 2 rupees for every 1 rupee of project. Rather than going with absolute NPV, we go with profitability index, which will measure how much does every project earn for every 1 rupee of investment. This is same as there it used to be called as contribution per limiting factor. Here profit or inflow per rupee of investment, because investment is my constraint. There will be two types of project. One is called divisible project and second is called indivisible project. Divisible project means allocate the money in the order of ranking, whatever ranking you did. What is indivisible project is, I want 60, I have 60 lakh rupee, I invested 20 lakh in first project, 30 lakh in the second project. The third best project needs 25 lakh rupees. 25 lakh rupees, 20 is spent, 30 is spent. Divisible means you can do part of the project. What is part of the project? I wanted to construct 5 floors of the building. I do part of the project and construct only 2 floors of the building. Just construct 2 floors of the building and do part of the project and earn part of the NPV. Do part of the project and earn part of the NPV. Don't do the full project and earn full money. You do only part of the project and earn part of the money, which is called divisible project. I need 5 floors to be constructed. I do 2 floors, invest only 10 lakh rupees and earn lesser money. Indivisible means just doing 2 floors will not work. People are not ready to buy only 2 floors. If it's only 2 floor, sales will not happen. Either construct all 5 or construct 0. Either construct all 5 or construct 0, which is called indivisible project. In indivisible, we follow something called as a combination approach. What is combination is, your ranking and all will not totally help you, because you may not be able to utilize the money fully here. You will understand the steps when you do a question. Divisible means part of the project is possible. Indivisible means part of the project is not possible. Let's see it in a question so that you understand the steps. Let's come to 47. A company has 1 lakh available for investment, has identified the following 4 investments in which to invest: project, investment, NPV, C, D, E, F. Investment amount is given, NPV is given. You are required to optimize the return from a package of project within the spending limit if projects are independent and divisible. Divisible projects are not divisible. Not divisible is indivisible. What is the difference? You will understand. Nothing much in the question. First, tell me project C, positive NPV, negative NPV. I want participation, guys. Positive, D, E, F, all are good project. All are good project. If you want to do all, you have to spend 40 plus 1 lakh plus 50 plus 60. How much money do we need? 2 lakh? I think 2 lakh 50,000. How much money we have? So obviously I cannot do all the four projects. All four are good. All four are good, but I cannot do all the four. I cannot do all the four. Which one do I compromise? On the basis of profitability index. On the basis of profitability index. Clear? Any doubts on the concept? Divisible allocation is little differently. Indivisible little differently. Working note one. Check on capital rationing. Check on capital rationing. Check on capital rationing. Demand for money. What is demand for money is how much money do I need to do all good projects. Everything is good here. Everything is good. Demand for money is 40,000, 1 lakh, 50,000, 60,000. Everything is good. All good projects we have. How much is the demand? Supply of money. The step is technically not needed. I'm just writing it so that you understand the concept. Supply of money. How much money is available? 1 lakh. Capital rationing exists as the demand for money is more than its supply. I have four very good projects, but I will not be in a position to do all the four. I may do one, maybe two, three, I don't know. I'll have to see. But I cannot do all the four. I cannot do all the four. Reason is money is not sufficient. Clear? Working note two, ranking of projects. Ranking of projects. Ranking of projects. NPV equal to PV of inflow minus PV of outflow. NPV equal to PV of inflow minus PV of outflow. Ranking is not on NPV. There's a reason to write that. How do you calculate PI? PV of inflow divided by PV of outflow. PI is equal to PV of inflow divided by PV of. There's a reason to write this. You'll understand. PV of inflow divided by PV of outflow. Is the outflow of the project given? Participate. Is the outflow given? Investment is the outflow. Invest is the inflow given? No, they have not given. They have given NPV. They have given NPV. So if I take outflow to this side, if I take outflow to the other side, inflow is equal to present value of outflow plus NPV. Present value of outflow plus NPV. That is the formula we are going to use to calculate PI. What is outflow? Investment. Outflow is investment is equal to, you can write here, PV of inflow is equal to PV of outflow plus NPV. PV of outflow plus NPV. Inflow minus outflow is NPV. Outflow goes to the other side. Outflow goes to the other side. So here we get PV of outflow plus NPV divided by PV of outflow. Present value of outflow plus NPV divided by present value of outflow is profitability index. Any doubts on the formula here? NPV is inflow minus outflow. Outflow technically will be then, sorry, inflow technically will be equal to outflow plus NPV. Particulars, I think we have, you may need 5 columns. 5 columns. 3 columns as it is in the question. Copy the 3 columns as it is. Project, investment, NPV. 6 columns, sorry, you will need 6 columns. Investment, NPV, 6 columns will be needed. I'll explain the other 3 columns later. C, D, E, project, investment, NPV. I think I'll need 6 columns. Investment in bracket, you can call it as PV of outflow. Investment is what you pay today, present value of outflow. Investment is present value of outflow. Any doubts on this? Next, PV of inflow. PV of inflow. What is PV of inflow? Is outflow plus the NPV. Outflow plus the NPV. By investing 40,000, I learn 40 plus 20. 40 plus 20. Write the amount plus NPV. PV of outflow plus NPV. Invest 40,000, earn extra 20,000. You earn totally 60, 135, 74. Adding the NPV amount, I get the inflow figure. Calculate PI. PI, inflow by outflow. PI is inflow divided by outflow. Inflow divided by outflow. Let it be in times itself. Can be in times, can be in percentage. Inflow divided by outflow. Tell me the values. 1.5, 1.35, 48, 1. Then last column rank. Highest PI is the rank 1 project. That is my first choice. Then second, third. Like you used to do statement of ranking in limiting factor. Same thing here. So this is my first preference. Second, third, fourth. 1, 3, 2, 4 is the ranking. 1, 3, 2, 4 is the ranking. 1, 3, 2, 4 is the ranking. Any doubts in this? Can you proceed? Clear? Any doubts on the ranking here? This is very simple. There's nothing much. Working note 3. Allocation of money for divisible projects. Allocation of money for divisible projects. Money for divisible projects. For divisible projects. How much money is available? Write 1 lakh in the center of the page. You can do it as a table also or as a chart. 1 lakh. Which is rank 1 project? C. How much is the investment for C? I invested 40,000 in C. I invested 40,000 in C, rank 1 project. I prioritized my rank 1 project, gave 40,000 to it. How much do I earn out of it? NPV, NPV. Invested and NPV. I have done my rank 1 project. I still have some more money. I'll go to rank 2. I will go to rank 2 project. I still have money. I'll go to rank 2 project. What is rank 2? E. How much money does E need? How much is the NPV? We have utilized 90,000. I'll go to the next project. What is the next project? D. I have 10,000. How much money is needed? 1 lakh. Divisible means if you need 1 lakh. See, the point is if you invest 1 lakh, how much NPV you earn out of 1 lakh? I will not do 1 lakh. I will invest 10,000 and earn 3,500. I will invest part of the money. I'll not invest full money. I don't have money to invest fully. So I will do part of the project. If I had 1 lakh 50, I would have invested 60,000 rupees. Whatever money I have, I will invest it. So D, investment is only 10,000. I do not have the money to invest fully. Divisible project means part of the project possible. I can present it as a table. I'll show the table in a minute. I invested only 10,000. Any doubts on this? And I earned 35,000 into 10 by 100. 10 10,000. How for 1 lakh you want 35,000. For 10,000 rupees you will earn only 3,500. Or to put it very simply, you're doing 1/10 of D. You're doing 1 by 10 of D. How much is the NPV here? 3,500. Any doubts in this? So now right below this, project to be done equal to C E and 1 by 10 of D. C E and 1 by 10 of D. You will do project C, you will do project E and 1 by 10 of D. NPV. By doing this, I earn 20,000, 24,000 and 3,500. Everything is already written. 20, 24 and 3,500. How much is the total earning? Any other combination you try, you will not earn more than 47,500. This is the best possible. 47,500 is the best possible earning. This is divisible. Divisible means you can do 1/10 of a project. Any doubts in this? Any doubts in this? So if you see here, you can present it like this also. Money invested, balance money, NPV, net 47,500. Now comes indivisible. Next, indivisible projects. Working note 4, project selection for indivisible projects. Three columns: combination, amount invested, NPV. Okay. Question has talked about 1 lakh rupee. Okay. 1 lakh rupee answer is there in the material. I'll assume it is 1 lakh 20. Just to explain few more concepts. 1 lakh 20,000 rupees is there with us. 1 lakh 20,000 rupees is there with us. I have to now do projects. I cannot do part of the project. 120. Okay. Indivisible project. You can just write in bracket 1 lakh 20,000 available. I'm changing the question. 1 lakh 20,000 available. In fact, make it 1 lakh 40. 1 lakh 40 available. 1 lakh 40 available. I'm changing the question as 1 lakh 40. Rank 1 project needs how much money? Rank 2, rank 2, 50,000. Rank 3, 1 lakh. And rank 4 is 60,000. Can I do rank 1, rank 2 and rank 3? 1, 2 and 3. All the 4 not possible. 1, 2 and 3. Is it possible with 1 lakh 40? You have to tell me 1, 2 and 3. Rank 1 needs 40,000. Rank 2 needs 50,000. Rank 3 needs 1 lakh. Put together I need 1 lakh 90. Is it available? No. Okay. Rank 1, rank 2 and rank 4. Is it possible? 1, 2 and 4. Not possible. 1 is 40,000. 2 is 50,000. 4 is 60,000. That is also not possible. 1, 2, 3 not possible. 1 to 4 not possible. 1, 3, 4. Rank 1, rank 3, rank 4. No. So 3 projects together not possible. See, 4 projects not possible. 3 projects, what are the combination? 1 to 3, 1 to 4, 1, 3, 4. And maybe 2, 3, 4. 2, 3, all possibilities you have to check. 2, 3, 4 possible? 2, 3, 4 possible? No. Okay. 1 and 2 possible? Only 1, 2 projects now. 1 and 2 possible? Yes, write them then. C and E. C and E. 1 and 2. Rank 1, rank 2. Okay. Rank 1 and rank 2. How much is the amount invested? 90,000. C and E. C and E. 3 projects together not possible with 1 lakh 40 also. Maybe if I had some 2 lakh rupees, 3 projects would have been possible. 90,000, what is the NPV? 44. This is rank 1 and rank 2. Rank 1 and rank 3 together possible? Rank 1 and rank 3. Okay, then write C and D. C and D. 40,000 plus 1 lakh, 1,40,000, and NPV for this is this was rank 1 and rank 2. This was rank 1 and rank 3. Rank 1 with rank 2 is done. Rank 1 with rank 3 is done. Rank 1 and rank 4 possible. Rank 1 and rank 4 possible. Then write what are the project names? C and F. Tell me the amount invested. 1 lakh. NPV. Rank 1 is over. Okay. 1 and 2 did. 1 and 3 did. 1 and 4 did. Rank 1 is over. 2 and 3 possible. 2 and 3. Rank 2 and rank 3. Okay. Leave it. 2 and 4. 2 and 4 is possible. 2 and 4 is possible. So write 2 and 4. 2 and 4, which is E and F. E and F. Rank 2 and rank 4. Rank 2 and rank 4. This is rank 2, rank 4. Listen, very simple. You have to do 1 and 2, 1 and 3, 1 and 4. All three happen. 2 and 3 is not happening. 2 and 4 is happening. Then 3 and 4. That's all. These are the only combination. 1 and 2, 1 and 3, 1 and 4, 2 and 3, 2 and 4, 3 and 4. This is the combination approach we follow. 2 and 4, what is the amount invested? 1 lakh 10,000. NPV. Clear? 2 and 3 tried. 2 and 4 done. 3 and 4. No. Clear? And one final check you have to do. See, first 4 projects you try, not possible. 3, not possible. 2, we have done now. 1 and 2, 1 and 3, 1 and 4, 2 and 3, 2 and 4, 3 and 4. All the projects 1, 2, 3, 4 should at least come once in any of the level. At least once. Is project 1 done in any of the combination? Once it has to come. Rank 2 has it come? Rank 3 has it come? Rank 4 has it come? Okay, so everything is done. Everything is done. I think this is 1 and 4. Everything is done. Which has the best NPV? 1 and 3. Though rank 2 is a good project, but I'll be doing 1 and 3. Though rank 2 is a good project, but I'll be doing what? 1 and 3. Because this ensures I earn maximum NPV. I earn maximum NPV. 55,000. It is not comparable with that 47. Okay, that the amount was lesser. I will be doing project C and project D. If you look at the solution, here it is very simple. Rank 1 and rank 2, rank 1 and I think rank 4, and rank 3 on a standalone basis. Because rank 3 was not appearing anywhere. Rank 3 was not appearing anywhere. Rank 3 on a standalone basis. That's all. No other combinations were possible. Here the best combination is C and D. The best combination is C and D when 1 lakh was available. I changed the question as 1 lakh 40,000. C and D is the best combination. Any doubts on this? Any doubts on this? Below the table, the company should do project C and D. C and D. This will give NPV of rupees 55,000. NPV of 55,000. I'll repeat again. If you have 4 projects, see all 4 together will never be possible. 3 together possible. I check 1 2 3, 1 2 4, 2 3 4. 1 2 3, 1 2 4, 2 3 4. Then I check 1 to 2, 1 and 3, 1 and 4, 2 and 3, 2 and 4. And thereafter, if none of them were in the any of the project, you just see individually any project possible. If at all it was not there. For example, when 1 lakh was there, C and E and C and F not had D project. It did not have project D, so project D separately written. Now every combination at least has C once, D once, E once, F once. That's all. So in this, the best combination was C and E. Any doubts on this? This is called capital rationing. Very simple concept. Nothing much is there. Any doubts on this? Can we proceed? Okay. A similar question, but a small different concept. Let's come to 45. Elite Cooker Company is evaluating 3 investment situation. Question 45. Produce a new line of aluminium skillets expand its existing cooker line to include new sizes, develop a new higher quality of cooker if only the project in the question is undertaken, expected present value and the investment required. First project 2 lakh invest, earn 2 lakh 90, NPV is, just give me a minute. Okay, NPV is 90,000. Second project NPV is 70,000. Third project NPV is 130. If you do the projects, all are good, but then there is something else. If 1 and 2 are jointly undertaken, there will be no economies. Economies is some benefit can come. The investment required will be the sum of the part. With 1 and 3, economies are possible in investment because 1 and 3 combined investment required is 4 lakh 40. What is the investment required for project 1? Project 3, but put together it's only 4 lakh 40. They're saying put together if you do it is only 4 lakh 40. They're saying if you do both the projects together, economies are possible in investment because one of the machine can be used in both the process. One of the machine can be used in both the process. So ideally if you do one separately 90,000 NPV, three separately 130 NPV, but if you club them together NPV can be higher. NPV can be higher because investment is not 2 lakh plus 270. Investment together is what? 4 lakh 40. If 2 and 3 are undertaken, there are economies to be achieved in marketing and producing the products, but not in the investment. 2 and 3 if you do together, some benefits are there in marketing. Expected present value of future cash flow is 6 lakh 20. What is the future cash flow of project 2? What is the future cash flow of project 2? 185, 3, 4 lakh. Put together is 585, but here they are saying put together how much? 6 lakh 20. Put together is 6 lakh 20. There are some economies of scale benefit. If all the three are undertaken simultaneously, the economies noted will still hold good. What is economies noted is investment will go down, inflow will go up, but 1 lakh 25,000 on the plant will be necessary. A space is not available for all the three projects. A space is not available for all the three projects. Which project or project should be chosen? If this below para was not there, there's no spending constraint and all, no capital rationing, but some combination we have to try here. Three projects on a standalone basis are good project. Project 1 good, project 2 good, project 3 good. Then you have to see 1 and 2 together you do what happens, 1 and 3 together you do what happens, 2 and 3 together you do what happens, and 1, 2 and 3 all you do what happens. Everything is possible. Only thing is NPV is not simple addition of 1 and 2, 1 and 3, because you get some benefit in investment or some benefit in inflow, some benefit in inflow. Working note 1, project combinations. Working note 1, project combination, 4 columns. Combination, investment, inflow, NPV or PV of future cash flow. Combination, investment, PV of future cash flow and NPV. Combination, investment, present value of future cash flow and NPV. And NPV. 1 and 2. 1 and 2. What is the investment in project 1? 2 lakh. 2. When you do it together, is there any benefit in the question? Doing 1 and 2 together, is there any benefit? No. So just put a normal total, 2 lakh plus 115, 315. 2 lakh plus 115, 315. No benefit. 2 lakh plus 115, 315. Clear? On the inflow side, is there any benefit when you do 1 and 2 together? No, just normal total. 290 plus 185. 290 plus 185. 290 plus 185. How much? Tell me the difference. That is the NPV. 160. It's a good combination. 1 and 2 together can give me 1,60,000 NPV. See, if there was no this extra benefit and all, do all the three together. That's the best. 1 and 3. If you do 1 and 3 together, is there any benefit? Investment required is only 4 lakh 40. 1 and 3, it's 2 lakh plus 270. But 2 lakh plus 270 is only 4 lakh 40. So investment is 440. Investment is 440. 1 and 3 together, investment is 440. Any benefit on the cash flow? Tell me the cash flow of 1. T put together 690. Put together 690. How much is the NPV? Good, decent amount of NPV, 2,50,000. So 1 and 3 is better than 1 and 2. 1 and 3 is better than 1 and 2. Any doubts on this? Any doubts on this? 2 and 3. If you do 2 and 3 together, is there any benefit on investment? No. So put a total. 115 plus how much? 270. 385. 115 plus 270. 385. Any benefit on the cash flow? 620. Difference. Good combination, but 1 and 3 is better. Still, 1 and 3 is better than 2 and 3. As of now, 1 and 3 is better. 1 and 2, not a great combination. 1 and 3 is the best. 2 and 3 is more or less at a moderate. 1, 2 and 3. 1, 2 and 3. Now listen, what is 1, 2 and 3 is, they said earlier benefits will continue. What is earlier benefit? If I do 1 and 3 together, it is 440. Along with that extra investment for project 2, along with that, because they said earlier economies will hold good, the economies noted will still hold. Where is the economies noted? Wherever you don't see a plus in the calculation here, all those places you saw benefits. So the benefit was in 1 and 3 on the investment side. So 1 and 3 investment, listen, 1 and 3 investment is 4 lakh 40. Tell me what is the investment in 2? 1 lakh 15 plus some plant extension is to be done, because of which I'll spend more. I'm forced to spend more. Doing all the three together will need a plant extension or an expansion. How much we have to spend for plant extension? 125. It is in fact increasing my investment value. Listen, the earlier benefit will still hold good. What is earlier benefit? 1 and 3 investment. We are not putting total of 1, 2 and 3 and then adding 125. No, 1 and 3 total is only 440. 2 separately is 115 and an extra 1,25,000 because plant is to be expanded. We do not have space to do all the three projects. 1,25,000 extension on the plant is necessary. A space is not available for all the three projects. Tell me the total of this. 6,80,000. Coming to the cash flow side, where do we have benefit? So 2 and 3 I write 620. Tell me one separately how much? 2,90,000. One separately is 2,90,000. Put together 9,10,000. Difference is how much? My best combination is 1 and 3. Best combination is 1 and 3. The best combination is 1 and 3. We are not going with the combination of 1, 2 and 3. That would have been the best if that extra 125 was not needed. That plant extension took away the returns which are coming out of the project. Otherwise, we would have done all the three. Here we are going to do only 1 and 3. We are going to do only 1 and 3 because there is no money problem here. Money is available, but the space was a problem. So it's not a capital rationing, it's technically like a space issue. Limiting factor was space. So if you do expansion, you have to spend more, which is not ideal. In case no information, then three projects NPV is 90 plus 70 plus 130, do all the three. 90. In this, I can add capital rationing situation saying that I have only 4 lakh rupees. Then you have to see which combination and all that we can do. But here we have tried 1 and 2, we have tried 1 and 3, we have tried 2 and 3, and we have tried 1, 2 and 3. Ultimately, we will do 1 and 3 because this gives me the maximum NPV. Any doubts on this? Clear? Can we proceed? Okay. I now move to the last concept, something called as modified IRR. Let me explain the concept and then we do a question around it. Now, when we did a concept called IRR versus NPV conflict, we learned that there is a project, it generates a cash flow year 0, negative 1 lakh, first year 30,000, second year 40,000, third year 50,000. When I get this money, IRR says that you will reinvest this. You will reinvest this. Reinvest means you will put it in some other project. At what rate will you reinvest? You will reinvest this at the rate of IRR itself. You will reinvest this at the rate of IRR itself. NPV says that you want to reinvest. You can put it in some other project which is equal to cost of capital. Only the cost of capital. What is modified IRR is? IRR based on NPV assumption. What is IRR based on NPV assumption is whatever you get in between, you will reinvest this at cost of capital. You will reinvest this at cost of capital. Now, how does this happen? What are the changes? Let's see. Assume I had 1 lakh, year 0, first year 40,000, second year 40,000, third year 60,000. IRR approach, this is the IRR I got, 17.5%. Okay. Maturity cash flow. Invested 1 lakh. I invested 1 lakh. I got 40,000 in year 1. In the calculator, add 17.5% 2 times. You invested 40,000 in first year. Add 17.5% 2 times. Plus 17.5% 2 times. How much? 55 to 5. Whatever money you got, you reinvested somewhere. You reinvested somewhere and got 55 to 25 in. This is year 0, year 1, year 2 and year 3. This 55 to 25 is year 3 number. 55 to 25 is year 3 number. Second 40,000 you got, add 17.5%, only one time. 47,000. Third one 60,000 as it is, no reinvestment there. Okay. So what IRR says is that you invested 1 lakh in a project, got first year 40, you did not use it, you put it somewhere else. Year 2 invested 40, put it in some project. Year 3 you got 60,000, which now you, instead of taking every year amount, I took first year 0 from the project, second year 0 from the project, third year I took from the project 55,000, 47,000 and 60,000. Third year I took 55, 47 and 60. First year I got money. What did I do? I created a fixed deposit. What is the return fixed deposit will give? 17.5%, which is what IRR says. Whether logical, not logical, let's not worry about it. IRR says you will get 17.5%. So I got back this money. Whether you get this way or you get money in this form, IRR will remain same. IRR for this also is 17.5%. If you apply IRR for this, it is 17.5%. IRR is 17.5%. Whether you get 40, 40, 60 or you get 160 to 225. But the problem is getting another project at 17.5%, which is where NPV says when you reinvest, you can reinvest only at cost of capital. What is cost of capital in this assumption? Let's assume 10%. I reinvest it at 10%. Can you add 10% and tell me what is the value instead of the earlier number? Add 10% for two times. 48, one time 44,000, 60,000. What NPV says is that you got this money, no, you will put it in some other project. What is the project? Create a fixed deposit. What is the return? Fixed deposit will give only 10%. It will give only 10%. Whatever money you got, you put it in a fixed deposit and earn 17.5 as per IRR, which is difficult to get, which is where NPV is more logical approach. It says that you will get a 10% return. If you had got 10% return on the last day, you will get only 150 to 400. You will get only 150 to 400, and IRR calculated for this is called modified IRR. IRR calculated by assuming that you will reinvest it at the cost of capital. You will reinvest it at the cost of capital, not at the normal IRR. Not if you do it at the normal IRR and calculate normal IRR, reinvested IRR, both are same. Normal IRR cash flow and reinvested cash flow IRR will remain same. If you can reinvest it at 17.5%, normal cash flow IRR, reinvested cash flow IRR will be same. Under modified IRR, IRR assuming a reinvestment rate. Reinvestment rate can be given in question or taken as cost of capital. Find maturity cash flow with the reinvestment rate. MIRR is computed based on initial outflow and maturity inflow. IRR assumes that whatever money you get back, you will be able to reinvest it at the IRR rate itself. NPV says that you'll be able to reinvest. Reinvest is company keep doing so many projects. So take money from one project, put it in the other project. IRR says if I'm earning 18%, other project will also give 18, which may or may not happen. NPV says no, let's not have a very extreme example. 18 you are earning, your cost is only 10%, at least 10% projects will be available. MIRR is IRR with the assumption of NPV. IRR with the assumption of NPV. What is the assumption of NPV? Reinvestment at the cost of capital. Reinvestment at the cost of capital. You will understand it better when I do a problem. Let's see it here now. Question 48. An investment 1,36,000 yield the following cash flow. Profit before depreciation but after tax. Determine MIRR considering 8% cost of capital. Determine MIRR considering 8% cost of capital. Now I will start doing it. The given data is cash flow. They have said profit before depreciation after tax. After tax means tax is subtracted. Depreciation is not subtracted. Good. Not subtracted means no need to add it back also. Tax, they have done the right calculation, subtracted. So cash flow is given. Now for doing IRR, at home you can do IRR. Year 0 136, first year 30, second year 40, third year 60, fourth year 30, fifth year 20. If you use this, one positive, one negative is called normal IRR. Normal IRR. Next, computation of MIRR. Computation of MIRR. Computation of MIRR. Modified IRR. Modified IRR. Reinvestment rate. I need some reinvestment rate. Reinvestment rate. Have they given any reinvestment rate? Reinvestment means whatever money you get, you reinvest it. Have they given any rate in the question directly? Cost of capital. Nothing is given, it is cost of capital. Reinvestment rate is how much? 8% in bracket. cost of capital. Cost of capital. Any doubts on this? Now, right, maturity cash flow is equal to maturity cash flow is equal to first year. What money do we get? 30,000 into 1.08 power 4. 4 years you will invest this. You get it in the first year. Invest for 4 years. Power 4 means adding 8% 4 times in the calculator. Adding 8% 4 times in your calculator will make it power 4. 1.08 power 4. Second year, what money did we get? I invest this for 3 years. This we used 8%. No, instead of using 8%, if you use the IRR rate, which could be 10, 11, 12 in the question, that is called normal IRR. That is normal IRR. Third year, what money did we get? Into 1.08 power 2. 2 years investment. Fourth year, what money did we get? Only 1 year investment. Fifth year, what money did we get? Sorry? No reinvestment for this. 20,000. First year power 4, second year power 3, third year power 2, fourth year power 1, fifth year technically power 0. So 30,000 into 1.08 4 times. Our answer and printed answer can have some rounding of difference, okay? 4815. 50,000 388. 69,984. 32,400. 20,000. Let me know what is the all put together amount. All put together single amount. Modified IRR means based on a reinvestment assumption. IRR based on a reinvestment assumption. What's the amount you get? I'll get this money in year 5. I'll get this money in year 5. 213,587. 213,587. I'll get it in year 5. I'll get this money in year 5. What is normal IRR? Normal IRR. What was the initial investment? Can you tell me the investment? 1,36,000. First year, how much you get? 30,000. Second year, 40. Third year, 60. Fourth year, fifth year. If you do IRR for this, that is called normal IRR. Normal IRR is IRR based on this, which is 10.69. My modified IRR will be different. It will be different. We'll have to calculate it. Next, below this, A is equal to P into 1 plus R power N. A is equal to P into 1 plus R power N. A is equal to P into 1 plus R power N. What money do we get back from the project? 2,13,000. That is the amount I get back. What is the amount I invest? Into 1 plus R power 5. Power 5 is not possible in the calculator, but I'll still do a trial and error. I'll explain. 1 plus R power 5. 1.5705. I'll later on show you how you can do one positive, one negative NPV and get the answer. But first, let me try a short approach. Any doubts on 1 plus r power 5? In the calculator, what is the cost of capital? Can you do 1.08 power 5? 1.08 power 5 and tell me what you get. 0.8 power 5. 1 point, some 1.4693 doesn't help. I need 1.5705. Try 1.09. 1.09. 5386. Very close, but still not reach that number. Maybe 9.5. 1.095. Try 1.095. 095. 095. 1.5742. Very close. So around 9.5% is the answer. This is one short approach. If it was power 4, I could have done square root. Other approaches to do this: year 0, year 5, positive NPV, negative NPV. Answer is 9.47%. Positive NPV, negative NPV, and answer is 9.47%. I didn't want to do another IRR calculation, but this is the other option. Other option is year 0, negative 136, year 5 you get back 213,587. Try at 9%, positive NPV, increase the rate, negative NPV. IRR based on this is called modified IRR. IRR based on this is called as normal IRR. IRR based on your normal IRR is 10.69. Modified IRR is 0 here, 0, 0, 0, and you get back 213,387. 9.45% is the exact answer. In notebook, we got 9.47 in that. So 9.45 is the exact answer, or 10.69. Normal IRR 10.69. Modified IRR 9.45. Modified IRR is 9.45. IRR based on normal cash flow is called normal IRR. IRR based on reinvested cash flow. Reinvested means one outflow, one inflow. What can an exam question do? They may end up giving you that factor 1 plus r power 5. They may give. From there you can take it. If they don't give, you have to do this. Year, cash flow, PVF at 9%, PVF at 11%, DCF, and complete the solving. Any doubts on this? Any doubts? As of now, you can write from PVF tables. We have not done all this. 1.5705 correspond to 9.45%. How you got 9.45? You don't know. That is where the other option is to do one positive, one negative. We did trial and error. 9.5 was almost there, but still I did not get exact number. So if you want exact calculation to be done, this is the option, or they may give you table values. From the table, get it. If they don't give you table values, start at not even 9%. You can start at 8% also. 8% is the cost of capital. Then increase the rate, decrease the rate, one positive, one negative. Any doubts on this? With this, the chapter gets over. It may look like a voluminous chapter. The reason is, like we did capital, the financing decision part, we learned it as 3 separate chapters. Financing decision was not a single chapter. We learned it as chapter 4, chapter 5, and chapter 6. Investment decision, ICI did not break it as multiple parts. Else, I could have broken this chapter as multiple subparts. The first part was basics, which we did initially, where we learned the techniques. Second part was on investment decision, where we did some problem. Then we did some problem on replacement decision, and then we did miscellaneous areas. So if I split the chapter into multiple parts, then it may not look like a very heavy chapter. Heavy chapter is only because it is not a single chapter. This is technically your FM as such has only 3 parts. One is called investment decision, second is called financing decision, third is dividend, and fourth is miscellaneous. So 25% of FM is this. In exam, it doesn't carry 25% weightage, but from a concept point of view, 25% of FM is this area, 25% or 30% is financing decision, some 10% is investment, and then there are miscellaneous areas. So here We went through a lot of concepts. My only request to you is go through the concepts today, and at home please mark which question you want to revise. Other chapters also I've told you, not sure how many of you marked and all, but this chapter go ahead today and mark which questions you want to do, which you don't want to do. Today itself mark it. Later on you see you may end up forgetting things. So today itself just mark which question you want to revise, which you don't want to revise, so that it will be easier. It will be easier for you at the revision phase. I don't want you to solve many questions. I want you to be clear on the concept. Concept is very, very critical rather than problem solving. Problem solving, yes, you have to do, otherwise you will not get the comfort, but pay more attention to the concepts here. Clear? Okay, this is done. We'll take a break. We resume at 10:30.